All right, all right.
Hello,
Back.
good morning. We are back. What a nice intro video, Patrick.
I know. Wasn't that amazing?
We are really outdoing ourselves. Big shout out to Rohan, a new member of our team, for making us look like we got our act together.
Indeed. Indeed. Thank you, Rohan. And thank you, Aaron, who's also working with Rohan and kicking butt.
Yep.
Um, we're back, man. We did this yesterday. 12,000 views of this stream yesterday.
And
That's
I
insane.
hear today that we're gonna double that.
I mean, we probably will,
We
especially
probably
with the
will.
folks that we've got.
We do have some very exciting folks. I'm sure that a lot of people that are here already know exactly who's about to come up after you and I get the hell out of the
You're
way.
probably like, get
Uh,
these idiots off the screen. Let's just move it along.
we know what you guys are thinking, and that's fine. We can take that because who's up after us is going to be a lot of fun. I'm not sure if I should give it away yet, Patrick. I'm not.
Don't yet. Let me give a little color about the conference and what people can expect today, and then maybe you can let people know who's coming up next. All right,
All
fine.
right, yeah,
Let's
you
let's
can do
get the
that.
housekeeping out of the way here.
Let's do it.
All right. So for anybody who joined us yesterday and for some reason we're busy taking meetings, maybe didn't get to enjoy a lot of the content, or for those of you who are new today, here's what this thing is. Right, we have a giant audience, a ton of really cool companies, the folks that we've curated and brought together that we think, as Neil put it yesterday, are going to be the next mid and large cap stocks of tomorrow, right? The big boys, the white hot stocks that have really cool stories. We have a lot of those folks that we believe are going to take that next step, right? We just lost half of Neil's body, but
They can't see that.
look at your
All they see
virtual
is you.
background.
Don't
That is
draw
awesome.
attention to it.
That is awesome. Okay, so we have those companies and then a mix, right? This is the really cool part about this conference, right? We're bringing a lot of the audience from these prestigious institutional conferences that those big investors go to, right? And we're bringing that audience together with our retail audience. You guys who are in the trenches day in day out, who are in the chat right now on YouTube and Umbrella, our networking platform, this is all for you, right? So we're excited. We want you to participate. Please write in questions in the chat today for the panelists, for the presenting companies. We will do our best to moderate those questions in. Okay, so that's part of it. Meetings on Umbrella, our networking platform, is obviously another value add here. But yeah, this is educational. It should be corporate access for a lot of you guys wanting to know straight from the horse's mouth what these companies are doing and what's next for them. So, Neil, what did I miss? Anything?
No, I think you're getting pretty good at this. We might just keep you around, Patrick.
Listen, I could use a vacation, so maybe not.
Couldn't we all? I think everyone in chat would love a vacation.
Right.
Speaking of which, I would love to talk about some exciting IPOs that are coming up a little bit later during the show.
That's gonna be fun.
But today, just a reminder, guys, this is about small caps, baby. This is about those stocks that have potential for explosive growth. And the thing about small caps is there's not a lot of information out there about them.
That's
So
right.
that's what this event is really all about. Just like Patrick said, you're going to hear straight from the horse's mouth. The horse in this case is the leadership from these organizations, basically pitching to you the same way that they explain their company to hedge fund managers. There's nothing else like this going on. We're going to keep doing these. This is our first one. So buckle your seatbelts. You're going to learn a lot about the future big stocks of tomorrow. And the one thing I want to add is no dumb questions.
Mm-mm.
As in, there's no such thing. As in, you're allowed to ask what you might perceive as a dumb question. You can ask anything. Use the chat. We're here. We want an active, thriving conversation from people of all levels of investing experience using the chat, talking to us, asking questions so that we, as your humble moderators, can make sure they get answered by the experts and leaders of these organizations that will be present today. So make sure that you're using that chat. If you're on YouTube, and that you're also using that chat if you are on Brella, our networking and one-on-one meeting platform.
Okay, so I think, Neil, without further ado, there is one, I mean, we could call him a special person. Most of the crowd probably already knows him, but there's someone that we should introduce right now, I think. So as he turns his camera on and unmutes himself,
can we get some wrestling intro music?
Could we? Is there wrestling intro music or the rock? I mean, normally he comes into like some Eminem song, I think, but
it's always Eminem. But I want like, I'm your Venus, I'm your fire, your desire.
Do you hear that? Jason Raznick, everyone, CEO, Chief Zinger, whatever he's calling himself today. Where's your wrestling music?
Like my sound effect? There you go. How about that? How about that?
That reminds me of like high school powder puff games. That's what that reminds me.
My screen, I think I look too bright or something, and we gotta change that. Bright.
You look angelic, I think is the word that comes to mind.
I love it. I love the white shirt. You're coming down from a high. I really love it. I hope that you have some knowledge to drop on us.
Well, I need my sport coat. Then I'll put a better reflection. All right, I'll put that on in a minute. But hey, Neil and Patrick, you said people need a vacation. This is my vacation. There's nothing I'd rather be doing today. If you said I could be in Florida on a beach with a drink and a Mai Tai, I would choose this. To get guys like, can I say the name, Patrick and Neil?
You can say it. You can say it.
To get guys like Kevin O'Leary for basically an hour to talk stocks, companies, the future. I mean, this is a guy that can have the voice of the ear of anyone on TV. Everyone knows him. And then the companies we have presenting today, guys, I mean, it's ridiculous. IDEX, YTR, just like the name goes on, the names go on. Mine, like there's just so many. So, and there's so much education. It's not just the companies. Yesterday, Patrick, you mentioned 12,000 people, and combined to like, I think there's probably at the end of the day with the different feeds and how people are reading, 25 to 30,000 people that got access to small cap companies. This was like in the beginning of the show yesterday. It was really funny. I don't want to call the person out, but he's like, what are we seeing? The stuff that Benzinga enabled yesterday was the first of its kind. It's typically only available to institutional investors. And Patrick, it goes back to our founding in 2009, 2010. Wall Street had an edge on getting news prior to Main Street. And that's where we came in to build Benzinga and then Benzinga Pro. Well, yesterday, we gave retail investors access to breaking an original, like companies giving original content versus it just going to institutional investors. That was like, and it was just funny that one person commented like, what are we seeing here? And they just not used to it, because what investors are used to seeing is what you're going to see on CNBC. But the problem with just looking at CNBC is you're going to get Tesla, Twilio, Nike, Under Armour, Lululemon. You're not going to hear about the 75 companies we have here that can be some of the best investments in the world. Every single, like, if it's already Tesla and it's already out there, I mean, that one has gone up a lot, but it's hard to find that alpha. With the smaller companies, that's where you get this information. And by the way, maybe you don't invest in the smaller company, you may find a trend. I mean, we have a lot of EV plays. We have Solo on today, SOLO. That's the electric,
electromechanica.
Yeah. And so these are just plays that, that everyone is talking about. And join the conversation. Neil mentioned it and Patrick mentioned it. If you don't know what the Brella thing is, you can go to bzsmallcap.com and still sign up and network with these companies. All I know is from 2 o'clock to 5 o'clock, I have 16 meetings. They're 10-minute meetings that I have. Some people are scheduled 15, but I like the shorter ones. And I just meeting with the different companies. Like it's fun. It's fun and it's amazing. So I guess that's my piece.
Well stated. I couldn't have said it better myself. I really love how this embodies what you started back in 2010. This is about providing access.
It really is, and it's long overdue. And like we just have the great team to execute on it. There's nothing. It's what you said, providing access. And if you guys have any questions how to like see the agenda or what have you, I know we have Ideanomics. We have a lot of great companies. Oh, we have the one FUV that was on yesterday. They're going to be on the panel. That was a great one. There's another guy on there that's great. There's a great electric panel. I was on the pre-call. It was amazing. But if you guys have any questions or you're confused, you can always email events@benzinga.com or follow our Twitter. And anything like that. But there are 2 YouTube channels, and there is Umbrella 2 channels too. So don't miss that. Both channels. If you go on the right side, you can like see the other thing, and there's other companies that are presenting at the same time. When I'm talking to Kevin O'Leary, he's talking. There's another channel. I think the first one's like IDX. I'm not sure, but I think that's what it is.
Mm-hmm. Jason, one more thing, just to piggyback on that, we will be dropping an email address into both chats on YouTube and Umbrella for each of the companies that are presenting. So if you don't have a meeting scheduled or you do have questions for that company, you will have access to them in the chat. So make sure to follow that as well.
Yeah, and one thing I want to add is guys, while you're here, make sure to like and subscribe so that we're able to keep producing these events for you. That's the only way that we know that we're doing. Did you just soundboard me?
I think you did. I think you were like giving an Oscar speech and he was trying to play you off. I think that's what it was.
Oh, that's a John Cena move. Neil is right on. Like and subscribe. If you don't do that, then we can't get the word out. I mean, these other guys have way more power, more reach, been around for 60 years. Benzinga's founded in 2010. We are here for you. We're financial news for the millennials. We need your help. This is Zinger Nation. You are all zingers. You're all part of us. We need to get the word out. So we know you're here. Please spread the word. Share on your social media. Share wherever. Let the world know. So these companies that you're looking at, like if you're investing, other people can hear about it. We truly greatly appreciate it. It was a John Cena moment. All right. Yes, I am surprised by the music board here. I didn't know what sound was about. Okay.
Jason has a new toy. That's all good.
Yeah, exactly. Listen, I think before this goes any worse, we should move on. We should move on. Neil and I, Jason, we're gonna get out of your way because you have somebody important to introduce now.
Yes. All right.
So, all right. Have fun.
Thank Are you guys going off and then I'm introducing
now.
Yeah. Yep.
All right. So I'm excited. Okay. I got to get my sport. Okay. All right. I am excited to introduce the man, the myth, the legend. Some people call him Mr. Wonderful. Some people call him the guy who, can turn nothing into gold. Some people call him the guy who went pick up gum from the scraped gum with a spoon off the ice cream floor. And then he quit his job and said, F this, I'm doing my own thing. They still have not tracked down that boss of his. They're still looking for it. And I'll just call him a friend. And Kevin O'Leary, welcome.
Thank you so much. That's great. I just want to do a shout out right now to Benzinga because I've been involved almost from the beginning, and you really have morphed into a platform that supports the entrepreneurial community. And that's important because there's a lot of shifting sands going on right now. And you are right. You focus on companies that are undiscovered and help them grow. I've seen it happen. I think it's a terrific job. I want to talk a lot about that today. We've gone through an extraordinary year. And I want to just do some of the milestones that I've learned from this and the outcomes. I mean, what I learned and what I knew in March is completely different what I know in December now. And we should share these with the community.
Yeah. And what we'll do is I think you're going to talk for like 10 or 15 minutes. And then I'm going to come back on for the last 20 minutes or something and ask questions about the amazing story of Start Engine and the different great stories of taxes. But I guess we're letting you, talk for 10, 15 minutes or so or what have you. And then I'm going to come in with these follow-up questions. And then we're going to take 2 or 3 questions from the community. I see there's 2,000 people in here right now, or maybe more actually now. So we're going to take, 2 or 3 questions from the community as well. So do you want, I guess I'm kicking it off to you to take over the screen and get.
Yeah, thank you. I'm going to do a quick snapshot for everybody that's listening about what occurred. I've got investments in over 50 companies right now, and they're almost in every state and almost every sector. And obviously, when you have private companies, as I do, these are, entrepreneurial companies that are trying to solve people's problems. Generally speaking, if you just looked at a basket of them and said, how are things going in, pre-pandemic, 50% of their sales would have come from retail, 40% from Amazon, and 10% from their direct websites to consumers. And the way we manage a portfolio that big is we don't put a price on the shares. We discount free cash flow. So, a really healthy company, let's say, was doing 100 million in sales, it would be making 15 million pre-tax in cash flow. And that's a great business. Now, what happens by the third week in March, and I've never seen anything like it, because we get the numbers reported to us almost every week in most cases. So we get the top line sales, bottom line cash flow. By the third week in March, every single company we were an investor in was cash flow negative. It was losing money. It was unbelievable chaos. And the reason that was happening is that basically retail shut down, which is 50% of their sales. And when you sell something in retail, you're basically making 50 cents on the dollar because you've got to pay the distributor and you've got the retailer and all the rest of it. When you sell something through Amazon, you're making 55 to 60 cents on the dollar. And when you sell it direct to consumer, you're making almost 100 cents on the dollar. So let's just remember that as we go through what happened the next few months. Now, from that chaos, I worked directly with CEOs, and we teamed up to try and figure out how to maximize our opportunities with the PPP loans. And as you recall, the way that deal worked was you had to have a good snapshot of your payroll on Feb 15th, preparing to compare it in June 30, and then they would determine whether that loan would be released or not, or forgiven. And that's when I learned, I guess Eureka number one, if you want to call it that. I found out that the majority of my employees, people in their early 20s or late 20s and early 30s, and our supply chain, almost could be more than 10,000 of them, 95% of them had nothing in the bank. They put nothing aside. And they were freaking out because the discussion was, do we furlough half the employees or do we just cut everybody's salary in half to get through this? So they were in dire straits. That's lesson number one. But the rest of the story is rather optimistic. And here's what happened. Let's fast forward to today. Today, I can report to you that 80% of my companies are actually ahead of free forecast cash flow for Q4. How did that happen? How is that possible? I would have never guessed that outcome. Now, not all of them are going to make it because the ones that were involved in the wedding industry or with cruise lines or supporting sports stadiums or restaurants, particularly in California, have been very vocal about the rules that are applying there. They're not doing so well, but the other 8 out of 10 are on fire. So here's what happens. By the early part of April, they figured out that retail has collapsed on them. So let's say, I always like to use an example. This is a company I've talked about before. This is called Love Pop Greeting Cards. Isn't that beautiful? That is a 3-dimensional firefly in a greeting card, laser cut in Vietnam. This is America's fastest growing greeting card company, headquartered out of Boston. And it obviously, greeting cards are purchased as emotional purchases in retail. In fact, this company had a store in Hudson Yards in New York. And if you know retail space, it's the most expensive on earth. Store got closed. So what did the company do? Well, it had to pivot. I call this the great digital pivot. The successful companies figured out how to do it. And well, here's what they did. This is around Mother's Day, if you recall, March, April. And one of the women there that was one of the designers, they used CAD stations, said, hey, I can't get my mom any flowers because all the flower distribution companies are closed down because of COVID. And the flowers are rotting on their shelves. So she goes to her CAD station and designs this. This is not a greeting card. These are flowers. Isn't that beautiful? I'm such a romantic. I love that. Look at that. That is the 3D basket of roses. She went online with this. She offered it to their customer base. It sold by the millions of dollars. It was a digital pivot. They figured out how to survive. The company's doing immensely well. Categorically, all the companies that did moves like that, here's another one. This is called Blue Land. Their mission, this is a joint investment I have with Comcast Ventures, is to get rid of plastic bottles for cleaning fluids, like dish soap. 5 billion bottles get thrown out every year. A lot of people don't want to do that anymore. So they have a patent to crystallize, that little tablet is crystallized cleaning fluid. You stick it in a reusable bottle, and you don't have to throw this out. These are FedEx to you. They're very inexpensive, really works on all kinds of fluid, whether you're cleaning a toilet, whether you're cleaning dishes, whatever, it's crystallized technology. It was supposed to launch in a big box retailer March 15th. Talk about being screwed. So digital pivot. We start shooting commercials while we can before New York shuts down. We start buying remnant cable ads all over the television networks like Midnight Communications, and immediately sales explode. Direct to customer, no retailer involved. Incredible. Companies on fire doing $3, $4, $5 million a month when we thought we were going to be a zero. And on and on. One last one. Look at this. This is base pause cat DNA tests. I mean, Yeah, I'm an investor in this. Why? Because it's the craziest idea I've ever heard. There's 110 million cats sitting at home. Everybody's sitting at home with their cats. They're looking at their cat saying, I wonder what my cat's DNA is like. Frankly, you can buy a cat cheaper than test its DNA. But hey, that's just me. This thing's on fire. It's a direct-to-consumer product. You swab your cat, you send it in, we tell you what it's going to die from and what you can do to keep it lasting longer. Listen, I'm not a cat guy, but I love cash flow. This is a fantastic business. My whole point is digital direct-to-consumer is what changed. But there's more good news. Now, this is why the market is on fire right now, in my estimation. Let's just talk about my companies, anecdotal information. It turns out people in accounting, in compliance, and logistics do not want to come back to HQ. That's about 15% of my staff. No interest in coming back to work in a cubicle. They want to stay at home. They're raising kids or taking care of elderly parents. They don't want to commute. One guy wants to move to the country, buy a farm and raise pigs and chickens. Okay, I get it. Guy's in his late 20s, I get it. So that means we can reduce our costs at HQ. So we're cutting back in states like New York, Florida, Texas, California, which is the nexus of where my HQs are, talking to REITs. In some cases, we have to litigate. Others, we're negotiating. We're dropping our demand for that expensive square footage by about 15%. But here's the one. So that's a savings. Remember I said an optimized company doing 100 million in sales, making 15 million pre-tax. That's savings number one. But here's the one that I'm just freaking out with joy about. I can't believe this. Another anecdotal story. Here's a company, one of my companies, Boost Oxygen. What is this? It's a consumer version of the same oxygen airline pilots breathe in the cockpit. 95% oxygen, 5% air. I use it every day. Boost, that's what it is. Selling like crazy, not only because of COVID, but it started in just high altitude places, Colorado, Denver, that kind of thing. But it's selling so well, a giant big box retailer, maybe the world's largest retailer, can't mention their name, biggest retailer in the world, wants to expand to every store with this. Now, normally what we would do with an order like that is the CEO would go, the head of sales would go, her support team would go, and I would certainly go because I'm an equity investor in that thing, and we would make our pitch together. The cost of us to do that, about $23,000, all right? That's business, travel, and entertainment. Here's what's actually going to happen. This meeting for Boost is going to happen on an 18-minute Zoom. All participants I just mentioned, and we have the unmitigated attention of the buyer for 18 minutes. In fact, the buyer's happy we're not showing up because now that buying team could put in, instead of 5 meetings a day, they could do 8. 18-minute meeting, 5-minute break. 18-minute meeting, 5-minute break. It's incredible. Think about that. We're slashing our business travel and entertainment costs by between 20 and 50% in Q1 and Q2. I mean, yippee-yi, yo-kai, yay. Instead of making 15% pre-tax, we're going to make 18. That's a 20% increase in optimized free cash flow. Now, is that good news for the airlines? No. Is that good news for some dumpy motel outside of HQs of giant retailers? No. Is it good for all the crappy food I had to eat when I go there? No, not going to do that anymore. In fact, I don't know what percentage we're going to permanently eradicate from business travel, but it's going to be a lot because this technology, this enabling digitization, the Zooms, the DocuSigns, the Facebooks, the Shopifys, the CrowdStrikes, all of those stocks, those incredible empowerment platforms have obviously been revalued by the world's economy because they empower direct-to-consumer businesses. And that's something you should think about when you're launching your deal. You should have some significant portion of it direct-to-consumer if you can, because that's what investors like me want. Now, if I see a new deal and I don't have a smoking hot digital team in there, I have no interest. I want people that know how to create fantastic videos, amazing presentations, really data-rich websites, great photography, all of that stuff, because I know that's where I make my money. Now, if you're telling me all you're going to do is roll out in retail again, that's yesteryear. That's dinosaur land. The new trend for anybody that's starting out is to focus directly on the consumer. So that's what I want to see. Jason, that's my 2 cents. Hopefully I've been useful in that, because I've never seen such a digital pivot in my life. And I'm a very happy investor today. Listen, I don't want to say that this pandemic has a silver lining. This pandemic's been hell on earth. A lot of people have died. But if it did have a silver lining, it's this. It forced digitization. It accelerated us into the digital era. And I'm very, very bullish about America 2.0. When this is over, we're going to have a much more efficient economy, a much more direct to consumer, higher cash flows, more productivity. And I'm so glad I'm an investor in it. Let's open it up.
Yeah. So you can hear me, right?
Yep.
All right. Beautiful. No, what you just described was unbelievable in the sense of like how these companies have pivoted. And I want one of that boost oxygen things. I just need that. Like that.
Yeah, baby.
Amazing. That boost oxygen thing's amazing. Okay, so I do have a quick question on Love Pop. I mean, that company now is I remember from the very, like, it was probably first season that when you invest in Love Pop, second season, early, but has like Hallmark tried to buy you guys out?
It's inevitable that one of those guys will try and buy us out. But, Wambi and his team, when they're growing and you're just growing like a weed, why sell out? Like, why not just keep building the base? And they're getting so much more sophisticated at determining how to sell direct to consumer. And the margins on these cards Wambi should be in jail for those margins.
Wow, they're that huge? Okay. Yeah, I know that. I mean, they're amazing looking too.
Yeah.
I bought them at, I forget where I sent you in Boston. I bought them from like Faneuil Hall, like this whole thing. I remember I bought it as a gift. They're like people are like, where'd you get? They're so amazed. The margin, that's impressive, because those things don't look shabby. So there's a lot we have to talk about. One thing is, actually, we're here in Detroit, Michigan, and our local news station, WXYZ, was talking about the $25,000 you're giving out with Start Engine. So will you talk more about the equity crowdfunding platform you have, and how does that work?
Yeah, there's a massive change going on in the market in terms of where my companies seek capital. In the old model, it was venture capital firms, which always, and I have nothing against them, I've done business with so many different VC firms, they always seem to want a preference share, and they always have a timeline. They create a fund, and by the fifth year, they start getting itchy to get an exit because they have a 5 to 7 year mandate on a time horizon. But it's always a preference shares. They try and differentiate themselves from all the other shareholders. Then there was the hedge fund guys that did factoring for receivables, nothing wrong with them. But also, private equity firms have also been involved in trying to, get positions in fast growing private companies. So I deal with all of them. Then along comes crowdfunding, equity crowdfunding, the ability to go to your own customers and offer them shares in your company where your interests are completely aligned. Now, when I first saw this happening as a result of the Jobs Act a few years ago, I said, I'm going to do this myself. I know a lot of people out there. I've got a lot of followers in social media. I have a lot of companies in my portfolio. I'll just create the Mr. Wonderful equity crowdfunding platform. So I started calling the other platforms, and I ran into Howard Marks. Now, I know Howard from the days of the Learning Company because he was a co-founder of Activision. And I started talking to him. And what he had done, and he did it sort of ass backwards. He basically got all the investors on his platform first, and then started bringing companies. So he had this amazing platform called Start Engine. I realized he was way ahead of me. I couldn't compete with him. So best thing to do there is realize when you're beat. And I joined him. I became an investor in his platform. I became a paid spokesperson for him. I'm a huge advocate. I got some of my companies to start using it to actually fund. We've done, multiple raises on Start Engine. But I'm just telling everybody here, if you want to raise $1,070,000. That was the original CF regulation from the Jobs Act. But they just announced, and it's going to probably be implemented in a matter of weeks, that they're going to raise the limit from $1,070,000 on a CF round to $5 million. Now that puts it as a direct competitor to every single venture capital company, because that's the typical first time round, a $5 million pre. Now you can do it in a much more interesting level playing field. You set the terms, you set the preferences, you decide the pricing, and you get this massive base of investors which don't all have a time frame when they need to exit. It's incredible. So I'm a huge advocate for this.
And you create loyal users that are like advertising your brand. I mean,
yeah.
The one thing that I have to do it all over again, we have like our Benzinga nation, like, and they want to invest in us, and they ask me all the time, and so nice from square one to have your community part of it. Because to grow companies these days, like you were talking about, so many of these direct consumer plays, it's not just, going and buying, AdWords and your CAC and your, CP, whatever. It's getting people to talk about you. I mean, that's like the conversation. So you could, like, that's why I think the start engine thing is the future. I mean, I think it is. Now it's risk. It's like, if you don't throw money in there if it's not, you know what I mean? But if you want to be investing in these private companies before they eventually go public, it's an opportunity to get in there.
Yeah, the key to a start engine strategy is a portfolio. You go on the platform, you shop the deals, you see the ones you like. It's like I have 56 companies. I'm hedging my bets. I don't know which one's going to win. You can't know, but you don't want to, put everything in one deal. You want a portfolio, in my view, a minimum of 10. But that's what the platform lets you do. And then you monitor what they're doing. And it's always the same story. Alex Kenji, who runs my venture platform, we're always amazed year in, year out. The ones we thought were dogs are huge hits, and the ones we thought were huge hits are dogs. Who knew? But you have to have a portfolio. We have some amazing outcomes. Look at Plated. It was sold for $300+ million to Albertsons. And I didn't think that was going to go anywhere. I wish we hadn't sold it. Now, through the pandemic, those plated kitchen meal kit companies, we got 300. I could have probably got $1 billion for it if I just waited 1 year. But you just don't know. That's the whole point.
I know I kicked myself on Blue Apron. At one point, it was down to like $1 or 80 cents. And yeah, the pandemic. So another thing that is big, PPE and taxes and companies getting the PPE. And I think that you have a company that helps in this process. Tell us more about what you think about taxes and the PPE. And
yeah. No, the thing that I learned, Jason, during the March-April period, we had to scramble for our accounting records. You couldn't get the PPP unless you had razor sharp accounting records and payroll records. And the 20% of my companies that didn't get the PPP, it's because they didn't have the right tax accounting records and they had no record keeping. They just hadn't kept up with it. So that's something I fixed. I searched the market. I found a company called TaxHive that's really designed for those startup sort of $1 to $5 million companies to help them do their taxes with the same power the big guys have. I mean, I have a giant accounting firm managing my taxes, and I plan my taxes. I don't bring them a shoebox of receipts in December. I meet with them every quarter and say, what do we do here? What do we do here? And we kind of plan to optimize our tax situation. I wanted that for my companies. That's what TaxHive did. Same deal there. I became an investor in the platform. I became their paid spokesperson. I'm pounding the table. If you are looking for a great deal in tax preparation and maintenance of your startup, just go online and check out TaxHive, because that's exactly what they do. And as these government programs, including the new stimulus package that's coming, and probably the one after the lame duck is over, you need to have razor crisp accounting records. I'm big on that. I'll never catch myself in that situation again. I want reports every quarter that are auditable.
Yeah, tax, like dealing with that right now, end of year stuff. So I was here till 11:30 doing that, numbers and figuring out stuff. That is like, when you build a business, when I first started it, you think of like, want to solve a problem, give a solution, give whatever it is. I don't necessarily think about taxes. And so like, I'm here at 11:30 last night doing taxes, but that's why you have things like TaxHive to make your life easier. That's the innovation of virtual, right?
Yeah.
Yeah.
There is one other area that I want to bring up. The amount of digital spend that we've been putting out has been huge. It's, I can tell you now, Q1 2001, 81% of our digital spend across my portfolio is going to Facebook and Instagram. Now, the problem, first of all, congratulations, Facebook. They're very, very efficient. You can measure your digital spend. But the algorithms are getting so complex that you really need some help to optimize customer acquisition. And the third sort of stool in my investments because of COVID has been with a company called Eureka. It's a spin out, a bunch of guys that left Facebook to start this company up, designed specifically to help you optimize your digital spend. What better company to work with than ex-Facebook guys who were probably involved in writing the algorithms in the first place? So we're using them. I'm all same deal. I'm an investor in them. Paid spokesperson again. But those are my three things: taxes, no question, raising equity crowdfunding and reducing customer acquisition costs, Eureka, TaxHive, and Start Engine. Those are the big moves I made in the last 8 months.
I just wrote down Eureka because I'm going to Google it after we're done, because I mean, that's what we've increased our spend. People are at home now trading. We've never seen growth like we've had in our history of our lives. It's crazy how many traders there are. And we're doing a lot of Facebook and Google, more Google. But Facebook, the targeting you can do on it is unbelievable. But you need like a scientist to do it. You can't. It's not a thing. You just click a button and you go there.
Yeah. Eureka's killer. They can help you reduce your costs dramatically. You can even talk to some of my companies that have used them. It just blew their heads away, saying, "I can't believe how much I've saved and how much I was screwing up." Because there's nobody. It's not in Facebook's interest to tell you how to optimize. Come on, they want your dough.
Yeah, who is the guy at Eureka that I should?
Just the best way to do it is go to eureka.com, because they have so many different teams. You have to tell them a little bit of what you're doing, and they'll assign you somebody as a coach. It's phenomenal stuff. It really works. I mean, it pays for itself.
Now, one thing you've been pretty vocal about the PPP, about supporting unemployment but not companies, and you've been debating on CNBC, arguing with that one guy. It seems like you guys are going to start a boxing match. You know, they do these social media boxing matches. Maybe you guys are going to do that. We can raise a few $1 million for that. I don't know. So what's your take on that?
Well, my take is I've saw what happened in the first PPP, and here's what I think. It's a personal opinion, but I bet you I'm right. 30% of it was completely pissed away. There's no point in giving money to a business that's going to zero because consumer preferences have changed. Let me give you an example. Movie theater chains. You saw last week that one of the largest studios on earth just declared, starting in Q1 next year, every tentpole movie is going to be released digitally on streaming services at the same time it goes to theaters. That's code for saying movie theaters are going to zero. And here's why. If I'm an investor in a movie theater chain, why would I expend capital to upgrade the carpets, the seats, the popcorn machines, the pop machines, when I know the same movie that I'm putting on my screen, that I'm charging you $15 plus parking of $20 plus food for another $40, whatever it is, you can just watch at home. Of course I'm screwed. So I would never invest in that. And why would I want the government to take my tax dollars and give it to that buggy whip business that's going to zero? Maybe an IMAX can last because it's a unique experience. I don't know. But the point is, you can't sit around the campfire kumbayaing about these things. You can look at a buggy whip in the Smithsonian and look at it, but it's a useless product. And I'd argue the best thing to do with a movie theater chain sitting in a suburb is convert it into a climate control pick and pack facility or a cloud kitchen or a condominium, because we don't need it anymore. And so why fund these zombie living dead companies with my tax dough? I say all the employees in there got to find new jobs. So let's support them for the next 14 months. Let's give them unemployment extension benefits and send everybody a check for $1,200. Much better than, and here's another one, 17 more billion to airlines. Why? I know I'm cutting back 20 to 50%. Airlines' middle name is bankruptcy. That's what they do well. They always go bankrupt every 10 years to downsize capacity. So the remaining airlines could get some measly return from themselves. I'm all for letting them go to zero. Let's let two of them go bankrupt. I'm just calling out the facts. You may not like the message. Don't shoot the messenger. These businesses have to go to zero, and their protein gets reprocessed in the economy. It's like a fish dying. If every fish stayed alive in the ocean, there'd be no food for anybody. They have to die, go to the bottom, the sea slugs eat them, reprocess the protein, somebody eats the slug, then it goes up the feeding chain again. Let these dying companies die. They want to die. Pull the tubes.
So how do you deal, like, now going on a more personal note, how do you deal with the vitriol from, like, when you're saying these opinions? I mean, I saw, like, you're a gym owner wrote something. I can't believe Kevin's saying this. You probably thousands of tweets coming at you a day. Do you read this stuff? Do you ignore it? How do you handle all that stuff? Because you're an opinionated guy, and obviously when you make opinions, people are going to respond.
You know, it's a great question, and I learned lessons from, I had a mentor named Jerry Patterson years and years ago. The guy was actually a hockey agent for Russian hockey players coming into Detroit and Boston. I mean, it sounds crazy, but it's true. I was producing television for the hockey leagues back there in the original 6 cities. But he said to me once, you know, Kevin, in your life, if you know something to be right and you have a goal you want to pursue, you're going to get a lot of noise. There's going to be noise to the left, noise to the right, noise behind you, noise in front of you, but you can't listen to that noise. It detracts you from achieving your goal. So, you know, and the other lesson I learned was from my mother. She said, if you only tell the truth, you never have to remember what you said. When I tell you movie theaters are going to zero, I believe that to be true. So all the crap I get around the sides, I don't care. I mean, I actually don't care. because I think I'm right. Now, you can disagree with me. You can have your opinion. And that's very important that we have that dialogue. But don't tell me I have to take my tax dollars and give it to an airline or to a movie theater or to some other business that's going to zero. That's really bad. And so what? If you're not happy with it, I couldn't give a beep. That's the way I look at it.
Okay. Yeah, it's like your line that you say when you at Shark Tank, "You're dead to me." Like you ignore the noise, basically. It's
still the truth, Jason. Don't shoot the messenger. It's still the truth. Are movie theaters going to zero? Whether I say it or not, yes, they're going to zero. It's the truth.
Now, speaking of a company and a stock that at one time, and I love it, you're open to look at changing opinions, especially when you have a smart son. At one time, you were in our office like 3.5 years ago, and you used this analogy. We were talking about Tesla, and you used this thing, and I haven't forgot about it because I was long Tesla, but it made me rethink my position a little bit. But the thing you were talking about is, if you take a train track, you don't know what kind of train. If you take a train, you don't know what kind of train you're on. And your point was cars are going to become commodities because they're going to be automated driving in 6 years. So you're not going to know if you're getting a Mustang or this one. I'm like, it's an interesting point that maybe it's not 6, maybe it's 10, whatever. And so, but then you changed and you bought Tesla at a good price. Can you just tell your story, a little bit of your story? I know this is not part of the interview, but I think it's very, I think it'll help listeners who care about Tesla and how you think about things.
Yeah. I remember to the day I was sitting at the kitchen table. Halftime report, a show I participate on CNBC was on. My son, Trevor, who was in the middle of his first round of internship at Tesla, he was working there. He was back. We're having lunch. The stock is getting slaughtered. It went down to 238 that day, 238 pre-split, because some guy downgraded it because, in the early days, Elon was doing crazy stuff. I love his crazy stuff, by the way, but he was doing a lot of it then. And I said to my son, I won't even, he said, "What do you think about Tesla? I'm working there, Dad." I said, I would never buy this stock. I'd like to short this stock. This is a ridiculous price for a car company. It's trading and he said to me, "You don't even know what you're talking about, Dad. This is not a car company." I said, "What do you mean? You're working there. They make cars. They got 4 wheels. They look like any other car." He said, No. The car collects data. This is a data company. The more miles driven by the cars, the higher the resolution of the data for one day when autonomous driving matters. And we're developing battery technology that everybody's going to want. This is a data company. Now, I don't have any dough. That's what Trevor said to me, because it's true, but you do. Why don't you buy some of this stock? It just got slaughtered. It's $238. So I'm sitting there on the kitchen table. I go on, I buy a bunch. And you know what happened. I have a rule that I won't let a stock be more than 5% of a portfolio. I've been selling that stock every week down to 5%. It just won't stop. And then, I had to admit, and by the way, Trevor is now, he's going to work at Tesla. He's starting in January full time. So, he just basically proved that you have to listen. You have to shut your mouth and listen. And when you're wrong, you have to admit you're wrong, and you got to make your move. And that's what I did in the case of Tesla.
Okay. Am I back? Okay, here we go. So on your Tesla trade, it's pretty funny that, like, I'm looking at the YouTube conversation. Someone's like, "Is Kevin upset he never bought Tesla?" But Kevin bought Tesla, guys. See, they're not out. They can't watch every moment. But someone was saying that. But that is a thing where you reconsidered, and your son, data on wheels, like you call it. So I want to move on to some other things you're doing in the psychedelic space. And I remember one thing that I think you do, Kevin, you see trends before they happen. You see like things like little trends of this is going to be talked about. I even think the wedding space, it was a cool product, Love Pop, but you knew that invitations need to be reinvented. They need to be cool, different. Again, seeing the trend. Psychedelics, you're doing some interesting stuff in that space. So I think that goes on to the thesis that we're talking about. So can you talk about what you're doing there in the company a little bit?
Yeah, I was never a participant in cannabis. I got so many deals offered to me in the cannabis space for one reason. I have so many different companies. Some of them are in fintech, and I'm a registrant for those companies with the SEC, and the regulators really matter to me, and I have to be compliant. And what I always worried about with cannabis was there was no way to invest in it as a medicine. You had to invest in a company that said they might pursue medicine, but they also have recreational product. cannabis is still a Schedule I narcotic. I know the House is trying to change that. It won't happen. The Senate's going to block it. So it remains a Schedule I narcotic subject to the RICO statutes. I don't want to get too complicated, but the challenge is if you're involved in moving an illegal substance for a recreational purpose over state lines, one state it's compliant, the other it isn't, you can get into a lot of trouble. So I had to avoid that whole sector. When I got approached on psychedelics as medicine, it was a couple of years, maybe 2.5 years ago, same idea, to be an early round investor. I was really intrigued because I suffered with all kinds of issues when I had dyslexia when I was young, and we haven't had new drugs for these mental issues for 30 years. Depression, ADD, opioid addiction, alcoholism, all of anxiety, all these issues are given drugs that have been around for decades that are really not that good for you. And so the premise of this sector, this idea was, let's take psychedelics and research them with FDA trial approved medicines. In other words, go through the trials, stage 1, stage 2, stage 3, under the FDA guidelines, nothing to do with recreational drugs, not dropping acid and all that stuff. Let's figure out if there are medicines here that work, because the anecdotal data is really interesting. And I met the CEO and the board and the other investors, and I had multiple meetings with them. I said, guys, if you're going to pursue recreational drugs, I have zero interest. But if you're telling me you can solve for opioid addiction, just opioid addiction, a multi-billion-dollar problem, I would love to have a position in that, because that's a big idea. I love big ideas. And they assured me, and I think we are going to hear from JR, the CEO, in a few moments, that they were going to pursue a non-recreational path and do medicines only. So I got on board in a big way, and I became a spokesperson for the sector. And I will say to those of you who are interested in investing in this sector, I learned a lesson back in the biotech days. When you invest in something that's a new medicine, you don't know the outcomes. It's a binary thing. Either it's a zero or it's a massive win. You want as many trials and as many molecules as you can possibly have in your portfolio to diversify your risk, because you don't know the outcome of these trials as they go. And what I liked about MindMed was they had multiple opportunities, multiple trials, multiple ideas, multiple markets. And that's the one I put my big bet on, because I like that diversity. And in anything you do in medicine, particularly a brand new medicine, get diversification on trials and molecules. That's the one piece of advice I've had. Now, having said that, MindMed has been an extraordinary outcome. I mean, I have to admit, it's of all the positions I have and all the companies I have, it outperformed everybody in 2020. But I could have never foreseen that.
Wow, I remember when you did it. Because I heard from Nancy, and I'm like, oh, this is interesting. It's a little off the radar for Kevin. I was like sort of surprised, and I did. I was like, okay, I was probably just like how I was probably a bear on it. I was probably like, this one's not going to be his favorite, or be a great, and totally, killing it. That's what you can say. And JR is speaking shortly, so you guys get to hear. And it's a public company. You can hear how the company's doing and the progress. One of the questions in the chat, I'm going to the chat question. They want to know what you think of SPACs. So what do you think of the whole SPAC craze these days?
Yeah, I mean, SPACs are a competition for private equity, and there's over 208 deals right now. I've actually did a SPAC a few years ago myself. But the key to SPACs, which you really should think about, is the sponsor. I only buy the deals where I know the sponsor has been a player successfully in private equity. So I own Bill Ackman's stack, the Gore brothers stack. You should look at the person behind the stack, because I know Alec Gore from years ago. The guy's a really good operator, great operating team. He's got a brother too. These guys know how to do deals. I know some of the team over at Ackman's shop. They're really smart guys. And so they're not going to do stupid deals. That's your assumption. But there's a lot of SPACs doing crazy stuff that are really doing very speculative deals that are really venture deals. And, I don't buy those ones, because, the outcome is so unknown. If you're going to buy a SPAC, make sure your horse and your jockey are proven winners. I mean, people that have done deals before. You can't say Ackman hasn't made money. You can't say Gore hasn't made money. You can't say Michael Klein hasn't made money. These guys, know what they're doing. So I'm very selective. I do own a bunch of SPACs. By the way, they're up. They haven't even announced deals yet, and they're up. So I mean, there's a lot of optimism. So I'm on board for SPACs as long as you like the operator.
Yeah, I own Atkins too because he's pretty smart. Now we have 2 minutes left, so I have 2 more quick questions. Now, first one is Beanstalk. So what's the latest financial literacy? I know you guys are doing stuff, and I know your ETFs are growing. Let's go to like the financial side of things. I mean, you have about 10,000 listeners right now. Want to hear about this?
Well, Beanstalks is my push into 2021 on financial literacy. I was so freaked out by what I saw during March and April in my own base of employees that I really had to get focused on this. And I went and looked at all the apps. I was going to endorse somebody else's app, but I needed one that invested the way I did, that also had platforms for savings, for project financing, and also long-term investing. And that's what Beanstalks does. So I sort of got behind, one that really reflects my investment philosophy. So, I mean, if you are nervous about trading, or you don't know a lot about diversification, or you've never invested before, what I'm really pitching on Beanstalks is, look, give it a shot, download it. For this month of December, I'm waiving fees for the next 3 months just to give everybody a try. I'm telling people, put up $100 a week. If the average salary is $52,000 to $56,000, depending where you are, there's 100 million people in America, I discovered doing research, that have no strategy for long term, that don't have an investment account. You got to have something ready for when you're 60. So I'm just saying, put $100 a week aside into Beanstalks or any other app. Frankly, I endorse just financial literacy, but Beanstalks is the one that reflects my investment philosophy. As you know, I like ETFs, I like diversification. So, that's what Beanstalks does. But I would also say, there's great ones that round up credit cards. There's day trading apps, all that stuff, but that's not for me investing. Beanstalks represents my philosophy. Give it a shot, download it, try it out. I'm trying to get 100 million people in America to start investing.
Can I purchase O shares on that?
No, actually, I'm completely arm's length. We don't have O shares on Beanstalks yet. I want to be arm's length and transparent on it. O shares you can buy on any platform. There may be a time, but I don't know when. But there's many, many good ETFs. I'm an advocate for the whole sector. I want a really great portfolio for everybody in there, and you can see the performance of what we do inside of Beanstalks. But I don't want to cloud it by putting my own ETFs in. I'm really about endorsing people's mental state to start investing. Get $100.
I just like your ETF, like your grandma's philosophy: dividends, OSUR. You're like dividends, companies that make money instead of just looking for a high flyer.
And that's what you're going to find in Beanstalks. That's what you'll find.
Guys, I'm so sorry to interrupt. It's Patrick. We've got JR coming over. JR, turn your video and mic on, if you will.
Here's JR, Kevin.
We'll keep this rolling. But JR, anything you want to say to Kevin? Kevin, anything you want to say to JR? I'm sure you guys talk a lot anyway.
Well, I'll say one thing about JR. Of all my companies, he is today the rock star in terms of performance. I care about performance. There is no investment I've had in 2020 like MindMed, and thank you, JR. Thank you.
Must be a good feeling. That must be a good feeling, JR, to hear that. Hear it? JR?
Looks like your sound we need a little help with, JR.
Okay.
Maybe jump in a little bit closer.
There you are. We got you.
All right. Can you hear me now?
Yes.
I was just singing your praises, JR, my top performing CEO of all my companies.
Well, thank you. Hopefully we're gonna keep it that way, because you're a positive guy, but you can also, you know how to lay it in there.
I love it. All
right. Well, thank you, Kevin. Thank you for coming on.
Thank you.
More of this. One of the questions someone asked, what's a day in the life like for Kevin? But I guess we're cut out now. We'll have to.
You're cut out. You are done.
For the next one.
Get this guy off the screen. Kevin,
I want to listen to JR's presentation, and I'll critique it later.
Good.
Thanks.
Okay, I'm gonna do
awesome. Well, let's keep this moving, you guys.
Okay. Thanks everybody.
Very much. We'll keep this moving. JR, I'm going to give you a chance to start, okay? Thanks everybody for joining us. JR, Ron here from MindMed. The symbol is MMEDF. MMEDF. JR, for the folks that are watching that have no clue about the opportunity in psychedelics, or about anything about you or your company, give us just a quick couple minutes on who you are. Obviously, I think most people are familiar with LSD, psilocybin, but but maybe give us just a quick minute or two about who you are and in what this industry has in store for all of us.
Sure. So MindMed is a biotech company that happens to be developing psychedelic medicines to treat big problems in society, including mental illness and addiction. I think these problems in society have become more prevalent than ever in the midst of COVID-19. I think people are also self-reflecting on that. I know I certainly have in isolation and in quarantine. But ultimately, what I saw as an entrepreneur was we did not have effective treatments for mental health and addiction. And the ones that we do have, yes, they work, but they're not really moving the needle. And we needed to create a new paradigm in how we effectively treat mental health and addiction. And I was, also came to this space really out of a personal struggle and a personal journey to get here. I was at the height of my career in Silicon Valley. I was working for companies like Uber. I went through Y Combinator. To the outside world, I was doing great. I was, had a great valuation on a company, good VC backers. But at the end of the day, I was struggling with alcoholism and other drug addictions. And so this was really how I ended up in this space, was because I needed to find a solution. And a friend had mentioned psychedelic medicines could be that solution. And that really did change and impact my life in more ways than one. And I'm sitting here with you today, now the CEO and head of a new biotech company. And we just yesterday reached unicorn status in Canada. And so it's an exciting time, I think, because our mission is extremely powerful and it's needed.
Very cool. Very cool. Well, thank you for sharing that. I know that the conversation around mental health definitely seems to be more in focus now than it has been in the past. It's not something that people feel, well, I shouldn't generalize, but that people feel like they need to sweep under the rug. You've got celebrities like Michael Phelps coming out and talking about his digital therapy app, right? And others like it, right? So the conversation around mental health, although more education is needed, is happening. What about the conversation around psychedelics? And I'll give you something else. I know that there's, something big happened, just about a month ago. In November, we had an election, and the folks in Oregon and Washington, D.C. approved certain therapeutic uses of psychedelics, or at least the Oregon folks did. I think Washington, it was a deprioritization of going after those criminal offenses. So last time you and I spoke together, you made a prediction that psychedelic treatments and therapeutics would be federally legal before cannabis was. And I love that. It wasn't that long ago, just a few months ago here. Then I was like, oh, I don't know, man. Cannabis is on fire. You never know. Kamala Harris just came out and talked about it when she was debating Mike Pence. What's going to happen here? But then the election happened, and we see this happen, and we know how this goes. One market does it, other markets will follow. So what do you have to say to us about what happened in November and what that tells us for these therapies and their adoption moving forward?
I think Oregon, and you're referring to Measure 109, which would, it does legalize the therapeutic use of psychedelics. There's a 2-year moratorium on that in the state of Oregon. But really what I think that vote represents is a bellwether in terms of a will of the people. People are angry. People have been locked up in their homes. They're struggling with anxiety. They're struggling with depression. They're struggling with addiction. And there aren't really great solutions out there. And so when something's on a ballot and it says, hey, we want to address these problems, I think that COVID had a huge impact on that vote, because I think people really did self-reflect on mental illness and addiction. Now, I don't necessarily believe that legalization on a state-by-state basis is the most efficient way that we are going to get psychedelics to the people that need them.
I love that argument.
Country. 11% of Americans in the month of June had considered suicide. That's 1 in 10 of your friends had considered suicide. That's a big problem. And so our approach and those in our industry, we are focused on FDA clinical trials. We want to use science and data to prove to both the FDA and society that these can be safe and effective medicines to treat mental health and addiction. And I think that's really important, not to rely necessarily on a political process, but more to rely on facts and data. And if we can do that, I think we have a much better opportunity to actually see these medicines go into clinics across America, be in patients and help them heal themselves. And I think that's very, very powerful. And so a lot of sort of investors in this space are referring to MindMed, Atai, and Compass as sort of the leaders and the three horsemen. We're all taking this federally regulated approach. And I think that's evidenced in our market caps and valuations. Compass has a very high valuation on the NASDAQ. We're doing quite well as well in Canada and have filed our uplisting application on NASDAQ. So again, the federal drug trials allow for a sustainable business that we think is going to continue to attract institutional capital. I mean, when I got Kevin as an investor, that was a real confidence. When I started getting some of name brand institutional hedge funds investing in our company and into this is key. I mean, this is how you build large sustainable companies that are going to last for a long time. And I think those investors on Wall Street are really seeing that, mental health and addiction, they've been largely ignored industries for many, many years. There needs to be disruption. There needs to be a new paradigm in mental health. And I think we're entering a mental health 2.0.
Yeah, and I was just going to ask you about Kevin, and I know that there are some other big names like Peter Thiel in this industry that have jumped in and started placing some capital, and that's got to be a big boon not only for the individual companies like you guys, but for the industry as a whole. So on the flip side of that, when it comes to the opportunity that exists in this industry, and I say psychedelics, we could say it's biotech with a certain bent towards certain products, but some have called this industry a giant data opportunity. And I wonder what your take on that is, and obviously what you guys are doing at MindMed that might echo that.
Well, I think there's a good quote which says, "Without data, you just have an opinion." And so
I like that.
It's important to have data, right? It's how you represent facts. And our job as a company and as an industry is to conduct clinical trials, gather the data, present it to the FDA, and present it to society that, hey, these can be safe and effective medicines. And so that is exactly what we are doing as an industry and as a company. I think there's also a revolution ongoing right now in digital medicine and digital therapeutics. I think that data can be better used to treat patients. We can understand patient outcomes in new ways that we didn't before. I think it also allows therapists and their patients to interact in new ways. If one could notice that, hey, their anxiety is actually increasing, and we can actually identify a biomarker or at least a way to better measure their anxiety, that's extremely interesting, I think, to a patient. We weigh ourselves every day on a scale and we count our calories. Mental health is as important as your physical health now. And I think, 76% of Americans are now considering their mental health as important as their physical health. That's a big sea change in our approach to life. And so digital therapeutics are going to be a big part of that, I think, coupled with psychedelic medicines. So we're looking at that. We just launched a new digital therapeutics and digital health division called Albert, which is astutely named after the inventor of LSD, Albert Hofmann, who was a chemist at the pharmaceutical company Novartis what predecessor to Novartis in the 1940s. He actually invented LSD on his infamous bicycle ride. But what we want to do with Albert is really marry these two concepts of digital health and measuring your mental health with psychedelic assisted therapy and psychedelic inspired medicines. And I think that's going to create a very powerful new paradigm in how we treat mental health for years to come.
Very cool. Very cool. And when it comes to this market as a whole, I know you're talking about, the path forward, and there's some we can say, some we can't, but, uplisting, things like that. What does this total addressable market look like right now? And in our last couple minutes together, why should investors specifically, and we have thousands of them listening right now, why should they be paying attention to this market and this company?
Well, look, when I first came up with the concept to start a psychedelic biotech company, I was looking at themes that I saw were going to be increasing over time. This was pre-COVID. And what I saw was that AI and automation were going to replace a lot of jobs. And I believe there was a McKinsey report that said up to 800 million people could lose their job by 2030 due to AI and automation. Well, COVID-19 just happened. 63 million Americans are jobless. In the month of October, those were the figures. So what happens when somebody loses their job? Rates of addiction and mental illness go up. This is not good for our country. It's not good for our friends. We need to find innovative solutions to treat these diseases and put them to bed, really. And so if you want to think about the total addressable market, I think you start with 40% of Americans had a mental health incident or some form of an addiction during COVID-19. That's a big.
What's that 40% you said?
40%.
Wow.
40%. So that's our addressable market. There's been estimates that the psychedelic medicine market could be worth upwards of $100 billion by equity analysts. I really genuinely believe that this market is going to get bigger out of COVID-19. I think the biggest single impact that we're going to see is not just to our economy, not just to the many that have passed away from COVID or gotten sick, but what is the impact to this 3 to 10 years from now on our mental health? Addiction just doesn't go away. It percolates. And so, alcoholism, these are going to be larger problems in society. And so a company like ours, we're taking a very long-term outlook on this. Our goal as a company isn't necessarily just to be a psychedelics company. Right now we're in the biotech phase, but we want to now marry this with digital therapeutics and create innovative solutions to mental health and addiction. And I think if we can actually achieve that, we may be creating effectively the Tesla of mental health here. And that it's a bold claim, but I think it's a very strong mission, and it's one that our entire team is focused on healing people.
Listen, JR, last time we met, you gave me a bold prediction, and here's another one: the Tesla of the mental health and addiction space, and digital therapeutics, where they all come together. I think that's a great place to be. It's a great thing to leave our investors with. MMEDF, again, is the ticker symbol. We appreciate having you on, my friend, as always, and I'm sure we'll hear from you soon.
Thank you. Look forward.
All right, take care. Take care, JR. All right. That was pretty darn cool. I got to say, having Kevin O'Leary on, who's invested in a psychedelics company like MindMed, and then to have MindMed say that they're the Tesla of the mental health, digital therapeutics, and addiction space, that is bold claims. Bold claims are us at Benzinga.
bold claims, but to be fair, very well-grounded in reality. Chat is loving it. And it looks like we've got Paul here already. So I'm going to do my disappearing act.
Go for it. Paul Travers, thank you for joining us, sir, the CEO and president and director of Vuzix. VUZI is the ticker, Paul, if I'm not mistaken. And I'll let you dive right in. Oh, remember to unmute yourself.
Yeah, good input there. Thank you.
Okay. Take care.
And we talked a lot to ourselves these days.
Always.
So look, I'm going to just dive in really quickly here, folks. Bear with me just a second.
I think we're still muted here.
Ha ha ha. 1 second, folks. One more time on the share. There we go. Hello, everyone. I'd like to thank you for participating in Vuzix's presentation here at Benzinga today. I'm Paul Travers, of course, the president of Vuzix Corporation, and I'd like to give you a bit of background on Vuzix. First of all, I'm not going to spend a lot of time on this page, just really quickly. Vuzix is a pioneer in wearable computing, and if you follow the space at all, if you follow computing, you'll realize that this world changes and it changes fast. And over the years, it's gone from great big rooms of technology and computers built into them to today, the smartphone, something that's easy to carry around and put in your hand. That technology is about ready to evolve again, and it's wearable computing that's coming next in the form of virtual and augmented reality systems. That's where Vuzix plays. Our business is doing really well today. It's growing year over year at an amazing pace, and each quarter is getting stronger at the same time. We're capitalized well with about $25 million in the bank, and it's nothing but execution now for Vuzix. It's an exciting time to be in this industry, and this story is about that. The next big trend in technology, as I said, is smart glasses that we wear everywhere. And Markets just put out a newest report. You can find a lot of these out there. Everybody is predicting that this industry is going to go through the roof. Well, if you think about the future of computing, it would be. There are billions of smartphones sold on a quarterly basis. Glasses coming out that replace your smartphone is going to be game changing. And I realize not everybody will do this, but the use cases around augmented reality and these kinds of glasses are through the roof, which is why it's projected by most to be $70 to $100 billion industry by 2025. And AR smart glasses are the form factor that are being predicted the most to win in this industry. Right now, it's happening first in enterprise, and in enterprise specifically around the healthcare markets. We also see it in manufacturing and in warehousing and the likes, but healthcare is really driving things a lot right now, and a lot of it was an impetus due to COVID, which I'll describe a little bit more in a minute. For Vuzix, we have a series of products that we've developed specifically for the enterprise marketplace, but we've been working on the technology for the future of these glasses that are going to be sexy, that are going to look like the Kingsman style sunglasses or glasses in the movie The Kingsman, and not easy to get to, but for Vuzix it's not that far away. First, our M series products, the M400 and the M4000. These guys are flagships. They're super fast, 8-core processors running with the best of the best. You wear them on the side of your temple, which I'll show you in just a few moments, and they allow you to connect people from around the world and digital content to the real world in real time. We've also got a Blade upgraded that just started shipping here in the end of the third quarter, going into the fourth quarter, which looks a lot strikingly like a pair of regular sunglasses. And where we're going in 2021, you can see here, these things are going to look just like glasses you'd buy out of an Oakley store. Why are people using them? It's simple. These are just some really quick examples. You get increased productivity with the glasses. It eliminates travel costs, and this is becoming a big deal. Hard to prove a year ago when COVID wasn't around, but COVID is forcing people not to travel, and they're finding out that just sending a pair of glasses solves the problem. It literally is going to save people hundreds of millions of dollars annually in travel costs. It improves worker safety because your hands and eyes aren't on a phone looking down or a tablet. It lowers your carbon footprint, obviously, reduces worker errors, protects worker health. There's a list of ROIs for using glasses in the enterprise markets. The verticals that are driving our business the most right now, telemedicine is probably the biggest one, but field service for remote support, remote training, remote quality operations, et cetera. These things are really driving Vuzix's business today. Manufacturing, warehousing, and logistics, these are going to be big business opportunities for Vuzix. We have a lot of pilots that are in place in those spaces. Unfortunately, COVID has put many of them on hold. COVID's going to go away next year, and when that happens, these other pieces of business are going to take off. When COVID goes away next year, people aren't going to get back on airplanes. The new normal is for people working at home, and that is what Vuzix's smart glasses enable most today. COVID has accelerated industry adoption of our glasses in many areas. People are staying home, they're not getting on airplanes. You can send a pair of glasses to solve this problem from medical applications right on through to just quality on the plant floor in China and not being able to get there. These are ideal for use in healthcare and telemedicine. They're lightweight. You can see this person's wearing them. They're only 2.8 ounces. They're flexible in that you can move the eyepiece up and down, point it in any direction that you want to. So maybe you're performing an operation, you're looking down, instead of having it stuck up here in the corner on your right of your eye, like some of our competitors, literally it's pointed comfortably down at the work surface. They're IP67 rated, so they can be cleaned and sanitized using conventional methods. The other thing is they're designed for remote work. We have connectors for Skype, Zoom, WebEx. You hook these applications into the glasses and they can join any one of those meetings today and many others. We have also partners that do and build specifically remote support software that allows telestrace and reaching in and drawing on the screen, etc. They're enabling healthcare professionals around the world. Organizations like Johns Hopkins, UCLA, today the University of Rochester Medical Center. Basically, if there's a place where people need help, it's related to COVID, instead of having people visit, causing the potential spread of the virus, they're sending the glasses in and using them. And in fact, they're being used by a list of growing companies today. It's amazing to me, just since the beginning of this year, how many medical organizations are using these glasses today. And why are they using them? They're using them for virtual rounds. Why send 35 doctors walking through a hospital when you can have one person walk through with the glasses on and remotely be part of that walkthrough? Patient intubations, professional training, long-term care, emergency departments, surgeries and ICUs. We have doctors today that are using our glasses with Pixie Medical even for knee surgery. In the United States alone, there are 600,000 knee surgeries a year. And they use our glasses, as you can see in this picture here in the bottom left, that looks at those markers in space. It aligns the knee so that it knows that it's correct, and then it puts the pins, it allows the doctor to put in the pins in the knee. It's an amazing pile of use cases throughout medical that are starting to use these smart glasses. They're hands-free and they allow you to easily share what you're doing and or get help while you're trying to do something. That same theme holds true for across industry. Companies like Clorox today, as an example, are doing remote fiscal audits, remote maintenance and troubleshooting. They're supporting some of their strategic goals using the glasses with work instructions and the like. It's basically around the world, if you have jobs that need to get done that require remote help, these glasses are perfect for it. Another example here, just really quickly, we're working with partners like Verizon. As you all know, they have this new 5G system that they're coming out with for cellular communications. They have a first responder program that they're putting in place in the new year that basically will put 5G support in an emergency truck. The EMT will then put our glasses on, and it'll allow a doctor at the hospital to see in real time what the EMT is doing and support that EMT to make sure that the patient's getting the support that he needs before he gets to the hospital. Minutes can mean everything in these kinds of situations. And this is an example of a video here that gives a bit of a feel for how that might work.
Introducing Vuzix M400 smart glasses. Hands-free, virus-free. For COVID-19 and beyond. The safest, most effective way to deliver remote medical support hands-free. Protecting patients and healthcare workers. receiving life-saving support remotely, streaming first-person point of view to off-site specialists. Vuzix M400 smart glasses, the safe solution, hands-free.
The M4000, this is our next generation partner that works with the M400. It's 100% software compatible with the 400, but with this guy, it's optically see-through. And the information that you see literally floats out in front of you. So with this, you can more easily be in the real world and have the digital information that's connected to the real world float and be part of the real world at the same time. So it's not picture in picture, it's literally overlaid on the real world. This is going to be game changing, and it's one of the first products that uses Vuzix's waveguide optics. You can see here that window that gentleman's looking through, and I'll describe a little bit more about that in just a minute. The Blade Upgraded is another version of our products that uses waveguides. This guy has a waveguide in the right eye, and we just started shipping a new version of it now with autofocus cameras and built-in stereo speakers. This was really needed for the product to be able to be used better in the enterprise markets. With this guy out there now, it's being used in a lot of different applications, from first security, first responders, and pharma. They're practically normal looking glasses. They got a little bit of a ways to go, but they're highly functional when it comes to providing information for users. And what I'd like to do here now is just give you a couple of examples of some of the partners that we're working with in Europe, like BMW, that plan on using our Blade and some of our next generation glasses. Because Vuzix builds these waveguides here in Rochester, New York, we've developed a lot of intellectual property around it. And it's here in Rochester. We design, manufacture everything to make these optical systems work. We've started an OEM group at the company that will supply these waveguide optics and display engines into third-party products. These are non-recurring engineering programs. In other words, we get dollars up front to do the programs, and ultimately the goal is to roll these out into production programs. We have a series of customers already. It's hard to describe all of them. We've not made public all of them, but to get a bit of a feel for it, you can see there's several defense partners that we're working with today. There's some people on the medical side, and we're very close in negotiations with volume production supply agreements. It's an exciting time for Vuzix. This business could literally be in the hundreds of millions of dollars worth of revenues for Vuzix as these products, these next generation products, come to market. Vuzix is in a great spot. Our technology in enterprise is leading the space. But for this industry to really take off, these glasses have to look like something people would want to wear all day long. And that's the technology Vuzix has been working on for quite some time now. We have approximately 180 patents and patents pending, and just over the last 3 years, 90 more patents have been filed. The next generation technology that we're coming out with is based upon our advanced waveguides and these ultra miniature micro LED display engines that Vuzix is working on. These display engines are literally 1/10 the size of what's available in the marketplace today. It's game changing on a power consumption perspective either, a fraction of the power to drive these displays versus what's in the marketplace today. You put this technology together, and next year, before the end of the year, Vuzix will be shipping glasses that look like the Kingsman glasses in the movie The Kingsman. If you haven't seen it, I highly recommend you check it out. This is where Vuzix is going, and I think this video shows it pretty well.
Introducing Vuzix, next generation smart glasses technology. A sleek exterior leads to a tech-rich interior, delivering style and substance with a trendy, comfortable design, combining easy wearability with even greater utility for an enhanced connected mobile experience with fully wireless connectivity. They're made even more dynamic with the added dimension of their ultra-slim, single-layer, see-through binocular waveguides. Powered by a pair of tiny, highly efficient micro LED projectors. They generate crisp video into the advanced waveguide optics that are viewable indoors and out for heads-up contextual information. Both monochrome and full-color RGB HD+ solutions are in development. And at 1 micron in size, the micro LEDs have one of the highest density pixel arrays available. From sight, we move to sound, with multiple noise-canceling microphones for flawless phone calls and voice UI integration. Forget your uncomfortable earbuds. With acoustic chambers fully integrated into the frames, we deliver clear stereo targeted over the ears for privacy without losing ambient sound around the wearer. Enhancing hands-free operation, the onboard processor wirelessly communicates with your phone. Use your voice or tap on the touch-sensitive arm to activate the displays, allowing discreet connectivity to the world. And with longer-lasting battery life, the glasses are ready when you are. Style and substance never looked this smart.
It's a great time to be Vuzix. Revenues are ramping. An average of 1.2 million a quarter in revenue is what it used to be at Vuzix. October alone beat that number. November has been a good month for Vuzix also. We've also got a pile of engineering programs that are going to add into revenues here into the fourth quarter. And right now it looks like December's off to a good start too. So business is really good at Vuzix. It's accelerating, growing. Smart glasses are the future of the computing industry. Vuzix is leading in it. We've got the technology for the future. Demand continues to be largely broad-based and not dependent on any one project, customer, or geography. That said, we have larger and expanding deployments that are happening from existing companies and new that are underway. Finally, the OEM opportunities, as I said earlier, for Vuzix could be in the hundreds of millions of dollars, and it's really also accelerating nicely for the company. Again, thank you very much and have a great day.
Wow. My glasses are so stupid compared to what we just saw. Guys, that's ticker VUZI. Make sure you check them out, follow them, add them to your watch list, and look at that contact info. We just lost the contact info, but make sure you're hopping into Brella. And if you want more information, you can reach out to it. Looks like Ed_McGregor at Vuzix.com. Great opportunity for access to learn more about what might be a big opportunity for growth. I don't want to talk anymore because up next, we've got one of the biggest and most popular mobile brokerage applications with a ton of features crammed into a tiny, really friendly user interface. Webull. Speaking with us today is Anthony Denier, the CEO of Webull Financial. Anthony, how's it going?
Hey, Neil. Glad to be here.
It's great to have you, my man. I am going to get out of your way, let you do your thing, and then come back in and maybe we'll do some Q&A. How does that sound?
Yeah, that sounds good. That'd be awesome.
Perfecto. All right, man. Do your thing.
Okay, cool. Well, I mean, that was a very cool presentation that I'm following. But being, sorry, I should start. My name is Anthony Denier. I am the CEO of Webull Financial. You may or may not know, Webull is an app-based brokerage that allows our users and our clients to trade for free, right? No commission, no platform fees, no monthly minimums. And we differentiate ourselves in many different ways that I will get to. But before I do, I did want to take a moment to thank the Benzinga team for putting this conference together. It's real exciting stuff that's going through, and it's great to see a platform where some of the smaller companies can get some recognition and show off what makes them so cool and so unique and change the landscape, just like we also try to do at Webull. So thank you to Benzinga. Very proud to be a sponsor of this event. I guess I'll touch on Webull first, because there's still many people out there, even people that are interested in the markets and that look at different stocks, options, cryptos, that have never heard of us, and that's fine. We're pretty young, and we're very proud that we've been one of the big disruptors of the industry. That's kind of changed the whole landscape. You know, we only go back not even, that's about a year ago now, where everyone was paying commission to get access to capital markets, right? And whether it was, $1.99 a trade, $4.99 a trade, it's, regardless of the actual price, there was always that barrier that lived there. And one of the things that we kind of pioneered at Webull, along with some other of our peers, was to change the landscape of getting access to the U.S. capital markets by having a zero commission philosophy. So Webull is approximately 2.5 years old. We launched in May of 2018. When we launched, there was, the zero commission space was very different than it was now, obviously. There were only a few players operating in the space. And at the time, there really was a lot of kind of, I would say, naysayers in the whole idea of zero commission, because if you're not paying the toll to get access to the market, then you must be paying the toll hidden somewhere else. And that was the general consensus. And, we worked very, very hard to flip that on its head and to say, no, that's actually not the case, right? I've been in this industry. I've been a professional trader for over 20 years. And I know there's many different ways of creating revenue from a customer's account other than charging them a commission every time they trade. Well, it took about 1.5 years for the whole world to kind of see that light as well. And back about a year ago, as I mentioned, the whole world, at least in the US, the whole investing world, online brokers to be exact, all went to zero commission back in October of 2019. And that was a really amazing moment for us at Webull, and actually some of our competitors and our peers in the space, where it was a total vindication of what we had been saying, right, for the 2 years prior to that. It's, this model can exist. We can provide best quality execution. We can provide really powerful tools, and we can provide access to everyone, regardless of their account size, without charging them a commission. And unfortunately, the business has been kind of held in this manner where the current, the brokerages that existed before Webull and some of our peers were only concentrated and only really cared about accounts with $25,000, $50,000 in their account, which to me was a total shame. There's no reason for that. Webull's vision has always been to give everyone equal opportunity in the markets, right? So you should have all the most powerful analytical tools, the best charting suites, access to all the types of market data that go in to, what makes an intraday move happen, what makes a long-term, what a cup and handle means on your chart patterns. Just because someone has a $50 account versus someone with a $50,000 account certainly does not make that person on the lower end less intelligent or less able to see the trends happening. And that was our goal from day one: provide all the most powerful tools we can to all our users, and do it so in a mobile device, right? That is the key for us. That's where we believe the future really lies. In all things mobile. And I'm sure, a lot of the presentations you're seeing on this small cap conference agree with that statement. No one enjoys standing or logging in their computer anymore, typing in a website address. If it's not accessible to your fingertips when you want it, whenever you want it, it's almost moot at this point. So we've been very, very fortunate with our growth over the last 2.5 years. We've started to get some pretty good recognition, especially over the last 6 months. I think all brokerages, it's no secret, had a nice tailwind with COVID. There was a lot of people that just had extra time on their hands because they no longer had to commute or drop the kids off at sports every day. And they found themselves, idle time makes someone want to be busy. And if you've always been just kind of putting it to the side, yeah, I'll open up a brokerage account someday. Yeah, it's something I'm meaning to do, or I really need to get my finances in check. Obviously, with interest rates near zero, I'm only losing money with it sitting in my checking or my savings account. There's really something I should be doing with that money. Well, the pandemic gave a lot of people the perfect opportunity to do that, right? With that little extra time that you had every day, you can now take the time to do some research on some stocks you wanted to buy, right? Or even if it was a little more passive and you just wanted to buy some index funds or some broad-based ETFs to get some sector exposure. You then had to look at, okay, what brokerage am I going to use? Am I going to use a traditional online broker where even now it's zero commission, but they don't really fit my style of investing, right? I mean, if I have an idea, or I'm in my backyard, playing with my kids, or gardening, or doing whatever I do, I want to have the ability to pull something out and make a choice, do some quick searching right through my device and pull the trigger when I need to. And we've been really, really fortunate to ride the tailwind of that growth, especially over the last 9 months or so. So I'm very, very proud to be here today to present to all you guys, to kind of give you a background on what Webull is, what we offer, and what our strongest points are, and how hopefully if you guys decide to do your research, look at all the options out there, you'll have a little more educated information on what Webull actually is. So let's go into some of the products that we offer. When we first started, we started out very simple. We started with a equity platform. So you were able to trade US listed equities only. And I want to be clear with that, with listed, right? So obviously it has to trade on either, one of the major exchanges in the US. If it does not, it's what's considered OTC. We do not support OTC at this moment. That's something I'll get into a little bit later about OTC. But there's specific reasons for that, especially when we launched. And when we were built, a lot of our thoughts and our direction and how we built the app was built around a lot of customer protection. You may have read, or you may have seen in our space, the tendency, especially with zero commission now, is to get people and to incentivize customers to actually trade more. Some call it gamifying the experience. That's something that we specifically stayed away from. A lot of OTC names, if it's not a big international ADR type OTC name, most likely the reason why it is OTC is because that stock cannot comply with the rigorous requirements set forth by the national exchanges in the US. And that's providing, GAAP accountings on a quarterly basis. They have to be audited financials. So make sure that this company is legitimate. They're not, faking any sort of revenues or faking any new sort of product introductions. Without, proper research and not having a proper network, it's hard to discern that just through news wires and just through what you see on the web. So we decided to stay away from that when we first launched, to protect our users. We then eventually went into getting more advanced in our equities offering. So we've always been known for our strong charting, analytics, and in-depth market data that we provide on the app. But we took it a step further, right? Instead of just simply having, market order, limit order to buy, we started bringing out advanced order types, right? So where if you're a quick sort of intraday trader and you wanted to place a buy order, we allow you to put bracket orders out there. And if you aren't familiar, bracket orders simply, when you place a buy order, you, at the same exact time that buy order goes out, you will be putting out a take profit order, which is a limit order higher than where you bought it, and also a stop loss order, which is an order to sell that position. If it starts dropping and you're losing money, you immediately get out of the position and you stop that loss. It's a really good feature, especially for a newer investor that's getting involved in very volatile names and doesn't have the ability to stare at their portfolio all day, every day. It's a little bit of protection on both sides, where you can take your profits when it happens, even if you're not looking, and you can also get out of position if it starts getting too red in your account. That's just breaking the ice on what we offer. We then brought it into OCO, one cancels the other. OCOTO orders, which is one cancels and one triggers the other. I can go in depth on these different trading features, but not to bore anyone, and I only have a set amount of time, I'll just mention them. We then, due to customer demand, wanted to roll out our next product, and that was stock options. And we were lucky enough to get that product out in March of this year. So it is a relatively new product for us, but it is definitely quickly becoming one of the most popular. Options offer our users the ability to get extra leverage in position. So if you have the you have the mind that a stock is going to pop because of earnings, instead of just buying the whole equity and utilizing a significant portion of the assets in your portfolio, you can buy a call that maybe has a short time horizon, so it's somewhat cheaper, to maximize all those gains on that, on that expected pop after an earnings report. And again, giving the environment we're in with COVID, with people having more time on their hands, and to be honest, with the lack of other venues for for people to get involved in sort of speculation, i.e., DraftKings, right? Other types of sports books. The options market became very, very popular over the pandemic. We are working on multi-leg options, which is a bit more sophisticated and more towards our more active and experienced type of user. And we are currently in beta testing of that. We have about 3,000 Webull customers currently utilizing our multi-leg strategies. And we will probably, expecting all continues to go really, really well, we will roll that out probably in the next couple months. So that's something we're excited to get going. I talk about different ways to leverage with options. One thing that separates Webull from our competitors, especially our mobile-based competitors, is that we operate much more like a traditional brokerage in the sense that if you qualify, meaning if you have $2,000 or more in your margin account, you actually qualify for leverage automatically, right? It's called Reg T. It is a rule that's been in place for many, many years for all US brokerages. But a lot of our competitors and a lot of the newer app-based brokerages either completely shy away from that aspect of the business, or if they allow it, they actually charge some sort of fee to gain access to any type of leverage. And once they do, they actually limit that leverage pretty much just to 2x. That leverage for intraday traders, meaning day traders on Webull, is good for 4x. So you can utilize 4 times leverage on equity purchases as long as the actual equity itself qualifies for leverage. Usually a qualifying equity has to be above $5 at a minimum and has some limited volatility in its range. So as an example, you're probably not going to get 4-time leverage on one of the cannabis or one of the very volatile cannabis stocks, but you will get a 4x leverage on a stock like an Apple, to give sort of an example there. Another thing we're very, very proud about, again, to give access to all the features of a brokerage where a lot of brokerage houses decide to actually not give access to all the features to their users unless they surpass some sort of AUM in their account, or they pay some sort of monthly platform fee or monthly access fee to a premium program, whether they call it Gold or Pro or Premium. Now, I was talking with actually the CEO of Benzinga, Jason, not too long ago on a podcast he has called The Raz Report. If you haven't seen it, it's pretty fun. About our launch. We had this conversation, I think about a week or so before Thanksgiving of this year, talking about our launch of crypto. So, I am proud to say again on Benzinga's platform that we've launched our crypto trading on Webull. So everyone with an account, with an equity account at Webull Financial, has the ability to open an account with our sister company, Webull Crypto. Doing so, they will get access to trade. Right now, we're only, November 19th was the launch date, so we're only 2.5 weeks in. We have over in the last 2.5 weeks, we've opened more than 150,000 crypto trading accounts, which is a pretty cool number, given that it's such a new product for us, right? Clearly the demand is there. I know this is not a crypto conference, so I don't want to talk too much on it, but hey, you're in an environment of low interest rates, high inflation, continual Fed backstop. Why not look to another asset other than gold to hedge your portfolio, right? Like I mentioned earlier, keeping your money keeping cash under your mattress in your checking account or your savings account, you're basically losing more than 2% a year just on inflation alone. So it's really all we're really psyched to have a totally new asset class be available to all our users, and we're even more excited of the take up of that new product and seeing our customers getting excited and trading it on our platform at Webull. We currently only have 4 cryptocurrencies. Again, we start very slow. We start for safety. We make sure our product is reliable, is consistent. In a world of high volumes and in a world of outages across networks, we always make sure that we take baby steps along the way. So, when we scale and we go big, we can handle the volume that comes in. Another thing I think that's really separates Webull from a lot of our competitors, and a lot of that has to do, with our pedigree of of being a true technology company merging directly with, the brokerage. I'm a fintech CEO. I'm sitting here in a suit. I wear suits. I am a Wall Street guy. I've been doing this for a long time. My expertise is in compliance, is in customer protection, is in making sure that customers are always safe, and whether it be their ability to get out of a position. What happens if you're long a call option and you're on the road somewhere and your phone breaks, or you don't have any data connection. How are you going to get out of that position if you need to? Well, sending an email is not going to suffice, right? Which is why from day one, Webull has always had a telephone number for customers to call in directly on our website. And again, another thing we're extremely proud of. This is from day one. We've had this call line. It operates every single trading day from 9 a.m. to 4:15 p.m. Eastern. And if customers have a problem, they can actually speak to a human here. I'm in my New York office right now. They can talk to one of us here. We have a lot of people that are working remotely, obvious reasons, but they will get someone on the line. So let's talk about future and what we're seeing at Webull in the future. I think fractional shares come up probably the most. And, that is something that I think a lot of brokerages have shied away from in the past, not only for the operational processes in terms of volume and manpower that you need to hire to accommodate that intense volume coming in. I mean, it's one thing to trade one share of Apple at a few $100s a share. It's another thing to trade a few $100s of Apple that are a couple hundred tickets, right? A couple hundred individual trades. It just puts a lot of strain on the system. But like I mentioned, we work slowly so we can build up and offer these types of products. And fractional trading is something that we're certainly going to be offering very, very soon to our customers. We're very, very excited about that. I had mentioned earlier in the year before the pandemic that we hope to have this by the end of 2020. Our timeline has changed a little bit. We had some obvious slowdowns and loss of productivity, obviously, and a huge gain of activity on the platform. So it's going to push that date back a little bit into early 21, but it certainly still is on the calendar. We also talk about, not everyone is an active investor. Not everyone wants to look at their portfolio, every couple of minutes of every day. I mean, we're all busy. We all have busy lives, and sometimes managing your own portfolio or being completely on top of your own portfolio is sometimes difficult to do. So having some sort of passive option on Webull with a robo advisor or passive investing option on Webull has always been on our sites as well. And that's something hopefully that we can talk more about as we get closer to it towards the middle of 21. And then we have the obvious ones, different products, right? So futures products, whether they be, FX, commodities, or index futures. We already have a Webull futures entity built. We already have the approval by the NFA, which is a National Futures Association, to do that business. It's just a matter of time to put the right pieces in place and make sure our customers are ready to handle that new product, something we're excited to bring out in 2021 as well. So, a lot of exciting things going on for us in Webull. We would love to continue our growth, which has been intense over the past 9 months for sure, but over the 2.5 years consistently, something we're very, very proud of. We're super excited to provide a better platform and a better product for our users and our customers. And again, I'm personally very excited to be here and speak to you guys at this conference and working with Benzinga since day one, mind you. Benzinga has been a very good partner of ours. Looking forward to continue that relationship and building on it. So, we have about 15 minutes or so left. I wanted to open it up if anyone had any specific questions about, what we do at Webull, what differentiates us at Webull from some of our competitors, or any general questions about what we do. I'm all open. You got me for 15.
All right. Anthony, really quick, I just want to say, I didn't know about some of your future plans for passive investing or automation around that, the sort of the robo-advisor tools. The fractional shares was a big question. Like you said, you're already getting that question a lot. Big question in chat, guys. So fractional shares are coming, slightly delayed, obviously, by how crazy 2020 has been for every company. Guys, so like I mentioned, you guys had a lot of questions. I want you to put them right back in chat again to make it a lot easier for us so we don't have to scroll all the way up. So one question that keeps coming up is regional. Canada, are you going to become available in Canada?
Yeah, no, I can appreciate that. I've had a lot of conversations with our neighbors up north about this. So the short answer is probably not for the next year. That's the short answer. And there's a couple different factors to that. And trust me, we have a lot of users in Canada. We have a lot of fans in Canada, and we are very aware of that. However, as you know, Canada has a much smaller community of brokers, and opening up their community to outsiders, i.e. Webull, Robinhood, we can extend that, is a little threatening to their model. And therefore it's difficult to get access to that market. It really is. There's a lot of hoops that we have to go through. It can be done, but it does have to go through the proper channels, and we are navigating those channels as we speak, but it will be drawn out quite a little bit.
Okay. And in public, so we got a couple people asking what the Webull ticker was. Do you have plans to go public at any point?
Well, we do not have plans immediately to go public. However, it has always been our goal to be a publicly traded company. If I were to give you a target date, that would probably be, too much speculation for me to handle, because it's hard to live up to that. There's so many things that can happen in the next couple of years. But the interest is there, and that's something that we definitely aspire to do. I actually had the pleasure of ringing the closing bell right before the pandemic. I believe it was about a year ago, last December. And one of the things I said, when you go up there, you give like a little speech to everyone, especially your teammates and your everyone that's your partners. And one of the things I specifically remember mentioning was, we're here ringing the closing bell now. In a couple of years, we're going to be ringing the opening bell for our IPO. So definitely on the schedule.
Excellent. Okay, so I have some questions myself. One, actually, let's get one here for Larry E. Are you a direct access broker?
So we do not offer direct access to our customers, and we have specific reasons for that. So as it stands now, the only way that you can enter an order on Webull is actually through a Webull platform, whether that be through the mobile app, the desktop, or the web access. I do know of actually some platforms out there, some trading platforms that claim to have access to Webull, where you can actually trade through your Webull account. You can get market data through your Webull account. That is 100% false. That is false advertising. We've sent quite a few cease and desist letters out to those companies that do that. And the main reason, I'm not just going to, I will give you a reason, because there is a legitimate reason behind it, is that our revenue is built on one thing, payment for, multiple things, but our major thing, payment for order flow, right? Being able to lend out your stock, charging you interest on any leverage you take in your account. We don't charge commission, we don't charge platform fees, right? So all the revenue that we make is pretty much behind the scenes, where the customer doesn't even know what's going on until actually they get their dividend check from the stock they loaned out to a short seller. But when you start opening up DMA access to traders that you cannot follow, right? It opens up to possible collusion, right? With terms of fraud, especially when we're talking about small caps. When the volumes are very low, we see a lot of wash trading, we see a lot of spoofing, and we see a lot of ramping up, especially into certain windows of month end, quarter end, that sort of stuff, which is obviously very, very bad for our other customers that aren't involved in the plot, and bad for us as a reputational risk. And then on the other side of that, the execution partners that we partner with for that payment for order flow, that we get revenue from, they do not want that flow as well, because they do not know that that's retail flow. It could actually be institutional flow. It could be someone at a hedge fund trading through a platform using a Webull account that's pretending to be retail. So it really skews the mix of what's called toxic flow and true retail flow. And it's not very good for our business model. Sorry if I went a little too deep into that, but there's a legitimate reason for that. It's not just that we just don't do it or choose not to do it. It's a specific reasoning behind it.
Yeah, no worries. I think that begged a thorough explanation. So that was good. Okay, so let's talk about crypto. Are you providing a hard wallet where one can own the cryptocurrency and then transfer it to another wallet or use it as payment or something like that? Or is this a pure speculation function?
Yeah, so as it stands right now, our crypto offering is simply a mechanism so customers can get exposure to crypto in their portfolio. In no way can a customer move that coin out, even if they owned a full Bitcoin. They cannot move that out to go buy their Audi, right? Or go put it in some fancy vending machine in Saudi Arabia, right? There's many reasons behind that. Is because digital currency, as everyone knows, is completely anonymous. And as a broker dealer, we are required to do proper KYC and anti-money laundering or AML checks on all funds that flow in and out of our customer accounts. And if we allow customers to bring digital currency into their account, and even worse, out of their account, we cannot control where that money came from, where it's going. And it's a huge AML risk for us as a broker. So you'll see that across the board. Any brokerage firm that has ties to the SEC or any regulator will not allow crypto to flow in and out of their accounts. So again, that stays in our wallet. It's not under your own wallet. And if you want to move your position in Bitcoin or Ethereum out, you're going to have to sell it into fiat currency and then move it out the traditional ACH or wire method.
Makes sense. Okay, so let's see. Let's talk about the technical tools that you have. So I know that you've got some of the best charting on any mobile brokerage, period. That's coming from my own experience. What kind of stuff do you have available there in terms of like studies or functions like things like moving average, MACD, RSI? Could you give people an idea of what sort of technical analysis goodies you have on the platform?
Yeah, I can mention a lot of acronyms. I think as it stands right now, we have 42. I mean, we're updating it constantly. We have 42 different indicators that you can add to your chart just on your mobile device alone. Going from a MACD, Bollinger Band, Fibonacci sequence, RSI indicators, obviously VWAP, right? That's, it's an old school one. The list is extremely, extremely deep. We're constantly adding to it as, customers recommend ones. We do a little research, say, oh, that's pretty cool, we'll add that. And we also utilize, or we're actually getting heavily into bringing some third-party tools into our platform. I know we've had some conversations with Benzinga, right? Plug. But we also partnered most recently with a company called Trading Central that'll bring in your portfolio, will bring like a snapshot analysis of whatever you hold in your portfolio. And that's going to be released on our next update in about a week or so's time on the app. So always adding cool new features for analysis. Again, we want you to be able to pull out your phone or pull up your account and have an idea of what's going on, then also have that optionality of, I want to get deep in the weeds in that as well, right? And going deep. And that's one of the great things about Webull with our community, right? With our in-depth stuff where, you can kind of, I do it all the time, I'm guilty. Like you sit down, you start looking into a stock, and next thing you know exactly what the management, all the short interest in the name, what they've been selling. You're just going deep on all this, company information that you wouldn't do on any other app, right? Which is really kind of, one of the things that makes us stand out.
And on that topic, you make paper trading really easy. Do you have paper trading options for options, or is that something that you're thinking about doing?
Yeah, it is very difficult to bring paper trading for options, obviously because of the illiquidity of so many options, right? So, we have a lot of conversations internally. Paper trading is very popular for us, especially for a lot of newer and more or less experienced traders, so they can kind of get a feel for how everything works. They can get used to the platform. Obviously, they can get used to their market. They get used to like here's my thesis on, on looking at candlestick charts. Let me try it in paper trading to see if I can make money over the course of the week before I throw in, $1,000 and try it on my own. Really useful for a lot of people. And options, we would love to offer that. We do not offer it yet for paper trading because the universe has to be very finite. There's so many different stock options that trade, but they're so illiquid and there's so little activity that there may be, a bid ask on an option. And if you actually took that ask, it may move the price $1, $1.50 because there's so little activity. But obviously paper trading doesn't truly execute, so you would never see that. Right. So it's a very unrealistic paper trading experience. And, like we do with all things, we want to make sure that our experience is as close to the real thing as possible. So it's something we'll be releasing soon.
Okay. Yeah. And that makes complete sense. All right, guys, more questions. We've got a little bit of time left here with Anthony. You're not going to get many opportunities to talk to the CEO of Webull. So hit me with some additional questions. In the meantime, I just have a couple of my own for you, Anthony. So we know that 2020 has been a watershed year for folks entering the markets. You mentioned yourself that activity has gone up quite a bit on the platform. How, with all of these folks coming in, how have consumers or retail traders changed in behavior, demographically? What are you seeing?
Well, I don't want to speak down upon some of the behaviors that have come up, but there is a bit more herd mentality now than we've ever seen in the retail space. Everyone is. I feel that the retail trader now gets more upset if they miss an opportunity to profit than if they actually take a loss, right? And that's the wrong way to think as a trader, right? A missed opportunity is fine. Having actually that realized loss is the problem, right? Two realized loss, two missed opportunities, you're fine, right? Two missed losses, two losses realized, and you're out of the market, right? So we see that a lot now. We see that, if one name becomes popular, a lot of people dive in. We look at some of the trading analysis we do on some of the names that are most popular on Webull. We put out lists all the time in our community, right? 10 most popular equities traded today, 10 most popular options traded today. And if you look at that list, you'll see that, like, if there was news out in a specific name, like a great example is like a Kodak a while ago would be an ideal example for that scenario. There were people trading Kodak that had no idea that they were buying Kodak. They just knew the symbol, right? Or a Palantir is another one, right? PLNTR. A lot of our users, you'll find, they actually don't know what the company does. They don't even know the full name of the company. They just know the symbol because they heard someone talking about it on a Discord group, right? And they just look at the chart and they see it go up and they jump in. That could be problematic down the road. I think, we've been blessed with having a very strong, a strong market, to say the least, this year. And probably more importantly, a very accommodative federal policy and FOMC policy.
Indeed. And, Chad, I'm sure that none of you have partaken in any of these meme trades, as CRC has called them. So some great points brought up there, Anthony. What about, and this is getting back down to specifics and functionality. Do you have alert systems, like price alerts and that kind of thing?
Oh yeah, to be honest, if I went through everything, I probably would, run out of breath in terms of the features that are on Webull. In terms of, stock screeners, right? And especially we're at a small cap conference, that works really, really well for looking for specific small cap names at a certain price range in a specific sector, right? With a specific revenue range. You could go very, very deep into our stock screener suite of products. We have alerts that you can create for a lot of different scenarios, right? Price alerts are the obvious ones, but volatility alerts, right? If it goes up, down a certain percent rather than, points. You can look at, volume alerts you can add to your portfolio. If a name suddenly gets popular, where you've been watching a name, even a name maybe that presented at this conference, and the volume has been very light, then all of a sudden you put a volume alert on that stock, and you see the volumes automatically popped. That's an opportunity to look at it, right? You're going to get the heads up, the little ding on your phone. You get into the account, and you see, hey, this is what I've been waiting for, right? The people have finally heard. So we utilize a lot of those tools on our platform.
That's great. And guys, I have a little recommendation based on that. Why don't you guys click the link in the chat, try out Webull, and add all of the awesome small cap companies that we have here today and set some alerts. I mean, I'm sure that a couple of them we've seen a couple of the companies that we've had here yesterday at least move. So definitely a great way to get your feet wet with Webull, and I highly recommend using it because there just aren't other tools that are so easy to use with so many tools available for you. So I got another specific question, and I think this is maybe we have time for like 2 more questions, and I'll let you have the last word there, Anthony.
Sure.
Do you offer dividend reinvestment in stocks?
So currently, we do not offer DRIP programs or dividend reinvestment. Yep. The reason why is because we currently do not offer fractionals. So if you got a dividend for, as an example, yep. And Apple gives out a dividend, you would have to own actually a fractional share of Apple. And liquidating that position would be more than complicated. You'd actually have to take the time to write in a message to us to liquidate it for you. That's not very good on a customer experience sort of level. So until we have fractionals, we're staying away from drips.
Makes perfect sense. Okay, and we're at about 1 minute. So guys, that's all we have time for questions. There are a lot of resources online. Webull is not a small platform. There's plenty out there for you to research on, dig your teeth into. Anthony, I want to leave you with the last word. What do you think is the most exciting thing happening for Webull over 2021?
Right. So there's so many exciting things happening for Webull right now. Going into next year, we will be expanding in many different ways. So Webull, as I started this conversation, most likely is probably unknown to you. You may have never heard of Webull before. But our goal for 2021 is to make sure that you've heard of Webull. So we're going to have some pretty cool commercials that will be hitting the air. Obviously, we're going to be doing a lot more events like this to get our name out there. And just the overall kind of experience of Webull having the products that we're adding, whether they be fractional, whether they be robo advising, whether they be futures products, it will be the platform that everyone wants to go to on a mobile device to trade, and get access and build a proper portfolio with proper tools, regardless of your account size, regardless of your experience in the markets. 2021 will be a very exciting year for us.
Love it. You guys will be hearing a lot more from Webull over the next year. Anthony, thank you so much for spending so much time with us and answering all of our questions. It's been a great session, man.
Thank you, Neil, and thank you, Benzinga, and everyone have a great day. You
too, man. All right, guys, next up, we have Mr. Carl Wolf from Mama Mancini's. That's ticker MMMB, Mama, Baby, MMMB, up next for our next investor presentation. Do I have Carl? Carl, I think you're muted.
Okay, here I am.
Beautiful.
I'm in Florida. This is a backdrop of front of my place, right at the ocean.
Oh my God.
Very cold today, though. 51 degrees, but nice. So anyway, I thought about my backdrop, so I figured I'd let everyone drool. So.
Yeah, no, coming from Detroit, Michigan, that kind of made me angry when I saw that a little bit. I don't know if the anger was from jealousy or what, but I like it. But you know what, Carl? I'm going to let you introduce yourself, your company, and get right into your presentation.
Great. Okay, so what we're going to do is put up our deck, our investor deck, for those who haven't seen it, and we'll run through that pretty quickly. And then we'll leave 5 minutes for questions. So we'll go to the next page. The next page. So this is why you might be interested in our stock. First of all, we're a manufacturer and distributor of specially pre-prepared, frozen, and refrigerated all-natural food products under the brand name Mama Mancini's. We're in over 45,000 locations across the country with all the major companies, as you can see on the bottom, from Whole Foods, Publix, Albertsons, Costco, BJ, Sam's Club, etc. Our revenue over the last 5 years have been increasing around 30% a year. We expect that continued, and we're very leveraged. We've just had record profits. We expect that to continue, and we are very, very hopeful that we will see accelerated growth in the next several months. We hope to get into the food service market, which we are now pitching. That would double our available size. And we've just begun selling plant-based meatballs, both the Beyond product and our own. So let's go to the next page. We're real. Our products are all natural. They're fresh. And Dan Mancini is our spokesperson. His grandmother Anna came here in 1921, January 20th, and we expect a major event. Next page. Our products are sold in the perimeter of the store, which has been growing at 8 to 10% per year. That is fresh prepared food, pasta, fresh deli, fresh hot bar, fresh sandwiches. The middle of the store has been decreasing by about 1 to 2% a year. That's why you see impingement of sales and earnings of people like Kraft Heinz, Campbell's Soup, Kellogg's, etc. The size of our market is about $35 billion. We're now running at around a 45 million run rate, and the business is growing very rapidly. And we are now starting to get some new business on plant-based products. Next page. Some of our products are listed here. As I mentioned before, they're all natural. They are grab and go or pick up that day foods. Over 70% of Americans decide what they want for dinner after 12 noon. Our products are very, very well accepted, over 92% in 2 major surveys of over 3,000 people buy our product. We have around a 15 to 20% consumer recognition on an aided basis. Our major seller is meatballs, stuffed meatballs, meatloaf, stuffed peppers. We have sausages, lasagna, etc. And of course, Beyond Meat. Can we go on to the next one? This is just a very fast chart showing the nutritional attributes of our product. As an example, our turkey meatballs are 22 calories an ounce, only 5, very little fat, sodium per serving. So as an example, other products have 80 calories per ounce. And we have no soy, no sodium phosphate, no hydrogenated oils. Plus, they really taste delicious. Our meatballs are made in the sauce, which is part of our secret. We call it the secret sauce. Next page. So some of our customers, as you can see, are the major chains in the country: Walmart, Sam's, Kroger, BJ's, Costco, Whole Foods. We sell Whole Foods on a national basis. And we sell different types of products. We sell products in our sleeves, which is the first product on the left on the top. We sell our product in grab and go, which is on the right. We sell our product for hot bars. We sell our products on QVC. As an example, in the month of December, we'll be on at least 4 times. 2 of the times are one-time only specials. We also have a major ship in December of Christmas in July. We presented the product in July, and we are now shipping in December. So there was quite a major amount of sales booked. We do not reflect the sales. In January, we're anticipating a major Mama Mancini's Day on January 20th. And in the month of April, QVC sold over $1 million worth of our product. And we're typically the number one or number two producer. As we mentioned before, we are going after food service. Particularly interesting is convenience stores. There's 300,000 of them in the United States. We're working on meatballs in a cup. And universities, which have very, very high interest in plant-based products. Right now that's on hold, but we think we'll wind up selling several hundred universities. And if we are successful there, that could be a $40–50 million business alone. We also are looking at direct-to-consumer. We're talking Amazon Fresh. And to support this, we have a major Sirius radio campaign in about 70 million homes, 70 million reach. Many people will know our commercial, Mama Mancini's, the Meatball Lovers Meatball, and we are on all the major channels. And we typically run per flight at least 1,000 commercials across the country, and they're done 6 to 7 times a year. We'll be doing a major commercial for Anna Mancini's anniversary. Should be mentioned that QVC represents an 8 to 12 minute infomercial every time Dan Mancini is on. He was just on this week and sold our sausage product, and it was an early sellout. We sold out 33% more than we had available for offering, and those are back ordered right now. Next page. These are some of our chains. What it's showing is we don't have full penetration. What's very important is we have over 26 items available. So if we sell a chain 2 items, even though we have 100% distribution, we will then try to sell that same chain a 3rd, 4th, 5th, 6th item. So that's major distribution opportunities. In general, we're weaker in the Midwest, and we expect that to be filled in very shortly. Let's go to the next page. So I have 5 minutes. Anyway, our growth strategy is to grow 5 major accounts a year. We think we'll grow at least 30% in the next year. Let's go to the next page. Our plant, if you just look at the pictures, we did remodeling. We brought in outside consultants. We're becoming more and more efficient. We now are redoing our packaging room. We think we'll save around $300,000 to $500,000 a year in efficiency, plus bring more product out. So there will be additional investments. They're not major. And we've done things like streamline our packaging. We have one supplier who now holds all the packaging material and bills us when we receive it. So it relieves a lot of capital, and we're paying much lower prices. So that's, we have in-house lab testing. We're a level 2 safe quality food plant. We have a full staff of quality assurance people. Next page. Just showing you the revenue. We're running around a 4 million run rate. The gross profit is will go up. It's 32%. I think eventually it could get to about 36. And we have record net income. Our cash and equivalents was 1.7 on July 31. With right now that we announce our earnings next week on July 14th. Cash and equivalents will be up very substantially, and debt will be pretty much extinguished at that point. Okay, so any questions? We have about, what, 4 minutes? 5 minutes? So I'm going to go back to the panelists with questions.
Questions in chat. A lot of folks are telling me that they're hungry. One question is, why am I hungry all of a sudden? I need to go buy some of these right now. Guys, the ticker is MMB. So add it to your watch list right now. Any questions, guys? One question is, can I become a lab tester? Any serious questions? What have you done to everyone, Carl? Is it you're doing this
Our
presentation?
products are great, are very, very great. You know, a 92% approval rating of intent to buy is unheard of in the food business. It's typically, if you have a product that's 65% in market research, that's considered a go. So we have a great response rate. If a product just tastes good, it doesn't get out. Right now, actually, we're doing a test on very, very significantly positive chicken for chicken parm. We have one right now. We're upgrading that to be. I don't think anyone's on the market like that. As if you just had it made fresh in the restaurant. That's going on right now in our test kitchen.
I've got a couple here. What are the profit margins like between fake meat and real meat?
Profit margin on real meat are a little higher, but the price on fake meat is much higher, about 67% higher than our regular product. What I should mention is that each incremental sale, and right now we're going for incremental sales. We have major presentations across the country. Represents 20 to 25% operating profit to the company. So if we're leveraged and we can grow our business 20 million in the next year, it's very possible. You know, it should bottom line to 4 or 5 million additional profit.
Amazing.
So anyway, that's the goal right now, is to, you know, hunker down, do the work, get the new business. It always helps to have products that you make margins and have a reason for being. That's one of the first tenets of good business. My background, if you check it out, Carl Wolf, I started Alpine Lace Brands. We grew it from nothing to a $120 million business. We got bought by Kraft. Merrill Lynch was our banker. And so I think we're following the same route there.
Beautiful. And we are at time. So Carl, I want to just ask you, how can folks learn more about the company from an investor perspective?
You can go to mamamancinis.com, no apostrophe, and go to investors. There also is a very complete report on the company, which is free, from Taglish Brothers. It's very detailed, a very positive and well-written report that reflects the company in detail.
Beautiful. Carl, thank you so much. Mama Mancini's, MMMB is the ticker. Make sure you guys add it to your watch list and take a serious look at those investor materials. Carl, thank you so much for being with us.
Thank you. Bye.
Bye. All right, everyone in chat, once again, MMMB, it looks like we dropped that URL. Definitely take a look. And hell, do your due diligence. Go to the store, buy some meatballs. All right, guys, up next, we've got our panel. We're going to be talking about comeback stocks. What does it look like as we start to rebound from this COVID crisis? How are these companies adapting to the changing landscape? What changes will persist after vaccination has become widespread? Very exciting panel. So it is my pleasure to introduce to you today, in no particular order, Frank Holmes, the CEO and CIO of U.S. Global Investors, Inc., ticker GROW, GROW. And I'm seeing folks come in. We've also got James Marsh. He is the SVP of Investor Relations for Lionsgate. That's Lionsgate Entertainment. Ticker LGF.A. We're going to drop these in chat. Can my producers drop all this information in chat, please? And finally, Andy Hayward, CEO of Genius Brands. Guys, thank you so much for joining me on this panel. For me, this is very exciting. what I want to do, go ahead and unmute yourselves, guys. This is a free flow discussion. All right. Don't worry about being polite to anybody. We're here to get this chat going. Chat, if you got questions, I've got plenty of questions lined up for these gentlemen that are going to give you a good idea of investment opportunities, as well as what to look forward to, or what to expect in 2021. But if you got questions, drop them in chat, and if they make sense, I'll get them in. Guys, I want to start off by just going around the table here and getting an introduction from you about yourself and your role and the organization that you're representing here today. And for that, why don't we start off with Frank Holmes? Frank, can you give us an intro?
Sure, thank you. I'm in San Antonio, Texas. I'm the CEO and largest controlling shareholder of U.S. Global Investors. We have mutual funds and ETFs. I'm known for the world of gold, from corporate finance from 30 years ago living in Canada. I've been living in Texas, so now I'm a full-fledged Texan. Y'all come back 8. And with that, we're known particularly for our gold funds, and we launched an ETF, and it's had an unprecedented growth this year, from 35 million to $3 billion JETS ETF. So we've been involved in that end of it, and myself have also the creation of several companies, the ground floor in our gold funds. So it was Franco-Nevada, was one of the Silver Wheaton, which are the 2 biggest gold royalty companies, and Hive Blockchain Technology, which was the first to really do mining using green energy from Sweden and Iceland, and now in Canada. And it's been on a huge run this year. It was up about 1,200%. So that's what I'm involved with, from crypto to gold to flying with JETS ETF.
Beautiful, beautiful, beautiful. James, let's take it over to you.
Great. Thanks, Neil. My name is James Marsh. I head up the investor relations effort at Lionsgate Entertainment. I was a Wall Street analyst for a number of years at, I'd say, too many firms to mention, but most recently at Piper Jaffray. Lionsgate was one of the companies that I did cover while I was there. So I joined Lionsgate about 4 years ago. Lionsgate's a diversified media and entertainment company. Got a large film production capability, films like The Hunger Games, Twilight, most recently John Wick franchise. Do TV production as well. Shows there you might be familiar with would be Mad Men, Orange is the New Black we're doing for Netflix. And we also own a large media networks business anchored by Starz. Starz has roughly 27 million global subscribers. Interestingly, that model has started to pivot. We've moved away from the old, traditional wholesale licensing entertainment model, and we're moving more to this aligned direct-to-consumer, data-driven model. I'd point out that we have more direct-to-consumer subscribers today than we do cable subscribers. So we're really, well along on the inflection point to the new business model. I think that's really important. I think there's a lot of concern about the broader media and entertainment space adapting to the new model. And, we'll talk about this more later, but I think we're well on our way to doing that. Roughly 20% of our revenues today come from direct to consumer. We think that'll be approaching 30% in the next 15 months. We think that's an industry leading position. I think some of our competitors like Disney get a lot of congratulations on their pivot to direct to consumer. We're right along there. We've got all the components that we need to be successful. We've got TV production, film production, a 17,000 title library, and a direct-to-consumer global platform that's collecting data on consumers. So we feel really good about the future.
Wonderful, James. And you beat me to a bunch of my questions. So thanks for that.
I'll emphasize them.
Andy Hayward, can you please give us a brief intro?
Yes, my name's Andy Hayward. I'm CEO of Genius Brands, and we have a very simple business. We make animated cartoons for children, and we broadcast animated cartoons for children on our own cartoon channel. Talk a little bit about myself. I've been in this business my whole career. I graduated college and went to work immediately at Hanna-Barbera, where I started writing on the Flintstones, the Jetsons, Scooby-Doo, the Smurfs, and all the Hanna-Barbera cartoons. Over the years, have produced about 5,000 half hours of children's cartoons, ranging from Inspector Gadget to Ghostbusters to Alvin and the Chipmunks, Hello Kitty, Super Mario Brothers, etc. At Genius Brands, when we started our company, we had a very simple concept. It was to do content with a purpose. It would be how we would distinguish ourselves from everybody else in the business, and at the same time, delivering shows as kids consume them today through digital means. All of the people in our company came out of the top C-level or creative C-level of the Walt Disney Company, Hasbro Toys, Warner Brothers, Marvel, or Fox Kids. And we've built this company from that group of people, all of whom have been quite experienced, of course, in their own respective fields. The children's animation business is a very interesting asset class. It's quite immune to ups and downs. We're not affected by interest rates. We're not affected by COVID. We're not affected by impeachments and Brexits and one party or another. It really has nothing to do with any of that. Kids continue to watch cartoons. They will continue to watch cartoons. And I would say if you had invested in the Flintstones or in Scooby-Doo or the Smurfs or Tom and Jerry when they first came out, you would have seen many, 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 many multiples of your earnings. They continue to go on forever. The beautiful nature of cartoons is they are international, they are evergreen, and they have dual income streams. The programs are licensed to broadcasters again and again and again. Once they've been paid for, they just work forever. They're like an oil well that keeps on pumping. And they also have the income stream of consumer product licensing. So any successful cartoon will spawn toys, video games, music, apparel, publishing, backpacks, sleepwear, school supplies, stationery, party goods, costumes, pretty much anything that you could think of. When we did Strawberry Shortcake, that started off with one single cartoon. And 6 years later, we had about 300 licensees, 600 licensed products in the marketplace, and we had done about $5 billion of retail sales. So that's our business. It's a growing business. It takes some time to create the business and develop the catalog and then get the momentum going. But we're well on the road and we have an extraordinary team doing it.
Wonderful. I love the scope of that explanation. Thank you so much, Andy. People are loving what they're learning right now, just from the introduction. So let's get into these questions. I want to ask particularly about 2021. I know, Andy, you just mentioned that, cartoons aren't totally affected by COVID. Makes sense. But from the perspective of COVID being an accelerant to staying at home and more leveraging the internet to access things like entertainment. Andy, I was wondering if you could speak to how consumers have changed, at least over the past year. Maybe it's not totally COVID related, but how has business changed? What changes are you seeing?
Yeah, two things. First of all, our audience is kids and our audience is parental co-viewing. Kids have been staying at home, so there's been more TV viewing going on. The kids are not going to school, so we added onto our channel a segment called Cartoon Classroom. Most of our cartoons have what we call content with a purpose. So, for example, the first cartoon we produced was with Warren Buffett. It was called The Secret Millionaires Club, where Warren plays a mentor to a group of kids in animation, and kids learn lessons in business. So we have enrichment infused into all of our cartoons, and that's one example. We have another one called Thomas Edison's Secret Lab, where kids are learning about science, and the lead investigator is a young girl. So with kids staying at home, viewing is up more. Secondly, in our case, we tried to create a product that was responsive to the times. So instead of having a subscription channel where people, I think, are already taxed quite a bit with the costs in their life today. Disney Plus is a subscription product. Netflix is a subscription product. HBO is a subscription product. That's a tongue twister. Ours is a ad-supported product, so it's free. there's no cost to see our cartoons. And we've seen, because of COVID, kids being home from school, there's viewing has gone up. And that was enabling us to build our channel and launch with some steam and some headwinds and winds behind us.
Surely, and surely getting some eyes on some IP there that you maybe wouldn't have otherwise. That's fantastic. Got to check out that Warren Buffett cartoon. I think Jason Raznick would love that. So
that's called the Secret Millionaires Club.
It is, and Warren kindly brought on all kinds of friends of his as guest stars in animation in every episode. They range from Bill Gates to Jay-Z and all points in between.
Oh my God. We got to have a watch party for this. That's good for adults.
There's no doubt, Andy, your business is booming. I'm on the board of Thunderbird Entertainment, and same people behind that created Lionsgate, Frank Justra. And we have Atomic Cartoons. So animation for teenagers to young kids is massive, especially if you can ever hit a Paw Patrol and you get all those rights, the $1 billion asset Paw Patrol.
Well, it's funny that you mentioned that. And of course, Paw Patrol is made by a Canadian producer. We have a show called Rainbow Rangers, which we created as a Paw Patrol for girls, very similar. And it's we have a master toy license with Mattel. It's on Nickelodeon. It's also on our cartoon channel. And we have about 375 products coming into the marketplace from that. If you catch fire and one of those cartoons takes off, as you say, Paw Patrol is it's about $1 billion a year of sales, Paw Patrol. So, but any of them that take off, they go on and on. You look at Tom and Jerry. Tom and Jerry was created in 1940. Kids discover Tom and Jerry fresh every single day. And the Flintstones was created in 1960. Again, every day you can go into a supermarket and buy Pebbles and Bam Bam cereal, or a drugstore and get Flintstone vitamins.
Yeah.
Great. And Frank, I want to get over to you. I want to get your perspective on changes in consumer behavior and how that affects things over the past year here.
So one of the big things we witnessed, and I would say running along and trying to grasp what I saw in the 90s was baby boomers discovering technology stocks and 401k and Roth IRA. All this stuff came in the 90s with baby boomers. Now we have millennials and Generation X and stuck at home, and they may not be watching cartoons, but they definitely are becoming stock traders. And this discovery we're going to see in the next 20 years is going to be a number of something like $10 trillion of transfer of wealth from baby boomers to millennials and Generation X. So with that, we found from our JETS ETF, and I was really worried about it because at the beginning of March it had halved in value, and all of a sudden it took off. Minnows from Robinhood and Acorn and TD Waterhouse started buying. The minnows then attracted players that were wanting to go short American Airlines and go long JETS ETF for that pairs trade to hedge themselves. And then that brought more volume. And then you had bigger players, and bigger players to today is basically from 35 million to almost 3 billion in assets, trading 35,000, I think it was 30,000 shares a day to 3.5 million shares a day. So in this new capital markets world for any company, it doesn't matter what it is, you really have to understand the barbelling that if you want to get bigger players and from hedge funds or pension funds, a lot of the rules are predicated on liquidity. So the minnows and the ecosystem ignite price discovery. And that price discovery all of a sudden brings in the tunas, the whales. So you need to have the minnows, and this is the first time I've seen this sort of huge increase in interest. I also found out that they do the research on YouTube and podcasts. And on YouTube, I discovered some of these personalities that had 2.5 million followers. And that person with 2.5 million followers is making a couple million a year in ad revenue. And they knew everything about the airlines. So a lot of these millennials would travel for the experiencing society. That's what they wanted. But now they're looking at all stocks and all ETFs. And so I think that's a very important part as we go into next year.
So, okay, I want to just make sure that we get that ETF across. That's the JETS ETF, JETS ticker.
So in the research, just to help, it was because if they said that after 9/11, a year later, the airlines were up 80%. And after SARS in 2003, the Asian airlines were up 120%. And after 0809, 6 months later, the airlines were up 80%. So you see the speculation coming in, and it's good. It's young people speculating, but they've done their research, and they're not going to Main Street, Merrill Lynch research on cycles, etc. They're going to YouTube to listen to interviews like this, and this is where they gather their information.
Very, very true. Very true. All right. So I want to move on to another question that I have. We got one in James. I'll get to yours in just 1 second in chat there. So I want to talk about leadership a little bit. Andy, can you give us an idea of how leadership addressed the changes that we saw in 2020 with that increased viewership?
When you say leadership, you're talking about leadership in our country, or are you talking about leadership in our company?
Corporate leadership.
Okay. Well, thank you. We're very fortunate. As I said, most of our people came right out of the Walt Disney Company or Hasbro Toys or Warner Brothers or Fox. For example, the person who is the executive chairman of our channel, cartoon channel, her name is Margaret Lesh. Margaret started Fox Kids. She was, prior to that, president of Marvel Entertainment. And with Fox Kids, she did it literally on the back of a napkin. She wrote out a business plan for Rupert Murdoch. It was sold to the Walt Disney Company 3 years later, I believe, for $5.5 billion. She had some very specific ideas on how we would turn Cartoon Channel into an important force in our business. And we listened to all of them, and we're implementing them today. One of them, of course, is having a ad-supported product as opposed to a subscriber-based product. Another one is having a very family-oriented content base. There's no violence. There's nothing negative. There's no negative stereotypes. There's only enrichment in the shows that kids can learn from. Other leadership involved is coming from our business affairs and financial group. We saw a lot of liquidity in the marketplace at this time, and we were able to raise money. We decided to beef up our balance sheet. We have a very clean balance sheet. We have not $10 of debt, nothing, and we're sitting on about $100 million of cash. We're looking for only to invest in ourselves. You know, the Secret Millionaires Club of Warren Buffett, one of the first lines he says in it is, the best investment you can make is an investment in yourselves. So we're investing in content, we're building our catalog, and we are investing in very, very accretive acquisitions. We're looking for things that will add to our business and enrich our business. We just did an acquisition called Chizcom, which is the largest media buying service in North America for kids. They spend more money on kids media, on commercials, than anybody, more than Kellogg's, more than General Mills, more than Mattel, more than Hasbro. They represent 30 of the top toy companies in North America. And that gives them and now us a great deal of clout in the marketplace. It'll also provide revenue in growing Cartoon Channel. The other thing that we invested in was the brand of Stan Lee. For those who are not familiar with Stan Lee, he's probably the most successful creator of our time. Stan created Spider-Man, X-Men, Iron Man, Guardians of the Galaxy, Black Panther, The Incredible Hulk, Thor. Everything that came out of Marvel was Stan. And he has a huge, rich catalog of IP. After he left Marvel, we acquired his name, his likeness, his IP, the right to do licensing and merchandising, and that will become a huge value for the company going forward. So we're investing in ourselves in these times, and the leadership of our company has all focused on that like a laser beam right now.
Great. Great. And James, I have not forgotten about you. I've got a lot of questions about Lionsgate.
Don't worry.
So tell me how the leadership over at Lionsgate has adjusted to this crazy year.
Sure. So obviously it's been a kind of a crazy year. Went into the year with certain expectations about films being released, shows being produced, TV shows being released. All those things have been put on the back burner. So it was really, I think for management, it was a test of the resiliency of our business model.
Mm-hmm.
I think early on, there was a lot of concern with theaters being shut and production being down, that would be a huge negative impact for our profitability in calendar 20. I think what we found is that the business model is much more resilient than we thought. We've been able to rely on the Stars business. Andy was talking about in-home consumption of media. That's been a big trend for us. So we've seen an uptick in subscribers. We've seen increased consumption of media, both on traditional linear platforms as well as direct-to-consumer platforms. And I think importantly, and this is something that people forget about at Lionsgate, is our library has done really, really well. So the shows and the films that have been produced previously, we still own a lot of the rights to those. We've been able to monetize those. So we've had record library revenues in the fiscal first quarter, our fiscal second quarter. Last year we did as well. So I think that's increasingly being perceived as a strategic asset at the company. So I think management's biggest challenge going forward is navigating theaters being reopened.
Mm-hmm.
And how do we start the monetization process for motion pictures when theaters are closed? And we've done some premium VOD releases. We've licensed some films to some other SVOD platforms. So we're starting that process, but I think generally speaking, we're waiting for theaters to reopen. And two, how do we get production restarted? There, I think we've been leaders on that front. We've probably got 6 movies going globally on the production side, a dozen plus TV shows. We've had to basically create new protocols, safety protocols for all the various stakeholders involved at the company. So, I think both of those have been challenges for management. Obviously,
Mm-hmm.
the most paramount thing is to make sure everybody is safe. But I feel like one way or the other, we feel pretty well hedged. If the world's going to reopen, theater's going to reopen, that's good for our business. Production's going to restart, that's good for our business. In the interim, if it doesn't, we'll rely on that shelter-in-place model that drives our library as well as our direct-to-consumer offering.
Beautiful. And then, Frank, I wanted to ask you, do you have anything strategically planned for 2021 that you would like folks to know about?
We do a lot of regressional work. Before we launch a product like Jets, we spend thousands of hours doing what's called fundamental approach of looking at how that airline industry did during previous crises, bankruptcies, et cetera. And then we did Go AU. So we'll be looking to launch another ETF product going out. Because we also realize you have to spend years of building up that awareness program, and then they click. And so with that, we'll be focused there. I'm also very focused on some of our investments, like particular high blockchain technology. I mean, it's gone up with Ethereum and Bitcoin 1,200% this year. It's traded almost 2 billion shares. It has institutional retail. It trades in Europe and Germany and over-the-counter US and Canada. So growth there, that'll be very focused on that company, which has gone, as I said, up substantially. There's huge opportunity in that space. So that is something we would take a core position in. So we would own a position like we do in Thunderbird. So Grow is basically, you could say, like a holding company that also has fund business. It has direct business, and then it makes these strategic investments. So I'm continuously looking at those strategic investments as opportunities for growth, in addition to launching the ETF. But right now, we're in a very sweet spot we've been paying a monthly dividend since 2007, and our revenue has just exploded here with the growth in Jets. It's easy to make a calculation. So that one particular product throws off $10 million a year of free cash flow and allows you to turn around to grow with. So I'm focused on that. But I think coming back on the leadership end of it, I think it's a very important part of how do you have a fixed mindset versus a growth mindset. And I think all leaders in a COVID type crisis, the invisible World War III, the amount of money printing that's taken place to keep the global economy. And I remain very, very bullish on that. And I think that new housing is going to think of home theater. I'm looking at building a new house, and immediately it's going to have, what do I do when you're stuck at home? Have a sports court at the back, have a swimming pool, and make sure you also have the theater. And that sort of concept. I think you have to have that personally, and you're going to have it for in business. And the Stanford professor has done tremendous work on it. And you just have to have this growth mindset. Those companies that didn't, I'm here in Texas, in the fast food business, et cetera, those were able to quickly pivot and have delivery systems outside faster. They're prospered. Those that didn't, all of a sudden are bankrupt. The same thing in my business is how fast do we pivot? And that really comes to this leadership of a growth mindset.
Mm-hmm. So, okay, this gets us to about 6 to 7 minutes left in our session. I wish we had about 20 to 30 more minutes. I want to go around. I'm going to skip through some of the questions that I had planned and speak more generally about tailwinds and headwinds that you see over the next 4 quarters. I want to start with James, and we'll go Andy, then go Frank. James, what are the tailwinds and headwinds that you see for Lionsgate over the next year or so?
Sure. So I would say on the tailwinds, I'd say it's the same shelter-in-place trends that we talked about there. Us utilizing our library, driving high margin revenue through that library, and rolling out our direct-to-consumer platform globally. So those are clearly I'd say the tailwinds. I think the headwinds relate to COVID and the flip side of the shelter-in-place economy, and that's getting theaters reopened. We don't really control that. It's driven by local and state governors and mayors. So we're not really in a process to control that. And the production process, we can't really control that. If we have local, state, and government employees shutting that down, it's going to be challenging for us. So I think the key for us to recognize is that one way or the other, our business model is pretty resilient. You don't need to make a bet on the economy reopening or not reopening for us to be successful. I think we could do well in either scenario.
Beautiful. All right, let's go over to Andy.
Well, we're very fortunate because the animation business doesn't require actors in production and soundstage and all of that. It requires artists who work on computers. So we have been able to stay open. We've had no layoffs at all. We've been growing during this period of COVID. And we feel fortunate that we will continue to be able to grow. We're building our cartoon catalog. James spoke of the importance of a catalog, and I couldn't agree with him more. We continue to build the catalog. We're continuing to build out our distribution. Our distribution is not just through various platforms that we're on, such as Comcast and Cox and Dish and Amazon Prime and Amazon Fire and Apple TV and iOS and Android Mobile and Roku and whatnot. It's also now through television set manufacturers. And we announced yesterday, for example, we just did a deal with LG TV that we will be available on all LG smart TVs. A month or so earlier, we did the similar deal with Samsung TV, and we're available on all Samsung TVs. So as we go forward, we're focused on distribution, and that's where we're putting our energies, and the winds, if I can say, then we're blowing us in that direction. COVID has not been an impediment to us right now. The really issues that we face have to do with getting good talent. There's a limited number of top A writers, top A directors, and top talent in our industry. The Walt Disney Company is and will remain the #1 competitor for the foreseeable future. And in acquiring acquisitions, of course, they're out there looking for things just as we are, and they have all the money in the world. So we've got to be very deft and nimble and thoughtful and skillful as we look for acquisitions, and we are. We're zigging when they're zagging. The other thing that I think is very important, and speaking of the times that we're in, is to be sensitive to issues around diversity and inclusivity. We recently promoted someone in our company to be our chief diversity officer because we think it's such an important area that has to be nourished, and not only inside the company with the people that work at Genius Brands, but also with the stories that we tell. And all of the stories we tell, we want to be stories that bring positivity and reflect good things and in diversity and inclusivity in our society. So I hope I've answered your question there, Neil.
You have. Thank you, Andy. Frank, I'm going to give you the last word on this with 2 minutes remaining. Headwinds, tailwinds.
Biggest headwind I see in the asset management business is going to be regulations. Regulations favor the BlackRock and Vanguards and really make it extremely expensive for entrepreneurial asset managers coming into the business and distribution of their stories. So that's probably the biggest headwind that I see when it comes to our asset business. But when I look at high blockchain, one of the big issues is no doubt COVID has created disruptions of getting hardware, et cetera, from Asia over to Sweden and Iceland and Canada, and then moving engineers that we have a lot of Croatians, et cetera, that will be flying up that now prohibited from flying. So I think that will be the headwind. The tailwind for that crypto business is the amount of Bitcoins is halved in mining. I know this in the gold business. If you have the supply of gold mines, then all of a sudden the value of gold would go up dramatically. Same thing in entertainment. If all of a sudden there was stopped all production or 50% drop in production of all entertainment, the library would become very valuable. So I think that's going to be a big tailwind. And I think also the money printing, this MMT, modern monetary theory, is being practiced differently in the G20 countries. They work together, so we're going to see continuous money printing and giving out universal income as a concept. Give all your student loans, all this stuff. Someone has to pay for this. And that's going to be very, very bullish for gold and other real assets. And so that's what I think is a big win behind hitting our sail.
Yeah, absolutely. So very, very interesting viewpoints from three very different perspectives, guys. I want to thank you each, Andy, Frank, James, so much for spending this time with me. I wish we had an extra at least half hour to go over everything, but this has been very insightful. So thank you again.
Thank you, Neil.
Thanks, Neil. Thanks, guys.
All right. So next up, guys, it is my pleasure to bring on let me take a look at our agenda. Oh my gosh. We've got Acuity Ads. This thing, just from a trader perspective, this thing has been like a quadruple bagger. All right. So if you're not following this stock, maybe take a look. It's ticker ACUIF. It's my pleasure to bring on Tal Hayek, the CEO of Acuity Ads. Do we have him present?
I'm here.
Hey, how's it going?
It's going really good. How are you?
Wonderful, wonderful. Thank you for asking. I don't want to step on your toes at all, other than to say your stock has just been a wild ride for investors recently. So let me just get out of your way and let you do your presentation.
Thank you. Will do. Okay, so again, thank you, Neil, and great to be here. Let's start with a little bit of background about Acuity. So we've started in business in 2009. The first 2 years of our lives was all about building the technology. And then we commercialized in Toronto in 2011, did about $1 million in revenue, and it started going very fast. The next year was 5 million and then 10 million. As you can see, 8 consecutive years of growth at the 82% CAGR. So it has been a great ride so far, and we believe the best is yet to come. I would like to share what industry we're in. So we are in the programmatic advertising space. It's the process of buying and selling digital ad units in an auction-based system, all done in real time. And the way it works is advertisers, which you see here on the top, would come to Acuity. So LG could come to Acuity and say, here's a $1 million ad campaign to run for us. We would then go and buy all the media for them on the supply side platforms. And supply side platforms are the ones that are managing the media for the different publishers out there. Everything that we buy is the decision is done by our AI engine. Everything is fully automated. We never make any human decisions when it comes to that. It's all based on the ROI we're trying to achieve for our clients, for the advertisers. Just to give you an idea of how it works from the consumer side, if you go into a website, let's say you're going to CNN.com, and you'll see the content of the page load, and you see the ad load, and it looks like it's all loading at the same time, but it's not. What's actually happening, the content loads first, and then CNN sends a bid request to an ad exchange asking for two things, a creative and a price. It goes into our system, and we look at your consumer profile. What do we know about your demographic information, geographical location? Then we go to our database of hundreds of advertisers, and we pick, let's say, the BMW ad, send it back to the exchange, and say $5. If we're the highest bidder, we get to show you that ad, and the whole process takes 50 milliseconds. So for you as a consumer, it looks like it's all happening at the same time. Another piece of information, we do this 110 billion times a day. So obviously it has to be done by a very sophisticated AI system in order to get to achieve all that. Very excited about the market opportunity here because the ad industry today is $614 billion. Programmatic that started 10 years ago grew to $127 billion in those 10 years. But the future is we're going to go into over $1 trillion industry, and the majority of it is going to be transacted programmatically, which means obviously the size of our market and the opportunity is huge, and we're very, very happy to be in a space like this one. We believe that programmatic is the engine for recovering growth out of COVID for all industries out there. So look, we personally seen a big drop when it came to mid-March. April was a tough month, but by May, we start seeing a major comeback to advertisers back to us. Why? Because if you're an advertiser and you now need to be way more picky about where you're making your investments, there's no better place to invest it than Acuity because we're providing superior ROI, all measured in real time. And this is why people are coming back to Acuity that was pausing campaigns, and that in general, and as an industry is programmatic, we're not seeing the negative results of COVID like other industries as well. And we believe that as we're recovering out of it, some sectors of the industry like travel, entertainment, hospitality are recovering. We're going to see a major uptick in there as well. Connected TV is something that we're very excited about because that's obviously a big part of the growth, the existing growth and the future growth as well. Look, linear TV, everybody knows it's dying. The consumers are moving away to digital. Whenever we can have control of the advertising that we're showing people that are watching shows versus everybody sees the same ad that are watching the same show, you eliminate a lot of the waste. And it's just, we've gone through a similar change when it came to the internet years ago, and now we're experiencing it again with connected TV. And actually through COVID, we've seen it more because for two main reasons. Connected TV offers the same idea when it comes to ROI. It could be measured all in real time versus TV that it's much harder to see the ROI. And also with linear TV, normally you have to commit major upfronts for it as a brand. And with connected TV, you have full flexibility, no major upfronts and commitments. From a competitive landscape, quite a few competitors out there on the demand side, platform side. You know, the Trade Desk has been a company that's been very successful, traded on the NASDAQ, and has a very, very high multiple, much higher multiple than what Acuity is today. So, you know, we've seen a lot of investors in the US specifically that are super excited about the opportunity to get into a company like Acuity at ground levels where the prices are today. Now, we are known to be that company that delivers superior ROI. This is how we grew in business throughout the years. We're not that company that raised hundreds of millions of dollars in order to invest so much of it in marketing and sales. No, we've done it differently. We bootstrapped for the first few years, and then we raised money very responsibly and slowly throughout the years. So how did we grow? By delivering a better ROI than our competitors. And I'll give you a few. We have countless of examples. That's pretty much how we grew from day one. But let's focus on one example. There's a D2C mattress company that started with us. They spent $840,000 with us back in 2018. Last year, they spent $4.5 million. This year is over $10 million. Why? Because it's a very smart company. They know exactly what they're doing when it comes to marketing. They're measuring everything. And they're seeing superior ROI coming out of that and shipping some more and more budget into us. And that's what we've seen across the board with many, many companies out there. From a category growth, look, before COVID, we had over 30% of our business was in travel, hospitality, automotive. And we lost almost all that business overnight when it hit. But our sales team was very resilient and started replacing it very, very quickly. We saw a major uptick in D2C, direct-to-consumer brands, e-commerce, pharma, healthcare, a whole bunch of other categories that really started taking off. And we're welcoming the world that travel is going to be part of our world again, and hospitality, entertainment, and all that. And we believe that we will be there to help all these companies capture their market share back here at Acuity. So looking forward to getting those industries back. From a financial performance, by Q3, we were back to the same revenue as we were in last year, more or less, which is absolutely amazing after losing 30% of our revenue. Very, very proud of the team to deliver that, but our financial performance is much, much better, even with the same type of revenue. As you can see, higher net revenue, lower expenses, $4 million in EBITDA in Q3 versus 1.6 in Q3 of last year. There's that 150% uptick. Net income, adjusted net income is higher. And very, very importantly, this is our 5th quarter in a row that we delivered a positive cash flow. So just the company's making money, just making the financial situation better and better all the time. So we're focusing as a management team on that. So this, as you can see, this is the LTM EBITDA, and every quarter we've been able to make the situation better and increase the trailing 12. And we see that continuing into the future. And this is a little bit of a fun fact. We have, the model is great leverage on our model. Why? Because the technology that we built can handle multiple times more revenue than we have today without increasing any of our fixed expenses. Our variable expense will be about 10%. So therefore, when we reach 200 million in revenue, we will bring in close to $50 million in EBITDA. So that shows you the leverage on this model, and we're looking forward to growing that either organically or inorganically in the future. And obviously, this is just an illustration. We don't believe we're going to stop there. We're going to reach much, much higher than that. And for me, the most exciting part of what we're doing here is Illumin. So Illumin is a new product that we launched to market on October 1st. We believe Illumin is changing the world. Well, the world of advertising for sure. What it is advertising automation. And it's something that we've been excited to bring to market for the last 4 years. And I'm so excited that Dream became a reality very recently. But what is it that we're fixing here? There's 2 major problems in our industry today. We, 10 years ago, were very innovative and we solved for the transactional issue. What we did not solve for is the huge gap between the way marketers plan and the way that programmatic gets executed. Because marketers, they plan in stages, and it's usually in 3 stages. There's awareness stage, engagement stage, and conversion stage. And they would like to send different messages to consumers that are along those stages. And it's very important for them to do that. But what happens in reality is they take that plan, they send it to their execution team or their agency, and they take that and put it in a black box. Essentially what they're doing is they're shredding the plan to pieces. Why? Because the black box has no ability to see a consumer journey, to look at the entire process. Black box is really good in executing against single line items like this one and delivering results against it. In fact, this is the way our old DSP looks like. And most other DSP that you're going to look at are also working like this, line items, not visual. And the next slide I'm going to show you is how Illumin looks like, which is completely different look and feel. So this is Illumin. Illumin is a very visual drag and drop system, highly intuitive. The second problem that we're fixing here is that for anybody operating today, the DSPs out there today, they need to be highly trained experts. With Illumin, any average person can set up a consumer journey within minutes. So that's huge. So that's usually the second problem that we're fixing. And what you're seeing here, it's a planning tool for marketers. All they have to do is drag and drop the people that they're targeting, the types of creatives they want to show them, the sequence, and set up some rules against it. And look, before this, I can share that I've many times seen a video ad, a 15-second spot that I really interacted with and I liked it and I thought I should really check that brand out. And then I saw the same ad again and then again and again and again. And after seeing it for 20 or 30 times, I want nothing to do with that brand anymore. It's annoying. We tell brands that if you already have your consumers engaged, you need to tell them the next reason why. You need to bring them along the consumer journey for conversion and educate them, especially nowadays when there's higher ticket items sold online. It's very, very important to do that. So this is what we've created, and I can tell you that the whole organization is super excited about Illumin, but that's not enough. As a DSP competing with other DSPs and very hard to differentiate ourselves for many, many years, it was always hard to get even meetings with the Fortune 500 brands. When we started looking for beta partners for Illumin, that was not a problem anymore. We had over 30 brands that applied to be part of our beta program. We ended up selecting these 6 brands. So you can see the Home Depot, Mass Mutual, Purple, Landmark, and Alex. These are the brands that love to be in the forefront of innovation, and we owe them a lot because they're very, very instrumental in helping us shape the product and bring it to market. These are some of the quotes we're seeing from these guys. But look, at the end of the day, they're all saying different things, but they love the ability to control the consumer journey, to control the message, and to be able to tell the story to your consumer without annoying them over and over again. So,
hey, Tal.
Yes.
So sorry to interrupt you. This is Patrick. Just to let you know, we've got just about 30 seconds remaining. I don't know if there's one final thought you'd like to leave our audience with.
Yes, absolutely. Will do. We believe that Illumin is changing the world of advertising like Shopify did for e-commerce, Expedia for buying airline tickets. And the one final thought that I like to leave you with is that, as we communicated in our call before, we are very excited to move into the NASDAQ sometimes next year. The application process has been started, and we believe that the right place for us to be is in the NASDAQ, and we're making the right moves to go there next year if everything goes well as planned as we have right now. So that's my final note, and thank you for your time today.
Thank you, Tal. We very much appreciate it. You guys, again, this is Acuity Ads, ACUIF. Very exciting stuff. One of the bigger movers I've seen on our conference thus far. So thank you, Tal. Really, really appreciate it, man.
Thank you, Patrick.
All right, take care. So, my friends, next up, we will move right along. We've got Michael Moe, the CEO and co-founder at Cooler Technology. And as we get him over here, it's KULR. That's the ticker, KULR. And again, we've got Michael Moe. So, Michael, as you come over, just throw your video and your and unmute yourself. There we go. Can you hear me?
Yes. Hi. Can you hear me?
I can hear you just fine. Love that picture behind you.
Great. Thank you so much. Let me share my screen, make sure the presentation is up. Can you see the presentation?
I can, yes.
Great. How does this look? It's okay?
It looks perfect. Go to town, my friend.
Great. Thank you so much. Hey, good morning. Thank you for joining the Cooler Investor presentation today. Appreciate your time. My name is Michael Mo. I'm the CEO and co-founder of Cooler Technology. Safe harbor statement, the customary stuff. Quick introduction about Cooler. We come from over 30 years of heritage of developing carbon fiber thermal energy management solutions for space applications. Our products are trusted by NASA to be used on the Mars Rover 2020 program, the International Space Station, and numerous different aerospace and defense applications. Our mission is to take these space-proven technologies and apply to the world of lithium-ion batteries and electronics to keep them cooler, lighter, and safer. Our customers include the likes of Lockheed Martin, Airbus, Raytheon, and other commercial customers. In our technology target multiple billion-dollar markets, such as the EV, energy storage, lithium-ion battery shipment. And our management team have decades of experience in technology development, marketing, and public company finances. I'd like to go over our technology portfolio. Our core technology is a carbon fiber matrix material that's very lightweight and conduct heat more efficiently than other materials. On the battery safety solution side, our Hydro TRS thermal runaway shield product is used on the International Space Station to store astronauts' laptop batteries and Microsoft Surface Pro safely without the risk of fire and explosion on board. The LERA ISC technology is invented by NASA JSC to test for battery safety for space applications such as astronaut spacesuit. Cooler is the exclusive worldwide perpetual licensee and commercialization partner for NASA for this application. It's now used by EV customers, electric aviation, energy storage, and other consumer products. Our ERA product is a technology on board Mars Rover 2020 to keep their lasers and sensors operating ideal conditions on Mars. Crux is our carbon fiber cathode technology for direct energy applications for DoD customers. We solve heat and safety problems for battery and electronics. As many of you know, batteries can overheat, and then it can catch fire and then have the catastrophic event and exploding. This problem can lead to cars, warehouses, and even passenger jets catch on fire. Electronics and chips overheating will reduce the system performance and reliability. So our proprietary core technology is a carbon fiber material, as you see the picture here, that provides superior thermal conductivity and heat dissipation properties in ultra lightweight and compliant configuration. Our patented technologies isolate and contain battery cell fires and explosions. We have trade secrets and IP in manufacturing this carbon fiber material, and we make our own equipment to build these structures. Our engineering team has been working together for over 20 years. We have 10 granted patents, and the most recent one providing protection up to 2036. As excited as we are about the space missions and programs, we're more excited about the opportunity to apply our technologies to multiple billion-dollar markets, such as energy storage, EV, and 5G cloud computing infrastructure. The global lithium-ion battery market will hit $100 billion by 2024. We believe battery safety is a critical aspect of enabling this $100 billion market. Lithium-ion battery recycling industry will grow to $18 billion by 2030, and transportation safety is a critical component of that. EV markets forecast to grow from 3.3 million units in 2019 to 27 million units by 2030. And the global thermal management and device market is forecast to reach over $16 billion by 2024, driven by the proliferation of cloud computing, AI, and the upcoming 5G deployment, where more data and faster network, smaller devices are all driving need for better heat management. Our growth strategy is the following. We collaborate and innovate with government agencies such as NASA, US Air Force, Department of Energy to develop cutting-edge technology for these energy applications. Then we work with government and regulatory bodies such as UN, FAA, to bring awareness coolers technology to be included in the regulatory roadmap. Then we apply these technology to commercial mass market applications such as energy storage, EV, and cloud infrastructure. We take a multi-pronged approach to serve our customers in different markets. Most of our engagements start with engineering design and testing. Once we've developed a customized solution for the customer engagement, we offer them the product for sale or an IP license for high volume customers. This allows the customers to be flexible, to integrate our products into the supply chain and make it more scalable and potentially lower the cost for everybody. It's important for our shareholders to know that Cooler's business model continues to evolve from being a component supplier to provide more design and testing service to our customers. The next phase of evolution is to provide that system solution, is to provide a total system solution to address market needs. To scale up as a system provider more quickly and efficiently in markets such as direct energy, hypersonic vehicle, thermal management, and energy storage, and lithium-ion battery recycling, Cooler will actively seek partners for joint venture, technology licensing, and other strategic partner initiatives. The goal is to leverage Cooler's thermal design expertise, the portfolio of our IP to create market-leading products, which Cooler will take to market directly and capture more value for our shareholders. Quick overview of our management team. My name is Michael Mo. I'm the co-founder, CEO of the company. I've been with the company since 2013. I've been in the semiconductor and technology industry for over 25 years. I received my undergrad and graduate degree, master's degree in electrical engineering and computer science from UC Santa Barbara. Dr. Tim Knowles has over 30 years of experience in thermal management and high power energy markets with carbon fiber. He has a PhD in physics from UC San Diego. He's led the team to develop products for the ISS, the Mars rover, Mercury messenger, and all these aerospace and defense applications. Simon Westbrook is our CFO. He has been CFO for NASDAQ listed companies as well as private companies since the 1990s. Mike Carpenter is our VP of engineering, who's been developing these applications for over 30 years as well. Update on some of our clients and customer engagements. On the government and defense side, Cooler supplied Federal Aviation Administration, FAA, with the ISC technology to evaluate for passenger lithium-ion battery malfunctions that can cause fire and smoke incidents aboard aircrafts. The most exciting event for 2020 for us was the launch of the Mars rover Perseverance in July. Cooler's heatsink was part of the Sherlock instrument on the rover and now on its way to Mars. Our heatsink keeps the optics and sensors on the rover in optimal operating conditions. They are literally the eyes and ears for the rover to look for signs of life on Mars. We work with NASA Marshall Space Center to build 3D printed battery system for manned and robotic space applications. The goal is to eventually 3D print our safe battery solution on the moon as part of the Artemis project. Our TRS solution is on board International Space Station to safely store laptop batteries as well as Microsoft Surface Pro for the astronauts. And we work with DoD prime contractors such as Lockheed Martin, Leidos, and others on direct energy, hypersonic, and the missile programs. On the commercial side, we have recently announced a number of commercial customer engagements. We partner with Airbus Defense and Space to use Cooler's passive propagation resistant PPR solution to research for lithium-ion battery safety and testing for flight applications. KULR has a partnership with a leading global electronics component and battery supplier, which is a leading supplier to key electronic components in smartphones such as Apple's iPhone, to build our ISC technology into their battery for testing for battery safety. And KULR is to license our TRS PPR technology to the partner in commercial phase. We're working with Volta Energy Products to provide our TRS technology to implement for stationary energy storage modules for energy grid applications. We've also supplied a Silicon Valley-based Draco Motors, who builds a super EV vehicle. That's 1,200 horsepower with a top speed of 206 miles per hour. We're literally deploying the thermal technology on the Mars Rover 2020 into their fastest EV to cool their battery pack. Here's a quick snapshot of the KULR Technology Group. Throughout 2020, we have strengthened our balance sheet with over $2.5 million in cash as of the end of Q3. Our burn rate is approximately $200,000 per month. We have a strong and growing patent portfolio, and our insider ownership is approximately 45%. We believe that KULR provides a compelling investment opportunity for our investor shareholders. We've been trading on the OTC market since 2018. We recently filed our 14C for the board to take certain actions to prepare for uplist to a national senior exchange. Our space-proven battery safety technology is a critical platform play for multiple billion-dollar high-growth markets such as EV, energy storage, and others. We have a robust and growing patent portfolio, both developed internally and through exclusive licensing arrangements with NASA and DOE. Our business model evolution is to transform a component supplier to an integrated design and testing part supplier to ultimately a total system provider to capture more value to our shareholders. And so we look forward to a strong growth year in 2021 and hopefully on a senior national exchange to attract more investor shareholders to join our mission to apply the space-proven technology to make the world the world of battery and electronics cooler, lighter, and safer. Thank you so much.
Thank you, Michael. Very much appreciated. We really, really, really appreciate you coming on. This is cool stuff. Next generation technology. So thank you. The ticker again is KULR. And Michael, the email address on here, ir@coolertechnology.com. Is that the best place for folks to reach out?
Yeah, that's the best place for folks. Any investor related questions, please reach out to that. Mario D'Souza, our Director of Corporate Development, some additional sales, marketing related, PR related, both address works. Yeah. And then if investor shareholders interested, my personal email address is very simple. It's michael.mo@coolertechnology.com. So I'd love to hear from our shareholders and the investors as well.
Great, Michael. Well, thank you so much. We wish you guys all the best. Have a great end of the year, and I'm sure we'll hear from you again soon.
Great. Thank you so much.
All right. Take care. Moving right along, my friends. Next up would be Verb Technology. Verb Technology. Rory Kateo. We'll move Rory over. The ticker here on NASDAQ is VERB. 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 Simple enough. So as go right ahead, Rory.
Okay, I hope that you enjoyed the presentation by Cooler, a great company led by a brilliant CEO, Michael Moe. He and I will be appearing on a TV show that on Amazon that launches, I think, January 8th. I think you're going to enjoy it, a business show. Okay, so I'm Rory Kataya, founder and CEO of Verb. Thank you for joining me. Today, I want to focus on our upcoming release of Verb Live, our live stream e-commerce platform, which we believe will be the greatest value creator for ourselves and our shareholders for years to come. But first, let me provide some context. Look, we're all living through unprecedented times, a seemingly endless series of crises ranging from natural disasters to an ever-expanding global pandemic. But you know, it's out of these times that entrepreneurs and innovation emerge, because it's out of these times that the existing paradigm is challenged and opportunities present themselves. And I believe that we'll see the next Amazon, the next Google, the next Facebook, or maybe even the next Twitter emerge from this period. And for those who know where to look, we're witnessing that unfold right now. COVID-19 and the resulting social distancing and remote work environment in which we all now live has had a profound effect on many areas of our lives, on many things that we once took for granted. The impact on retail businesses has been particularly hard. Brick and mortar retail was already dying on the vine due to the shift towards Amazon-style convenience, causing a massive surge in e-commerce. But COVID and its long-lasting effects have changed retail as we know it, and honestly, it's really unlikely to return to its former form anytime soon. So this is where we see the opportunity that I referenced earlier. And with that backdrop, let me tell you about Verb. So we're a SaaS-based recurring revenue model software company with what our customers say are the most effective sales tools in the market today, because they utilize our proprietary interactive video technology that produces 600 to 1,200% increases in sales conversion rates, 3,300% increases in sales rep retention rates. We've had more than 1.6 million downloads of our products, more than 25,000 4.9 star ratings on the app stores. We're in 60 countries and 48 languages. And now we've just reported 6 consecutive quarters of SaaS revenue growth. Our platform is comprised of a suite of products that include Verb Live, which we're going to talk about a little more, CRM, Learn, and Verb Teams. So let me take you into our presentation. I want to start with Verb Live, which, as I said, I believe will likely be the greatest value creator for our shareholders for years to come, and it launches this month. When I talk about this difficult period of time producing the next Amazon, this is the technology that I'm talking about. True live stream in video e-commerce. It's a combination of Zoom and Shopify, and the disruptive implications of this technology and the value creation potential are virtually unlimited. So let me explain. Today, people have adopted webinars and other video streaming platforms to promote their products and services. You may have heard the term social selling. Well, we've taken that to an entirely new level. Imagine you're watching a webinar with your favorite author introducing his or her new book, or a struggling retailer pitching any other product or service. And while you're watching the live stream broadcast, the host places an interactive icon or button on the screen that says, "Buy it now." And that button then appears on the screens of all viewers, potentially thousands of viewers all over the world. The host then invites the viewers to, hey, click here to purchase his book, clicking on that button right in the video. And as and when the viewer's interest level peaks, they do it, eliminating friction from the sales process, leveraging that checkout counter at the supermarket, that innate impulse buy propensity that we all have. And if it's an ebook, they could pay for it and download it right out of the live stream broadcast. Or how about a small boutique struggling with their store closed due to COVID, using a live stream to show off the latest fashions that they would have had on display in their store, and allowing viewers that they reach through their Facebook post, as an example, to buy items right out of the video. So let me show you what we believe may be the biggest disruptor to online commerce to come out of the COVID era right now.
Recently, Bombshell Boutique partnered with Verb Live for a 30-minute live shopping experience. During this event, the host modeled a variety of pre-selected looks for the audience, who were able to ask questions, socialize, and provide feedback via the chat feature. The displayed pieces were then available for instant purchase via clickable in-video links.
This has a nice lining that goes down to about the knee area, and then it's just nice and flowy and sheer towards the bottom.
As host, you're in charge. When it comes to shopping online, we noticed a few things that made this experience truly amazing. As host, you get to control the action by adding clickable buttons on screen. You simply load your links and images that correspond with your real-time products, and voila, your engagement increases, and you can view your audience clicking the items in real time. Using Verb Live provided Bombshell Boutique with a shopping experience that far exceeded that of a typical e-commerce site. For her customers who were desperately missing the sociality of going into her store and perusing, the event provided a relaxed opportunity to connect with other shoppers and chat with friends. I think one thing that really helped how easy the whole thing was, if a shopper was interested in the product, they just clicked on the picture and could immediately purchase it. Brooke Ramirez also notes that having a real-time exclusive experience was a key factor in driving sales. It gave buyers the chance to see things they may not have found by simply browsing the website, and many logged on already prepared to make a purchase. It was just a matter of deciding what to buy, she said. The innovation of Verb Live takes live webinar to the next level, creating interactive video with live broadcasts to create a frictionless shopping experience like no other. Stay tuned to see what other live shopping experiences that'll be added to the Verb Live platform.
So that's Verb Live. And next month, we begin offering it to our client base of approximately 1.6 million people who have downloaded it as part of our other applications. We're also going to offer it as a standalone application that we're about to release in a mobile app version as well. And we've recently completed an integration of Verb Live into Salesforce. And we've just launched a joint marketing campaign with Salesforce to their existing client base. In fact, 2 weeks ago, we won the Salesforce contest as the most productive Salesforce app, beating out Adobe, among other really big names. It's offered as an add-on to their monthly Salesforce subscription. We will also complete an integration into Microsoft Outlook by the end of the year for launch in Q1. Look, there are over 1 billion Outlook users worldwide. Well, we're going to offer it as an add-on to their monthly Office 365 subscription. The pricing is being finalized now. So how many people do you think would like to click right in their Outlook toolbar, record an interactive video, and send it out through Outlook instead of typing an email, or launch into a Verb Live interactive session right out of Outlook? We've protected the IP that we've worked on for years, and with patents that have been issued and patents that are pending. Look, this is a quick presentation here, so we're not going to have time to show you all of our other products right now, but I invite you to visit verb.tech, sign up for a free trial of our Verb Teams app, because that has Verb Live built right in, so you'll get a chance to experience that. Lastly, let me leave you with this. Let me give you a glimpse into the future. We believe that we are experiencing the beginning of a convergence of entertainment content and e-commerce. The technology now exists, and we have it. Technology that will signal the end of commercial interruptions as we know it. No more annoying, irrelevant, and many times inappropriate pre-roll ads that you're forced to watch in order to enjoy your video. And no more those horrendous interruptions during the videos when they cut the video playback to insert yet another annoying commercial. Instead, all entertainment videos will be clickable and shoppable. We call it shoppable entertainment, and you're going to be hearing that term more and more as we get into 2021. The data shows that most people are watching TV shows and shopping on their mobile devices for the things that they're seeing in the shows. Most forms of video entertainment already have sponsored paid for product placements. Now those products, as they appear in the story, can be clicked and purchased while you're enjoying the content uninterrupted. Now think about the implications of that. Think about the value creation opportunity that that presents. So pay attention to what Verb delivers in 2021. It's going to be a really exciting year for ourselves and our shareholders. So thank you very much.
Thank you, Rory. We really appreciate you jumping on with us today. Really excited to have you again. You guys, the ticker is VERB, Verb Technology on the NASDAQ. Rory, thanks a lot, man. We'll hear from you soon, I'm sure.
Look forward to it. Thank you.
All right, take care. Next up, my friends, we'll keep this rolling. We're coming over with Paul Rivera, the CEO of Electromechanica Vehicles. Stock ticker is SOLO, Solo on the NASDAQ. The chat has been blowing up about this, so I look forward to this presentation. As we move Paul over, reminder to those in the chat, if you have questions for Paul, go ahead and throw them in, and we will get to them as soon as we can. There he is. I think he's coming over. And reminder to those folks in the chat too, we will be placing IR email addresses in the chat for you to reach out for any of those questions. Paul, welcome. Hey, I'm good. I'm reading your lips. You'll have to unmute yourself.
Hi, Patrick. How are you doing?
I'm good. Thank you very much. It's good to see you. I know we're tight on time here, but so I want to give you as much time as you can. You take it away.
Okay. Can you see the screen? Are you good to go?
I cannot see the screen yet.
All right. Tell me when you can.
Nothing just yet. Everybody wants one of your vehicles, Paul.
You should be able to see the screen.
Not quite yet. I can't. At least I can't see it. Nicole or anybody?
No, but it's not coming up. Can you go down to the bottom of your Zoom window and click share screen? It's a green icon.
Yeah, we've done that.
There we go. Here it comes.
There we go. So now there we are.
Okay, good. All right. Sorry about that little technical glitch there. So now I hope you can see the screen. I hope everybody can see the screen there. Can we see it?
We can.
All right. Well, first of all, thank you very, very much for having me. I really appreciate the opportunity to talk to everybody. So let's jump in and talk about Electromechanica, and let's talk about the Solo, which is really unique. So the first thing is just to share with everybody here that, you know, when you think about electric vehicles, because there's a lot of electric vehicles in the space, really important point is that we are not like everybody else that's out there, right? We are different in the fact that, first of all, we're a Canadian company. We started out of Canada. We started out of Vancouver. And secondly, if you look at our vehicle, it's quite different than anything else that you've seen as well, right? It's a three-wheeled electric vehicle, and it only has one seat. So it's a single occupant, three-wheeled electric vehicle. This is our flagship vehicle. This is called our Solo, and quite different than anything else out there in the space right now. And we're headquartered out of Vancouver. That's where our R&D facility is based. And we have also operations in Los Angeles, but our production facility is out of Chongqing, China. And so let me tell you what is really unique about what we're trying to do here. What we're trying to do is really, really capture that space that's between passenger vehicles on the one side of the spectrum and micromobility. If you think about passenger vehicles, you think about the fact that a lot of the time, 3 to 4 extra empty seats, oversized powertrain that's underutilized in a lot of cases. And it doesn't matter whether it's an electric vehicle or if it's an internal combustion engine, it's just all passenger vehicles are sized for maximum payload and maximum amount of passengers. And a lot of times you're not using that entire powertrain, and you're not using the trunk, and you're not using those 3 to 4 empty seats. And then on the other side of the spectrum, if you think about it, today there's a lot of players in the micromobility space, which is all of these little electric scooters, a lot of little electric bikes. And those are great to get you in that last mile served. Those get you from your bus station, your train station to your workplace or vice versa. But not a lot of safety and protection features. The people are exposed, and of course, very limited range. Well, this is all about the space in between. This is all about everything you do when you're by yourself and when you're driving solo. This is about going to the grocery store by yourself. This is about when you go visit friends or when you go to the gym or when you're commuting. And so the vehicle was originally created for that purpose, and it was to solve a lot of the urban driving challenges about driving solo. And that's kind of what was originally meant for the vehicle. But then as time evolved, a lot of really cool things have happened. So we've been around since 2015, and we're not talking to you from a PowerPoint presentation. We've actually, created a lot of vehicles. We started out in Canada, like I said, and we've done a lot of engineering, and we built 64 prototypes in Canada. And then between 2015 and 2017, did all the initial engineering. And then from about 2017 through 2018, we started our next evolution of the product, and we signed on with a partner out of China, who's our manufacturing partner. And our manufacturing partner, who's based in China, is a company called Zhongchen Industrial Group, and they are one of the largest motorcycle companies in the world. They have more than 50 joint ventures with some of the biggest brands in the world, very well-known motorcycle companies around the world. And we leveraged their expertise for production, their expertise for supply chain. And with them, we've been able to advance the design of our vehicle and advance the engineering. And they also gave us space, and we were able to create a 200,000 square foot production facility over there. And then we also uplisted to the NASDAQ in that time period as well. So in 2018, we uplisted to the NASDAQ, and here we are. So in August of 2020, we began production of the vehicle. And today, I'm pleased to tell you that we have now, and I'll fast forward here for a second, started, and then I'll come back, started rolling out our retail footprint here in the United States, in the West Coast of the United States. And we're up to 10 retail locations that look similar to what you see here on the slideshow. And, we originally created the vehicle, like I said, with the consumer in mind. And it's a direct-to-consumer model where somebody can buy this vehicle for $18,500, and they can go into a shopping mall. This happens to be at the Westfield in Century City near Beverly Hills, and they can look at the vehicle and they can learn about the vehicle. The vehicle has a 100-mile range, a top speed of 80 miles per hour. It has front and rear crumple zones. It has triple side impact protection. It has a roll bar inside. It has energy transfer underneath the vehicle. It has torque limiting stability control. And then inside the vehicle, it has a lot of the same creature comforts that you're used to. It has Bluetooth. It has a heated seat. It has heating and air conditioning, and it's pretty integrated. But then what's happened as time has gone on is that although we created it for the retail space originally, we ultimately saw a huge opportunity in these other two categories on the left-hand side of this slide here. We realized that with very, very minor modifications, we could really offer something unique to fleets and utilities and to commercial applications. And so if you look at that middle picture here on this slide, and you take that hatchback off and you put a cargo box on, a uniquely styled cargo box, we now have a very cool, stylish vehicle for pizza delivery and for fast food delivery and small parcel and post, and companies that are trying to do tech work, like small technicians that are going out to homes and businesses. And because the vehicle can be recharged in 4 hours and has a great 100-mile range, it's perfect for those kinds of applications. And if you think about the number of fleets and commercial applications worldwide that just fit this kind of single occupancy application, this is a home run for us. And then in the last category, the idea of being able to share the vehicle. If you think about walking up to the vehicle and taking this vehicle and putting it onto a charging infrastructure and working out agreements with different charging infrastructures and having the ability to walk up with your iPhone or your Android and unlocking the vehicle and being able to take the vehicle from one part of a major city to another part of a major city, and people who don't want to own vehicles and use the vehicle for short durations or for a day or for a few hours, that is where the other part of our ecosystem comes into play. So the three parts of our ecosystem are, of course, the retail space, and that's where we started. Fleets, utility, delivery, and then sharing the vehicles. And I can just tell you that we're in the middle of course, producing in China and sending the vehicles across right now and just rolling out our retail footprint. But we are also just on the verge of announcing where our US assembly operation will be. We're down to 2 locations, potentially the Nashville, Tennessee area and the Phoenix, Arizona area. So we're just deciding between those 2 locations. And we're just super, super excited about what we have here. We are not like any other EV company out there because we're not trying to put a premium 4-passenger sedan or crossover electric vehicle on the road at a very high price point. This is a single occupant flagship vehicle that we will be putting on the road in a 3-part ecosystem that has a purpose of solving a lot of urban driving challenges. And that is what makes us so different, with a completely different value proposition than any other EV company. And all I can say is just follow us, because our journey is just beginning. So I really appreciate the opportunity to talk to everybody, and thank you, Patrick.
My pleasure, Paul. Thank you for coming on. We appreciate it. Guys, again, the ticker is SOLO, SOLO. The chat's blowing up. Paul, when can we buy them? All kinds of stuff. Anything you want to say to these?
Yeah, you can place the orders now. I mean, we're starting to roll out on the West Coast right now. The pre-order list is fairly long. So if you're in the states of California, Oregon, Arizona, even Washington, then you can go online. You can place if you're a consumer and you're interested, you can place a pre-order today, but you'll be waiting a little while just because there's a pretty long pre-order list right now. So you're looking at probably at least a 6 to 9 month wait before you'll see it. It's quite a while. But thanks again, Patrick. I really appreciate the opportunity.
My pleasure. Thank you, Paul. We'll see you again soon, I'm sure.
Okay, take care. Bye.
All right. So guys, thank you. Thanks so much for all the engagement in the chat. This is really exciting. I know that we'll have another opportunity to talk to Paul and the SOLO team. So keep your questions coming. We'll deliver them as soon as we can. Next up, let's keep this rolling. We've got Justin Schreiber from Conversion Labs. I see that he's over. So Justin, just flip your camera on and unmute your mic. The ticker here is CVLB. CVLB. Conversion Labs. Pretty cool company. So many good questions in the chat too. You guys keep it coming. This is very helpful for us, and obviously the companies too. They want to engage with you, so make sure that you're throwing that stuff in there. Do we have Justin? All right, I see you. Just go ahead and turn your. There we go. Can you hear me?
Yep, I can hear you.
Awesome, man. Welcome.
Thank you.
We'll let you attack it. Go ahead.
All right, great. Okay, hi, nice to meet everyone. My name is Justin Schreiber. I'm the chairman, CEO, one of the co-founders, and up until the last financing that we did, one of the largest direct investor in Conversion Labs. A few things here from the attorneys. During the presentation, I'll be making some forward-looking statements. They may be optimistic. Please make sure you read the slide thoroughly before you invest in the company. So Conversion Labs. Conversion Labs is a rapidly growing telemedicine company. We call it direct-to-consumer telemedicine. We have a portfolio of brands in very large markets, men's health, hair loss, erectile dysfunction, dermatology, that basically combine, virtual medical treatment with prescription medications and unique over-the-counter products. We have a nationwide network of licensed physicians. Right now, we're treating patients in 48 states virtually. We also have a pharmacy that can dispense medication to all 50 states. And our business model is simple. We run an ad online, on TV, focused on men's health, hair loss, dermatology. We acquire a patient. The patient sees one of our doctors, receives treatment virtually from the comfort of their own home. If appropriate, one of our physicians will prescribe a medication. We also have proprietary over-the-counter products in many of these areas that we offer alongside of prescription medications. Everything is shipped to the patient's home. It's a very convenient model. It's also discreet. And most importantly for investors, it's a great business model. It's 100% of our telemedicine customers are on subscription. The unit economics are very attractive. So in addition to doing a lot of good things for increasing access and providing quality healthcare to people across the country, economically, it's a very strong business model. We also have a portfolio company that we invested in, in 2018 that's has a software as a service business, which I'll touch on briefly, but it's rapidly growing and very valuable asset in the portfolio. So I think most of you probably know this, but the telemedicine and online pharmacy opportunity is massive. The telemedicine opportunity is estimated to be in the $250 billion per year range. And if you look at the online pharmacy opportunity, it's another $400, $500, $600 billion, depending on who you talk to. So if you take a look at one of the better known companies in the space that went public, which is GoodRx, they estimate the total addressable market to be $1 trillion, which if there's one takeaway from this presentation, remember that this whole telemedicine opportunity, inclusive of the online pharmacy component, is $1 trillion market. It's a market, very comparable in size to like the search engine market. And we are in the very, very early days, of telemedicine. So, great market opportunity. And we think that Conversion Labs is very well positioned to be a leader in this space. Again, going back to what's unique about our company, there's a couple of key takeaways here. I mean, we've built out a telemedicine infrastructure, that combines physician treatment, state licensed physicians, treatment across, all 50 states. We also have a pharmacy infrastructure through a third party that enables us to, when appropriate, dispense and ship prescription medications directly to our patients. We have incredible relationships with Facebook and Google that we've built, over many years. And look, one of the most unique thing about Conversion Labs is our ability, our ability on the acquisition side. We have an incredible team and an incredible technology infrastructure, on the marketing and patient acquisition side of things. And, I believe that Conversion Labs is better than anybody in the space, even our larger peers, at acquiring customers, doing that, cost effectively and intelligently. And that's what produces the incredibly strong unit economics, that I think will allow us to accomplish, some very incredible things, with minimal dilution to our shareholders, and with much less capital, than many of our peers have required, to get to where they're at today. Telemedicine growing, all the trends, especially post-COVID, indicate that, telemedicine is here to stay. We're not seeing any slowdown in our telemedicine business post the pandemic. Quite the opposite. It continues to grow on a month-over-month basis. It's convenient. It's, I believe provides it results in better care for patients. It greatly increases access to care. It drives down cost. I mean, it is going to be a big component of the healthcare system of the future. We have we believe that it was very important to basically build an end-to-end system here. So we have relied on some third parties for some of our physician treatment and our consultations and our pharmacy infrastructure, but all of the core components of our direct-to-consumer telemedicine business, we own. We do it all, and this diagram just kind of illustrates that life cycle, and starting with patient acquisition, shipping medication and over-the-counter products, prescription follow-up consultations, follow-up care, over-the-counter offerings, etc. We've seen incredible growth. I've said this publicly, but Conversion Labs is still on track to do more in Q4 2020 than we did all of last year. I confirmed that with our CFO this morning. So couldn't be happier with the growth numbers across the board. And really, we're seeing growth, across all of our brands, including our software as a service business that, consolidates, with the parent company revenue. Another breakdown here of the telemedicine and SaaS side of the business, but I think the important takeaway here, the most rapidly growing component of the business is our telemedicine offering. Even our legacy brands like Shapiro MD, which have a proprietary over-the-counter product portfolio, we are going to be making a major push in the telemedicine space for hair loss for both men and women, and we'll be launching that in the first quarter, maybe even some testing this quarter. But it's going to be game changing. It's going to be different than anybody else has offered nationally. And it's going to, really address like a big unmet need, especially for women that really haven't. Many women, it's a larger market than male hair loss, and many women have not had access to the right, to the right medical care for this issue. Veritas MD is a very important part of the business. Stay tuned in the next couple of days, but for some big updates on this. But we acquired this platform earlier this year for some options and cash. It is an incredible end-to-end cloud-based platform that enables us to, enables our physicians to treat patients using audio and video, all the scheduling capabilities, all of the EMR capabilities, e-prescribing, it is an end-to-end telehealth platform that we've customized for the direct-to-consumer telemedicine world, but has every capability that we'll ever need to provide incredible care in the space, and of course scale the business. RexMD is our brand that is focused on men's health. Right now, it's primarily erectile dysfunction. We've seen incredible growth from RexMD this year. We're launching, as you'll see on the next slide, these are the current offerings that we have under RexMD. And then this is, we plan to roll out a lot of additional treatments, weight loss, allergies, hair loss, primary care, other sexually transmitted conditions like herpes and cold sores. We're also looking at some other interesting spaces like the IBS space, and also mental health, which we plan to expand into in the very near future. Shapiro MD is our hair loss product line, based on 15 years of, clinical study, and some really strong IP. This has been an incredible growth driver for the business. It's differentiated, it works. We have very happy male and female customers, continue to invest heavily in this. And like I said, we're going to be launching a compounded drug offering, around this, that will basically be sold in conjunction with, our proprietary over-the-counter product line. We have 2 influencers lined up, 2 female influencers that have, verbally committed to get behind this. Both struggled with hair loss, both used the product with amazing results, incredibly genuine. And we believe this is going to be just completely game-changing for the brand. And that's something that you're going to see in Q1 of 2021. Some other options as well, like we believe that, beyond hair loss, we're looking into offering diagnostic products and treatments for thyroid disorders, offering Latisse for eyelash growth. And then obviously there's a big connection here between, for the teledermatology world, right, and OTC skincare, which is something that we'll also be offering to our patients through the Shapiro MD brand. SOSRX is a brand that we launched, planned to launch right before COVID. We put it on hold for regulatory reasons. We didn't want to confuse patients about whether it was appropriate for treating COVID-19. So, in the interest, out of an abundance of caution, we've put this on hold, and it's something that, likely will relaunch in 2021. PDF Simply, something many of you may not know, it's a really great asset in the portfolio. I mean, it's grown from $300,000 a month in revenue this year, approximately, to, I think it's going to end the year at somewhere in the ballpark of $1.5 million a month. We expect this to be at a $20 to $30 million run rate, the first half of 2021. It's got incredible unit economics. It's a simple business. $1 in, yields $4 out or more. We're continuing to improve the technology. We also will be announcing in the next couple of weeks that we've increased our ownership from 51%, to approximately 85% of PDF Simply. So incredibly valuable asset. DocuSign trades at around 40 times trailing 12 months revenue. So you can do the math. If PDF Simply is at a $25 to $30 million a year run rate by the second quarter of 2021, obviously it probably doesn't deserve a 40x multiple on that, but it has incredible upside. We're making, the PDF is making big investments in their technology. They're operating right about cash flow break even. And, it's an exciting asset in our portfolio that will likely spin out or monetize in some way in 2021. I mean, key takeaways, we're going to continue to build this business. We're anticipating to do somewhere in the $40 million, range for revenue, net sales in this year. We've got all of our infrastructure for telehealth done. Our plan is to continue to grow, the men's health, women's health, hair loss, and teledermatology offerings. into at least to $150-200 million a year run rate, in the next 2 years. I believe that's very achievable. We're going to continue to put up incredible growth numbers throughout 2021. You can count on us for that. And then beyond that, I think there's some very interesting opportunities that have already started to show up in the traditional healthcare world. So we have pharma companies that are talking to us that have branded products that they've invested in large amounts of money in getting approved, very large markets that have now started to approach us because of our patient acquisition capabilities about joint ventures and how we can partnerships where we can have very meaningful revenue shares of revenue that we would create for these pharmaceutical companies through a direct to patient offering and using our infrastructure that we've built. So big business in all of these hair loss, men's and women's health, mental health, weight loss, all those categories. First priority, continue to scale that, show amazing unit economics. Beyond that, if you want to think about what's beyond that, it's most of the traditional healthcare product world. I mean, they don't have the capability that we have. It's very valuable, and we think that we're positioned well to be a major player there. Thanks for everybody's time. Appreciate you tuning in for our presentation. If you have any questions, you can reach out to Ron Both. He's a very nice guy. Or my email's here as well. You're welcome to send me an email and schedule a time to chat.
Awesome, Justin. Thank you so much. We really appreciate you coming on. You guys that are watching, that's Justin at conversionlabs.com. And also Ron and Grant, you can reach at investors@conversionlabs.com. Justin, thank you, man. CVLB, again, is the ticker. And I'm sure we'll hear more from you again soon.
Thank you very much.
All right, take care.
Yep, you too.
Thank you. Thank you. We'll keep this moving, my friends. Next up, we're bringing over Richard Stockton. Richard Stockton is the CEO of Braemar Hotels and Resorts. It's a REIT on the NYSE, BHR. BHR is that ticker. Richard, how are you?
I'm good. How you doing?
Great, man. You had a great panel earlier. Thanks for joining us there. You guys have a cool story. I would imagine things are crazy and fun in your world right now. So I'll let you kick this thing off.
Yeah, thank you. I guess I'll start by sharing my screen. Is that the program?
I think so. Go ahead. I'll let you know when it's up.
I'll do that. Let me go to.
Okay, we got it.
Screen mode. You got it?
Yep.
Okay, let's get into it. So, as Patrick said, that Braemar Hotels and Resorts is a publicly listed REIT that specializes in owning luxury hotels and resorts. I've been the CEO now for about 4 years after spending the majority of my career at Morgan Stanley prior to this. But let me talk to you about our strategic initiatives, and they're all related to the current COVID-19 pandemic. The pandemic has affected the lodging industry significantly. You've seen all the headlines. It's resulted in, at one point, the closure of 11 out of our 13 hotels. We went through a process to reopen those hotels and had them all reopened by October 1st and are now marching forward into the recovery phase. So our objectives these days are to, first and foremost, continue to conserve liquidity. So we went into the pandemic with a significant amount of cash, which has always been our policy. And we had also an undrawn credit facility that's enabled us to store up our resources and has made it very clear that we will come out of this in very good shape over the next coming months when a vaccine is ultimately disseminated. We're managing our balance sheet. That's a combination of liquidity, but also our maturities, working with our lenders. We did enter into a number of forbearance agreements that lasted for 6 months. So we got some relief there. And that was all we really needed to get to where we are today, which is in a much improved position than, say, last April and May. And so our focus now is returning to profitability. We are positive, just above kind of break even at the hotel level in terms of profitability. Our next stop is corporate level profitability, which we're expecting to hit in the middle of next year. And then from there, continue to move forward and grow the portfolio. give you some of our operating statistics from the third quarter. You can see actually our average daily rate of our properties was actually up year over year, 7%. So what we've seen in this crisis is that we've been able to grow rate, although our occupancy is down pretty significantly. As an investor, however, I think that represents opportunity. Our shares and our share price has obviously been adversely affected. We're down probably 50%. It's approximately 50% year to date. And it's very clear that we're now on a path to recovery, and our share price is following suit. Let me give you just some more details on our portfolio. So here we have an outline of our portfolio. You can see we're geographically diversified across many markets that are high-rated markets. 2 properties in Napa Valley, Ritz-Carlton in Lake Tahoe. We've got the Capitol Hilton just down the street from the White House in Washington, D.C. The Ritz-Carlton in Sarasota. That's the best hotel in Sarasota. The Ritz-Carlton in St. Thomas, the only luxury hotel in the Virgin Islands. Pier House Resort in Key West. Park Hyatt Beaver Creek, that's the best hotel in Beaver Creek Village. Hilton La Jolla Torrey Pines, that's right on the 18th hole of the famous Torrey Pines golf course. So you can see our properties are Class A, prime. This is 100% of the properties. We don't have any properties that don't fit that description. And in many cases, they are the very best properties in their respective markets. And, we focused on luxury, and we focused on these unique, irreplaceable destinations because over time it's been proven that they will grow their revenue per available room more quickly than other properties. And so you can look at our company as really a growth play within the sector. So it's less about what a traditional REIT would do, which is generate income against long-term leases. And this is much more about growing asset value with irreplaceable luxury hotels. This is an overview of our portfolio in further detail. You can see we have 8 of our properties that we classify as leisure properties and 5 that are classified as urban. And the leisure properties are recovering much more quickly than our urban properties. It will take a little bit of time for the urban properties to come back based on rollout of a vaccine, and then we'll get people doing more business trips and meetings, and then we'll have more group business coming to those properties as well. So really the first leg of the recovery is the leisure portfolio, which is already underway, and we're expecting the second leg, which is the urban portfolio, to kick in probably around second or third quarter of next year. You can see our EBITDA contribution by various metrics. You can see the vast majority of our hotel EBITDA comes from the Ritz-Carlton brand. It's about 50% on a trailing 12 months basis. And 80% is coming from luxury. A couple of our hotels are classified as upper upscale, even though they're Class A properties, very well located. Technically not luxury, but we have 80% of our hotel EBITDA coming from the luxury segment. Here we've broken down, you can see the performance and the impact of the COVID-19 pandemic on the luxury portfolio and the urban properties, and then as a whole. And you can see the occupancy, we're averaging about 50% on our resorts, and then we've got about 20% on our urban properties. And as far as average daily rate is concerned, our resorts are about where they were in 2019, and our urban properties are down significantly. And again, we're expecting that to turn around, but only once we get the vaccine disseminated. One of the good things that's a silver lining, if you will, from this recent crisis is that we see supply of hotel rooms going down dramatically. This is great for us as a hotel owner because that means we'll have much less competition going forward. And so within the next 12 months, we've already seen additional supply forecast drop from 2.3% to 1.5%. We're expecting that the pipeline will continue to dry up over the next 24 months. It's just that many of those projects have not yet been canceled. We have excellent liquidity. If you look at our balance sheet, at the last quarter, we reported $88 million of cash available, an additional $34 million, $35 million of restricted cash that is cash set aside for improvements to the properties. So that total cash of $123 million compares to a monthly utilization of about $5 million at the moment. And we're working each month to improve that. And we have seen sequential improvement and reduction in cash burn even since this has been reported. So we'll find ourselves in that cash flow break-even position in 2021. And then from there, it's about generating cash flow for growth. Our leverage strategy, we focus on 45% net debt to gross assets. We've always held a 10% of our gross debt balance as cash on the balance sheet, so always maintain high levels of liquidity. And then we always use non-recourse debt so that the debt is mortgage loans at the properties rather than putting the company itself at risk. And we find that that's a great way to manage our exposure. In terms of debt maturities, again, still on the balance sheet, we don't have any debt maturities until 2022. So we have a sufficient runway for the recovery to kick in. In 2022, we have about 20% of our debt maturing, so still not a significant amount, really. We currently have a weighted average interest rate on our debt of 2.5%, which is very low. And that's all based on our strategy of utilizing floating rate debt. So as interest rates have come down, along with the economic contraction, so has our cost of debt, and that's resulted in significant interest expense savings for us throughout this year. So as we look as we look forward in terms of strategic initiatives positioning us, we've invested heavily into our portfolio over the last few years. We improved the beach at our Ritz-Carlton Sarasota. We did a conversion, 2 conversions of the Notary Hotel to an Autograph, completed in 2019. We just finished the conversion of the Clancy to an Autograph this year. We've renovated the lobby at the Park Hyatt Beaver Creek. We've built a presidential villa at our Bardessono property in Napa Valley. And we've did a $100 million complete renovation of our Ritz-Carlton St. Thomas property, which is absolutely gorgeous, brand new, in addition to adding some additional amenities such as cabanas, family pool, and some other things that guests are already really enjoying. So I think our portfolio is in excellent condition and really poised to take a lot of market share as the recovery kicks in over the next few months. You know, one of the things that's important I'd like to point out is our alignment of interest, amongst the management team members. And, we're owners and we own 13% of the publicly listed company. So we come into work thinking like owners and acting like owners. We're here to drive shareholder value, and that's what we're constantly challenging ourselves to do. So it is amongst the highest of any of the lodging REITs, and so we're driven by creating shareholder value, both in terms of when looking at dividends and dividend policy, as well as driving the share price to the extent we can. So that is a quick overview of the company. The key takeaways again, we are going to come out of this crisis in very good condition. We've been conserving our liquidity and managing our balance sheet on a path to profitability next year. Again, our share price has really been adversely impacted, and we know the recovery is on the way, and we expect the share price to reflect that as further developments come to light over the coming 6 months.
All right. Thank you, Richard. That was fantastic. Anyone in chat? We're a little bit ahead of time, actually. Anyone in chat have any questions for Richard? All right, guys. Richard, where can folks reach you if they want to ask some questions down the line?
Well, they can email me. It's probably the best way to reach me. And it's rstockton@bhrreit.com. rstockton@bhrreit.com. There is a lot more information on our website, which is bhrreit.com. And it also includes a number of videos that we record from time to time. Each quarter, we try to showcase one of our properties. And so you can watch a video of me giving you a walkthrough of our most exciting projects. And so we really have a lot to see there if people want to find out more.
Yeah, I mean, that's a great thing for a REIT is get a good look at some of the properties they are invested in. So make sure you guys go to that website. Richard, thank you so much for joining us today.
No, I appreciate the time. Thanks for having me today.
All right, you have a good end of year. And we will get on to our next guest here today if they are ready. Next up, guys, we have David McNally. David McNally is with Titan Medical, TMDI, NASDAQ, TMDI. I'm going to put that in chat for you. And I will just play it cool while I wait for... Hal, you're late on the question. He already took off. Make sure you email him at rstockton@bhreit.com, bhreit.com, and you can get that question over to him, Hal. David, I see you. How are you doing?
Doing well, thank you. It's a pleasure to be here.
It's great to have you, sir. I will step out of your way and let you begin your presentation. If you have any questions, let me know.
All right, I'm going to share screen and pull up the presentation here. All right, and it looks like we have the technology. We're live on the screen, just to confirm.
Correct.
Very good. I'm David McNally, President, CEO, and Chairman of Titan Medical, a Canadian domiciled technology company that is advancing robotic surgery. We're listed on the TSX under the symbol TMD and under NASDAQ under the symbol TMDI. I'm thrilled to be here to present our vision for single access surgery. With my enthusiasm today, I will be making forward-looking statements that involve risks and uncertainties that are disclosed in our documents filed on SEDAR and the SEC websites. Titan Medical is focused on robotic-assisted technologies, and we're developing a versatile single-access surgical platform intended to perform abdominal surgeries through a single access point. Just to repeat, our system is designed to deliver the benefits of precision and dexterity in surgery, including illumination and cameras that provide a view inside the body through a single incision. We're designing the system for clinical performance, but also ease of use by the surgeons and operating room efficiency, because we know we have to address all the stakeholders involved in surgery. That includes the economics of the hospital, up to the C-suite, potential benefits for patients, of course, being paramount. That is reducing trauma, delivering virtually scarless surgery, and ultimately, we believe we can deliver faster recovery times with this technology. Despite the COVID-19 pandemic.
David, I want to step in really quick. It looks like your slides are not advancing.
Oh, that's interesting. So they're advancing on my screen and not on the Benzinga screen.
It would seem that we are not seeing that in Zoom. Right now, we just see your PowerPoint presentation open in the editor view.
All right, let me see. I'm going to back up then. And I'm going to, let's see if I advance in this manner. Any help? No?
You might be, try unsharing your screen and then resharing.
Okay, let's try that. Thank you for calling that out. All right, let's see.
So you're going to want to go to the bottom of your Zoom window and you will see that share screen icon. Just go ahead and click that.
Okay, so it says you are screen sharing. I'll stop share. Okay. And then I'm going to share again.
Yep, I think you just had the wrong app selected for sharing. You're just going to want to share your whole screen.
Share the whole screen. Let's try this.
There we go. Now we see the whole presentation.
Okay.
So if you, now when you present, go ahead and click it.
Okay. First slide.
Click a swap displays there on the top left.
Okay, okay, here we go. Swap displays. Need to escape.
Boom, there we go. Perfect. Perfect.
All right, and it's showing just fine in this regard.
Well, it looks like we've closed out of it.
Yeah, so let me go back in. Strangely. Are we back?
Yep, we're back.
And are we on forward-looking statements?
Yes, we are.
Advance to the first slide?
Yep.
Okay, then I'm going to advance, and we should be on the Medtronic Development and License Agreement slide.
We are.
Very good. Thank you. So as I was describing, this has been a tremendously productive year for Titan Medical. Earlier this year, we entered into development and license agreements with one of the world's largest medical device companies and most highly regarded companies, Medtronic. This leveraged about a third of our intellectual property portfolio with an initial license payment of $10 million. And then we proceeded to execute under the development and license agreements, securing an additional $10 million payment in October. We are now on track to achieve the payouts associated with 2 more milestones in 2021. We expect to receive an additional $21 million for execution under those milestones. Now, the beauty of these agreements is that it aligns the future visions for robotic surgical technology of Medtronic and Titan Medical, yet Titan maintains the intellectual property rights necessary to independently develop our system and commercialize our standalone single access robotic technology. In this year, when many companies have been letting people go, we have been hiring in our Titan Medical USA headquarters in Chapel Hill, North Carolina, building out a world-class team of developers that encompass a broad array of technologies from electromechanical engineering to software development, and they are advancing the development of our Enos single access system. Our USA subsidiary is the operational headquarters of the company, yet we remain Canadian domiciled. As I mentioned, we're actively recruiting, and we continue to do so as we build out our technical team in Chapel Hill, which happens to be a technology hub for robotic surgery. We're also continuing to grow our intellectual property portfolio, which now stands at 150 patents and patents pending, and that is a global portfolio. Stepping back for a moment to position us in the world of surgery, abdominal surgery, of course, has existed for literally millennia. Over the past few decades, surgery has evolved to reduce trauma to the body. Open surgery is well known. It has broad application, yet it requires significant hospital stay and recovery time. And there are risks associated with adverse events, associated with intervention on that scale. We've seen an evolution from open surgery to minimally invasive surgery, often called laparoscopic surgery, a form of minimally invasive surgery that has increased over the past 25 years. And indeed, that has reduced hospitalization time, reduced risk of adverse events, yet it requires highly skilled surgeons to perform these procedures. If you can imagine performing procedures with straight devices requires the surgeon to think in reverse as they move their hand with these straight implements. The implement actually moves in the opposite direction of the surgeon's hand. Hence the arrival of multi-port robotic surgery, which has provided the opportunity for surgeons to have a more natural interface with the tools, with the surgical tools. And it expands upon the benefits of minimally invasive surgery, particularly by providing a close-up, steady, magnified view inside the body, and also being able to improve upon the movement of the instruments by reducing tremor, for instance. Now, multi-port robotic surgery replicates laparoscopic surgery, so it requires multiple access points. Now, Titan Medical sees the future as single access robotic surgery. That is performing surgery through a single access point in the body. To do so has some very challenging technical attributes of the technology that have to be delivered. That is, we are delivering the ability to triangulate on the tissue and provide a camera and light source all through a single incision. The great news is that single access surgery has already been introduced to the market with an adaptation of technology that evolved from multi-port robotic surgery. So the market leader today has launched a single port surgical system, and we're delighted to see that the adoption is continuing with that technology. We believe that we have a unique solution that builds upon that vision. Our technology is differentiated in its simplicity of implementation. For instance, our system features an open display where the surgeon has the ability to view a high definition, three-dimensional view inside the patient at the target anatomy, yet provide situational awareness in the operating room to be able to see what is going on over at the patient cart. The ergonomics of the workstation are designed for comfort for surgeons of any gender and ethnicity and size to be able to operate the system. Our purposeful design is focused on improving patient care and recovery with single access surgery, yet clinical capabilities that don't require the surgeon to compromise on their ability to manipulate tissue. We're also designing our system for operating room efficiency, so it's easy to set up. And it's designed for hospital economics to be cost effective as a solution. With a single incision made through the umbilicus, our system has the ability to be near scarless in result, also reducing trauma to the body, of course. Our multi-articulating technology, for which we've already received patent coverage, provides the ability to triangulate on the target tissue, yet we have a reusable instrument model that allows us to keep costs down. And the small footprint of the system provides for the ability of the system to be utilized in multiple operating rooms. From a system overview perspective, we've developed a versatile single access robotic surgery solution that is designed to overcome multi-port robotic surgery limitations and complexity. It has a smaller operating room footprint than existing systems, and we've engineered the system for performance, efficiency, and cost effectiveness. We believe that with this solution, we can address the needs not only of large hospitals, teaching hospitals, but also smaller hospitals and ambulatory surgery centers where we see the market moving. I note that our system has not yet been cleared for marketing by any regulatory authorities, and we anticipate endeavoring that process in the next couple of years. The workstation of our system has developed to be open, unobtrusive, providing a high definition display of the target anatomy. The system is configurable to meet the needs of the surgeon to be comfortable even for longer procedures. And we've developed the system to be maneuverable within the operating room or to be moved to another operating room. We even have intellectual property coverage of the natural multi-articulated handle interface that interfaces with the surgeon. So we've really paid a lot of attention to the ergonomics of the system and thought ahead to integrating software for simulation training for accreditation of surgeons. The second component of the system is the patient cart. This is the part of the system that is used to deliver the instruments and camera systems and light source into the body of the patient. With a single arm configuration, there are no external moving parts. So this facilitates simple setup and assistant-friendly surgery. So the bedside assistant is unencumbered. It's easy to load and unload the instruments through a detachable camera insertion tube, which has a two-dimensional high-definition camera that allows for visualization upon entry of the body, visualization of the target anatomy before the instruments and the endoscopic camera are delivered, and also acts as a backup camera during surgery should the endoscopic camera become soiled during surgery. With a single access point, we also enable swift multi-quadrant positioning. That's moving to different areas of the anatomy with a simple move of the central unit. There's minimal cable management in the operating room to keep things simple. And our instruments and steerable high definition camera delivered through an insertion tube of 25mm diameter. Again, the patient cart is also maneuverable between operating rooms.
Hey, David, I just want to step in and let you know you've got about 30 seconds left.
All right. So our multi-articulated instruments are designed to deliver the needs of surgical procedures with respect to dexterity and strength of motion. As I mentioned, we have a large and growing intellectual property portfolio. Our system has been deployed in preclinical procedures from a wide variety of procedures led and performed by some of the world's renowned minimally invasive surgeons. There are peer-reviewed abstracts and manuscripts that have been published. And really highlights of Titan Medical are that we have a novel clinical paradigm. We already have preclinical feedback that indicates that the system works, a robust IP portfolio that's validated by one of the world's largest medical device companies. And we believe we have a disruptive technology that is entering a market environment that's receptive to robotic surgery and moving to procedures that require less and less invasive interaction and also allow us to deliver on the promise of reduced trauma and faster recovery times. I thank you and urge our audience to go to our website, titanmedicalinc.com, to learn more. And you may email us at investors@titanmedicalinc.com.
Fantastic. Thank you so much, David, for being with us today.
It has been a pleasure. Thank you.
All right, guys, that's ticker TMDI on NASDAQ. TMDI, dropping that in the chat for you. Next up, we have VolitionRx Limited. That's ticker VNRX. And speaking with us today is Scott Powell. Scott, I see you and I hear you. How are we doing?
I'm doing very well. How are you, Neil?
I am doing splendidly. Great to have you. I will get out of your way and let you do your thing.
I have 15 minutes. Is that correct?
That is correct, sir.
Great. Okay. Thank you, Neil. Thanks to Benzinga for having VolitionRx present today at the Small Cap Conference. I'm Scott Powell. I'm the head of investor relations for VolitionRx, and I'm the U.S. Chief Financial Officer. I will share my screen so you might see PowerPoint. Let me just close the other applications, and there we are. Hopefully all of you can see the Volition slide deck on your screen.
Yep.
Great. Okay, moving to slide 2, the obligatory forward-looking statements and disclaimers. So I point you all to this. A little bit about Volition. Our mission is simple. We want to save lives, as you can see from this slide. What we mean by that is we are a diagnostics company developing blood tests to screen for a variety of diseases, primarily in the oncology space. We are also beginning to look at the application of our technology to respiratory ailments. What makes us different from a lot of other diagnostics companies is the modality. We are working exclusively in blood. Blood is a preferable modality for which to perform diagnostic tests because it tends to be inexpensive. People tend to regularly comply with giving blood samples, tends to be fairly easy, and there really are no negative side effects from giving blood other than maybe a sore arm, as opposed to other diagnostic tests that can have serious side effects and complications. Moving to the next slide, you can see a photo of our primary R&D facility in Belgium. It's about 40 kilometers south of Brussels. 20,000 square foot office building and R&D facility. We employ about 35 scientists and support staff here at this facility. A few weeks ago, we announced the acquisition of another R&D facility about a kilometer down the road from this facility called Silver One. And that's primarily to allow us to ramp up production for our veterinary blood test. It's our first product that we commercialized just over a week ago, and we are currently selling this blood test, and I'll talk about that in a few minutes. We also have offices in London, Austin, Texas, and Singapore. Key financials slide. You can see our ticker is VNRX on the NYSE American Stock Exchange. Our market cap has ranged from around the $150 to $200 million range over the past year or two. 52-week range, you can see there, monthly burn about 1.7 million. Cash on hand at the end of Q3, we finished with 21 million in cash on hand. Gives us enough cash for a little over a year or about a year. We have a number of ways to bring cash into the company in 2021, primarily being the revenue we expect to generate from our first product, as I mentioned, that we launched 1 week ago. And I will skip over some of the slides here and talk about that product, since I think that's probably what most of the audience is most interested in learning about. So bear with me while I just move to our veterinary slides. And this is our Nu-Q Vet Cancer Screening Test. This is a blood test for canines that we developed with Texas A&M University. You can see at the bottom there, their veterinary medicine and biomedical sciences department. Texas A&M came to us a little over a year ago and was curious if our technology would have utility in animal health as well as in human health. And previously, we had just demonstrated utility in human health. We sent a number of our biomarkers over to Texas A&M to their veterinary school. They got some really good results in some small studies. They decided that the results they were getting in detecting a variety of common canine cancers was good enough to warrant moving forward. So in October of 2019, we formed a wholly owned subsidiary called Volition Veterinary Diagnostics Development, LLC. We granted Texas A&M University 12.5% equity ownership in our wholly owned subsidiary. In return, Texas A&M in 2019 and 2020 commenced a number of clinical studies looking at how our technology performed in terms of detecting a variety of cancers in canines. And if you look at slide 19 here, you can see the performance of our blood test in 2 common canine cancers. On the left, you can see our results from our clinical study at Texas A&M in canine lymphoma. And on the right, you can see our clinical results in detecting hemangiosarcoma. Hemangiosarcoma is the most common cancer in canines. It accounts for 20 to 25% of all cancers, so it is the most common. And canine lymphoma accounts for about 7 to 10%. So our blood test between these 2 cancers detects about 30% of all canine cancers. The results on the left, you can see from canine lymphoma, we had an area under the curve of 87.3%, and we broke out our sensitivity and specificity. We pegged our specificity, which is our false positive rate, at 100%, meaning we had 0 false positives. So we did not identify any canine as having lymphoma that did not have it. And our sensitivity came out at 74%. That means we accurately identified 74%, or about 3/4 of canines that had canine lymphoma. Very, very good results for a blood test. On the right, the results were even more impressive in hemangiosarcoma, which again is the most common canine cancer, with an area under the curve of over 97%. We pegged our specificity again at 100% so that there were no false positives, and we accurately detected 89% of all canines with hemangiosarcoma. So extraordinarily accurate test for hemangiosarcoma, very accurate for lymphoma. The way that this is planned to roll out, you can see here on the prior slide. So what we have is a blood test that detects about 1/3 of all canine cancers. Now, certain breeds of canine are predisposed to certain cancer types. So for instance, Labradors are highly predisposed to hemangiosarcoma. So if you have a Labrador, if the canine is sick, demonstrating symptoms that could be associated with canine cancer, your Labrador could be a candidate to take the Nu-Q vet cancer screening test to rule in or rule out cancer. The same if you have a poodle. Poodles are predisposed to canine lymphoma. So again, if you have a poodle and the dog is of an older age and is demonstrating symptoms that could be associated with lymphoma, your poodle could be a candidate to take the Volition Nu-Q blood test. If your canine is of a different breed that is not predisposed to these two cancer types, currently your canine would not be a candidate to take our veterinary screening test. Obviously, our hope is that working in collaboration with Texas A&M, we can add 1/3, 1/4, 1/5, et cetera, cancer that we can detect through our technology so that we can cover 50, 60, 70, 80% of all canine cancers. So right now, your canine would be a candidate to take our test, which is currently being sold through Texas A&M. You can go onto their website and your vet can purchase the blood test for you on the Texas A&M website. Right now, it would be used primarily for two purposes. One would be for symptomatic screening. So your canine is a breed that is predisposed to one of these two cancer types. Your canine is sick. Your vet thinks it could be one of these two cancer types. Therefore, you may order the Volition blood test. Secondly, as you can see from this slide here, there are about 20 million canines that are age 7 or older. Canines, upon turning age 7, become much more likely to develop cancer at some stage in their lives. Just like with humans, when humans reach a certain age, we become predisposed to certain cancer types. That's why screening for prostate cancer in men starts at age 50 asymptomatically, and colorectal cancer screening, for instance, starts at age 45 for all American adults if they're asymptomatic based upon age. So this is the second way that our test could be deployed, would be an asymptomatic screen based upon a canine turning age 7 or a canine's age. You can see the market opportunity here is significant. 77 million canines in the United States alone, 20 million over age 7, and 83% visit a vet at least once per year. 75% of these visits are for routine care. And you can see about 6 million cancer diagnoses in canines annually in the US. In terms of pricing, our cost of goods is about $5. We sell our test to Texas A&M for $45. They resell it to veterinarians at $122. And then veterinarians are encouraged to resell the blood test to dog owners at between $160 and $200 per test. So very significant revenue opportunity for us in 2021 and beyond, and a very healthy gross margin for us. In terms of marketing the test, Texas A&M has begun marketing. They featured our blood test on the front page of their student newsletter called The Eagle 3 days ago. And they are reaching out to a number of veterinarians in the state of Texas and elsewhere that graduated from Texas A&M with a DVM, a Doctor of Veterinary Medicine. Texas A&M is also reaching out to 7 sort of sister veterinary schools or colleges and research institutions that are involved in the veterinary space to make them aware of our blood test and encourage them to educate the vets that have graduated from those schools about the availability of our blood test for canines. So really exciting opportunity for us as we move into the veterinary space, as we commercialize our first product, and as we hope to generate meaningful revenue in 2021 and beyond. Moving, because I think I'm down to just a couple minutes, moving to our human health products. We also have been getting really good results in bloodborne cancers in humans. And you can see here, moving to this slide, we're looking at a number of leukemias and lymphomas, so non-Hodgkin's lymphoma, acute myeloid leukemia as two of the primary bloodborne cancers that we're researching. We got good results in a mid-sized study here in 2020. We've announced publicly that we will be working to enroll much larger studies in human health to look at least these three bloodborne cancers, NHL, ALL, and AML in 2021. And again, hope to have solid clinical data over the course of 2021 and look to move blood tests into the market for a variety of these bloodborne cancers in human health as well. And turning to the slide here, many of you know Volition as a company that has been developing a blood test for colorectal cancer. Our work continues in colorectal cancer. We have a study underway at National Taiwan University in Taipei, Taiwan, the #1 university in Taiwan, working with their university hospital and working closely with the Taiwan government to see how accurate our blood test can be in terms of detecting colorectal cancer in the Taiwanese population. We also have a study in lung cancer also underway at National Taiwan University in Taipei. We expect to have interim results from both of those studies by the end of the first half of 2021. And again, these are very large market opportunities. There are over 100 million Americans of screening age for colorectal cancer in the United States, 150 million Europeans of screening age in Europe. And with this cancer, the problem is that although we have a very good diagnostic test in the colonoscopy, we have a problem of compliance. People don't comply with their screening obligations because very few people look forward to a colonoscopy procedure. Therefore, a lot of people do not get a colonoscopy. And unfortunately, this cancer type goes unscreened in many adults globally. It's a big problem with compliance. A blood test, a change of modality, or a new modality option for human health would drive compliance rates up, because while a lot of people would refuse a colonoscopy, many of those same people would not refuse a simple blood test if there were one available to them. Lung cancer is a large opportunity as well. The #1 cancer-related death in most countries, if not all countries globally. Colorectal cancer tends to be the second leading cause of cancer-related death. So we'll have additional data there, both very large opportunities for Volition. I think we're getting down to the last 30 or 60 seconds. So I will just point you to our website, volition.com. There's a lot more information on our website. Encourage you to flip through our slide deck, look at some of the corporate presentations, and feel free to reach out to myself or any other colleagues. Our contact information is on our recent press releases and on the website. And hopefully you'll all follow Volition's development over the course of 2021 and beyond. Thank you.
Thank you, Scott, so much. Hit it right on the dot, man. Hit the time perfectly. Everyone take that information down. You're going to want to reach out to learn more about what's going on. And again, that ticker is in chat, VNRX. Scott, thank you again.
Thank you, Neil. Thank you to everyone at Benzinga. Have a great afternoon.
You too. All right, next up, a stock that I'm sure many of you know because it's been on the move quite a lot this year. We're talking about Safehold Inc., ticker SAFE, Safe. Ian Selig, manager of IR, is here with us today. Ian, do I have you? Ian, I see you. You just need to turn your camera on. And unmute too, the last part.
It's not,
hey.
not my first rodeo. How are you?
I'm doing great, man. How are you doing?
I'm doing pretty well, thank you. I'm doing pretty well. I just want to make sure that you guys, can you see the Central Park and the slide? Or are you
Picture
looking
perfect. Picture perfect.
Perfect. Great. So I'm delighted to be with you all today. Thanks, Benzinga, for having us to discuss Safehold, a truly unique investment in the world of Me Too ideas. So today's presentation is broken up into two parts. The first walks through our business model, but then most importantly, the second walks through the investment in SAFE. I think we'd all agree that before we ever decided to make an investment in any business, it's important to understand the fundamentals of the business behind it. So to begin, Safehold is the first and only company that is focused on ground leases. We're publicly traded on the New York Stock Exchange. Our ticker is SAFE. And while many of you may be familiar with ground leases, I would imagine a number of you are not. So allow me to give you a brief primer. So what's a ground lease? Any piece of commercial real estate is literally just two components. It's the land and the building that sits on top of that land. And in a ground lease structure, we separate those components. And one party owns the land, and that would be us at Safehold. And another party leases that land for a long duration, typically 99 years. The tenants of the building are, in effect, the owners of that building, and they're responsible for all expenses. They're under a triple net lease, meaning that they pay the taxes, the maintenance, the insurance, and CapEx is all theirs, and that's their responsibility. The net operating income, or the profits that that building produces, is theirs to keep. However, at the termination of the lease, like many other lease structures, not only does SAFE get its land back, but it gets the building and all its improvements back as well. So you're saying to yourself, why would a real estate investor consider such an ownership structure? We're all somewhat hardwired to believe that you must own the land and the building together. Well, a simple way to understand Safehold's business is to realize that every time somebody buys a property, they're really buying two things. They're buying the building and they're buying the land, but those are very, very different investments. The building is the higher return operating part of the business where all the leasing, designing, marketing, and managing needs exist, making it a very active investment. The land, conversely, is the quiet, passive, lower return part, more like a bond. And the truth of the matter is there's no other place in the investment world where those two types of investments are forced to be together. In the corporate world, you don't have to buy the bonds of the company to buy its stock. In fact, that would be considered senseless, entirely inefficient. But that's what's been happening in real estate because there's never been a nationally scaled institution to acquire that land component and do it in a way that actually enhances the value of the building. And that's our value proposition. And the math is pretty compelling for building owners. By selling the relatively low return land to Safehold, and by creating a properly structured ground lease, owners earn a much higher return on their buildings, and with substantially less risk, by the way. And you'll see that it's a win-win for all of us. So Safehold ground leases have created three important efficiencies for our buildings owners. First, there's a capital efficiency by reducing upfront capital needs because SAFE is buying the land, which is typically 35% or so of the entire purchase of the entire property. Next, there are substantial cost efficiencies that are associated with the various frictions costs that every time that building trades, such as mortgage tax, brokerage fees, all which are based upon the purchase price of both the land and the building. And lastly, and maybe most importantly, a significant maturity risk reduction on a large portion of the capital structure by replacing it with near permanent capital. So actually, this idea of separating the land from a building via a ground lease has been around for centuries. In New York, where I live, most of Trinity Church owns a lot of the land in downtown Manhattan. And by the way, a lot of those buildings are on ground leases. Cooper Union University owns the land under the Chrysler Building, and that's under a ground lease. The Empire State Building was under a ground lease up until a few years ago. Some of the wealthiest families in New York have attained their wealth because some patriarch realized 100 years ago that that land was going to be worth a lot of money. London, another fantastic example. The Duke of Westminster bought West London 150 years ago. It was primarily swamplands and apple orchards. Today, the royal family receives over £1 billion in ground rent every year. And probably the best example is that picture on the bottom of the slide, which is Hong Kong. The British leased that land from the Chinese, built this megapolis on top of this tiny little island, and then literally handed the keys back to the Chinese in 1997. But quite candidly, Ground leases of the past have had an awful reputation because most of these old-fashioned archaic ground leases contain negative provisions such as arbitrary rent resets, require permissions for just about any improvement, and were written to be extremely one-sided toward the landowner, which would make these leases value-destroying for the building, not value-enhancing, and created two things that the markets despise: uncertainty and ambiguity. So at Safehold, we recognize that the problem is that no one has taken this fundamental idea and modernized it to work in today's capital markets. But there's still more things that makes any business revolutionary. Many of the biggest and best companies today are being built by rethinking how things were historically done and delivering fundamentally better solutions while offering a better customer experience. Think about what Amazon has done for retail, or what Uber has done for taxi services, or what Venmo and PayPal has done for payment processing. Utilizing this proven formula, Safehold is literally taking a $7 trillion real estate industry and making it more efficient while delivering a better customer experience. And this idea is revolutionizing the way property owners think about their buildings and the land underneath them. Let's see how our portfolio has penetrated the market since our inception. So Safehold IPO'd in June in 2017, about 3.5 years ago, and our portfolio consisted of $300 million of ground leases. Last year in 2019, only 3 years later, Safehold really gained traction by closing $1.8 billion of deals and grew our portfolio to approximately $2.9 billion today, an 8 times growth since our IPO. And since we're focused on the top 30 markets in the US, the best locations in the United States, I think it's meaningful to take a moment and appreciate the caliber of the institutional quality properties that Safe invests. So the ground leases on this slide are just a sample of the types of deals that Safehold closed in 2019, all with high quality, world-class customers and sponsors. A wonderful example is the property on the far right of the slide. That's 425 Park Avenue, and it's the first office building to be constructed on Park Avenue in 50 years. And Safehold purchased the land underneath that building for about $600 million. So now you have a general understanding of Safehold's business model. Let's get to the fun part and why you're really all here today, and learn why Safe is such a compelling investment. So as I mentioned, a little over 3 years ago, we took Safehold public, and something really extraordinary happened. By putting a ground lease investment in a public wrapper, we democratize this investment. So what do I mean by that? Typically, ground leases were the domain of churches, royal families, and universities because, quite frankly, who has $40 million to park for 100 years? I know I don't, but I do have $70 to buy a stock. Now, for the first time ever, this investment is available to the individual investor, you and me. And not only that, we can express our opinions on ground leases every day. If we like ground leases, we could buy Safe stock. If we don't like ground leases, we could sell Safe stock. Think about that. We turned a 100-year, relatively passive investment and gave it daily liquidity. Now that is powerful arbitrage. So Safehold was taken public by iStar, who's been in the real estate finance business for over 3 decades and completed more than $40 billion of real estate transactions. Not only is iStar Safe's founder, but it's also its largest shareholder and its manager. Clearly, having iStar's years of experience and expertise in real estate finance and sale leasebacks, along with their robust ownership position, is an extremely important part of Safe's ongoing successes. iStar has offices throughout the country, and we all know that real estate is a local business and it's a relationship business. But most importantly for us investors, an investment in Safe contains the 3 most significant characteristics that every investor should seek, something that I like to call the trifecta of investment attributes. So let's review those. The first is principal safety, making sure that your capital is well protected. Our Safehold ground leases are literally one of the safest ways to invest in real estate since they occupy the senior most 35 to 40% of the capital structure. Akin to taxes and utilities, you must pay your ground rent. We're even senior to the leasehold lender, meaning if the tenant doesn't pay their mortgage, then the bank will foreclose, but then the bank will be responsible for paying the ground rent. And having ground leases throughout the country in the best location adds an additional layer of safety. The second attribute contained within this investment is growing income that is achieved through long duration, contractually escalating cash flow streams. Our ground leases are structured with 2% annualized rent bumps that compound over the life of the lease. And the power of compounding is literally a page out of Warren Buffett's playbook. When you compare comparable AAA-like bonds with similar duration, this 2% compounding bump structure in our Safehold ground leases creates excess returns exponentially greater than other investments with similar risk and maturity profiles. I'll get a bit more specific about detailing these cash flows in a moment. And lastly is this whole notion of capital appreciation, which is just another way of saying, hey, how can I get wealthy from this investment and then be able to pass that wealth on to my children and for generations to come? Well, to understand that attribute a bit better, let me remind you what I mentioned at the beginning of the presentation. At the expiration of the lease, not only do we get our land back, but we get the building and all the improvements back as well. Now, I know many of you are thinking, hey, I'm not going to be around in 100 years, so what does that really matter to me? Well, in a moment, we're going to examine that store of value in more detail and understand why it's an extremely important part of this investment. So let's take a moment and understand the ground lease cash flows. As I mentioned earlier, the land is akin to a AAA bond. However, when you compare the compounding, escalating cash flows of Safehold's modern ground lease portfolio to the returns of very similar investment instruments, typically very long-term, high-grade bonds, we can generate approximately 150 to 200 basis points of excess value. A great example is MIT's 100-year bonds. That's that gray line on the bottom of the slide. As you can see, those bonds trade at approximately 3.2% yield to maturity, while our ground lease portfolio generates about 5.2% yield to maturity. Now, in the AAA CMBS world, if you can generate anywhere from 5, 10, 15, or 20 basis points higher than your peers at that AAA risk, you would be one of the best performing managers on Wall Street. We are literally generating close to 200 basis points wider, and that's remarkable. And I don't think there's even another 100-year compounding escalating cash flow stream in existence today with that type of growth. Now, back to that third component of value in this investment, the capital appreciation piece. As you can see on this slide, when we IPO'd in 2017, we had $400 million worth of buildings that were sitting on top of the land that we owned. As of today, that value is $5.1 billion, reflecting growth of over 12 times. And while this store of value is not ours today, it will be someday because of those ground lease reversionary rights. We like to compare this unrealized capital appreciation account to a 401k. Many of us have these kinds of liquid accounts. We can't touch them yet. Hopefully we have some smart folks managing that money for us. Now take a close look at this slide again, and imagine you had $400,000 in your 401k 3 years ago, and it has now grown to $5 million. It's quite clear to me you'd be hard-pressed to find any other asset class to have such significant growth. Importantly for our investors, we're presently working on strategies to monetize that UCA account without having to wait until the leases terminate. However, it's a bit premature to discuss that in this presentation today, but this UCA account will be an extremely powerful element of this investment as the business continues to scale. That being said, something that we can all wrap our heads around is Safe's overall software. Yes.
Ian, this is Neil from Benzinga. I just got to step in and let you know we've got about 20 seconds left. So perhaps your final remarks.
I'll wrap it up. So let's review our stock performance. You can see since our IPO, our stock has accelerated 253%. We were the #1 performing REIT last year. And let's just talk about the potential, what is the opportunity set? Well, with $7 trillion worth of commercial real estate in the 30 top markets, if you take 35% of that, that's approximately $2.5 trillion, and we are the only ones there. So I am going to leave on this note. Please visit us at safeholdinc.com. And you can find much more information there. And please feel free to reach out to me. And thank you, all you guys at Benzinga, for allowing us to present today.
Oh, I was muted. Thank you so much for being with us. It was our pleasure.
Take a lesson
from me. Full circle, baby. All right. Have a good day, man.
All right. Thanks so much.
All right, guys. Once again, that's ticker SAFE, SAFE. Next up, we're going to have a little conversation. Let's see if we can. I got a little bit of echo from Ian. There we go. All right, my sanity has returned. We've got a little fireside chat coming up for you guys with Axos Bank, Greg Garrabrantz, President and CEO. Do I have Greg? While Greg gets on the call, I just want to remind everyone, smash that like button. We're trying to get to 500 likes, and we're sitting at 268. What are you guys doing?
Oh,
come on!
Hey, sorry about that. I was right there on. Okay.
All good, all good. We are here in one piece. How are you doing today, man?
Really good, thank you. How are you?
Wonderful. Really looking forward to this talk. Before we get into some questions, Greg, if you wouldn't mind, could you please introduce folks to you, what you do, as well as Axos?
Sure, of course. So I'm President and CEO of Axos Financial. We have two primary subsidiaries. We have a bank. It's about a $14 billion asset bank. And we have a securities business as well, a clearing company that clears for about 70 introducing broker dealers. We can talk more about why we have those businesses and what synergies we have there. We're publicly traded on NASDAQ, about a $2 billion, on NYSE. We moved last year, and we're about $2 billion market cap.
All right. And what is the ticker on that?
AX, AX.
AX, guys. AX is the ticker. Get it on your watch list. All right, great. Let's talk a little bit about what makes Axos Bank different. There's a lot of competition out there. I was wondering if you could tell us what makes Axos different from peers in the space.
Sure. So we were really one of the first, and certainly I think arguably, from a success perspective, NetBank was before us, but we were one of the first digital banks that operate entirely branchlessly. So what that does for us is that we end up with a much lower efficiency ratio than our competitors by usually around over 20 points. We are investing a lot in our securities business right now, so it slightly distorts the efficiency ratio at the holding company. But at the bank level, we're in the 30s on our efficiency ratio. And we really are at a point, I think, from a consumer perspective, where behaviorally things have moved so far in our favor that we don't have the branch infrastructure that has to be rationalized. We don't have to worry about the COVID implications of dealing with branches. So we're really fortunate in that regard.
So for folks that aren't familiar with investing in banks, what is the typical efficiency ratio that might be compared to
a typical efficiency ratio for a large, money center bank would be in the high 50s. And for banks that would be the 10 to 20 billion range, it would be quite typical to see efficiency ratios in the 60s. And that would be computed as non-interest expense divided by net interest income and non-interest income. So it's just a way, kind of like a pre-tax margin sort of calculation.
Got it. And you're beating that fractionally. So that's fantastic.
Yeah.
Okay. So let's talk about the fundamentals for Axos Bank. Could you talk a little bit about your growth rate to date and perhaps forward looking?
Yeah, sure. So we've had very strong growth in earnings over the last decade on a fairly continual basis. We had, by crossing over the $10 billion mark, we had a large relationship with H&R Block that unfortunately had to end based on interchange rates. But even with that, what we have across a broad spectrum of our businesses, we're ending up at a 15 to 20% EPS growth rate every year. And that's been fairly steady, and so good, strong, profitable growth from the variety of businesses we have is in a safe way has been a big part of what we've been doing over the last decade.
That's fantastic. What do you think are the biggest contributors there?
Well, it depends on the market. Right now, mortgage banking and mortgage refinance has clearly been a huge contributor, and the reason why is with record low interest rates and our delivery mechanisms, which are very data centric and all digital. So we have a purely digital mortgage platform. That mortgage platform is capable of handling large volumes, and so the opportunity now for mortgages and profitability has been very strong. So we had a great mortgage banking quarter last quarter. It more than made up for the H&R Block loss, and it's going to continue to perform well into the near future, particularly in an environment where we think that interest rates are going to continue to be low.
So you've been built to succeed in this environment. Go on. You look like you're about to say something.
I think that's right. I think that the reason why is that we really don't have the challenges. When I get on the phone with on these CEO conferences and with other bank CEOs, they're really struggling to try to figure out how to operationalize branch hours, how to deal with those things. And about 5 years ago, we invested heavily in what we called our universal digital banking platform. And it's our own front end platform that allows us to consume APIs, not only from our partners like Nationwide, but also for a bunch of different services. So we have a large team of developers, about 130 developers working on that platform. And so if we have anything that we need to do digitally, we can get that in a couple of weeks into the platform, which allows us to have all our interactions digitized. And that really makes a huge difference. And that's also not only on the consumer side has shown up, but it really has shown up in our small business banking group as well, which has seen absolutely record growth since the pandemic, because most banks really are not prepared to digitally open small business accounts, nor to have the value proposition that we do because of our cost structure. But then also we can deliver fully digital services to small businesses as well.
So yeah, you touched on a little bit of what I wanted to ask about is with these, you're a digital first organization, and this is to a degree sort of catastrophe proofed you given the past year. And made you actually successful in this environment. And in that you're creating a margin between you and competitors. And I'm just wondering, what are competitors doing that you see sort of makes them a weaker play from an investor perspective?
Yeah, well, I think that one of the interesting problems in banking, the way it's being done, is that obviously we're digital, but you look at a lot of the money center banks or other banks, they're usually larger than us because it's hard if you're not very focused to have a good digital platform. But some of those banks do have decent digital platforms, but what they end up with is they end up sort of being stuck in the middle. They can't offer the value propositions that we do to our customers based on our cost structure because they have the inefficient branch infrastructure. So essentially they have a set of stranded costs, and those stranded costs have embedded themselves in the operating structure and in the customer interaction experience with respect to how people deal with their banks. And so in some cases, those customers still want those branches or feel like they're important, even though they're rarely using them. And so the banks are really struggling now operationally with those branches, but also with the fact that they can't offer a product that's competitive to ours because they have some cost in the value chain that's problematic. So I'll give you an example in our mortgage banking business. So our loan officers do 30 to 40 loans a month. Well, that's a lot. And a typical loan officer at a bank might do 3 to 5. The reason they do that is they have data leads that come in. The applications are largely completed online. Processors are doing a lot of that work, and the salesperson is focusing on a highly value-added activity. So that salesperson does better on a total basis than a typical mortgage loan officer at another bank, but they're also getting paid a lot less per loan. We're passing that savings on to the customer and providing them lower rates and no fees on mortgage refinance. So that's an example of the symbiotic nature of what we get from being digital in financial services, is the ability to take that product, make the product better, sell more of it, et cetera.
So on the topic of tech innovation, I know that you have somewhat of a robo advisor.
Yes.
Could you tell me a little bit about that and how that fits into your ecosystem?
Yes, exactly. And so we bought a small company that was a robo advisor services. And what we're in the process of doing is several things. First, we're integrating that into our clearing company so that we own the full value chain associated with that robo advisor. And within 3 months, we're going to have that application fully integrated into our universal digital banking application. And so there's a lot of benefits associated with that, in the sense that what we'll be able to offer our customers is the ability to decide how they want to utilize their excess liquidity. And we're also going to bundle the services in pretty unique ways. So for an individual that has a checking account with us that does direct deposit, we're going to give them free robo-advice, that sort of thing. So we're basically creating a structure where we can take advantage of all the holistic solutions that we offer consumers. And to the extent that they're committing to us, we're going to be committing to them with higher value products. So we're actually, I think it's really exciting what we're doing. We have a trading platform launching this year. We have the robo-advisor side as well. And we'll be incorporating a variety of lending products that also utilize the fact that there are securities offerings there. So for example, we'll be linking overdraft lines of credit with margin loans and things like that, and doing that in a way that's very cost effective.
Can you tell me some more about the trading platform?
Sure. The trading platform is going to be integrated with our clearing business. It's going to try to differentiate itself in several ways. It will have a fully paid lending option. So that will mean that for customers that hold securities with us, to the extent that those securities are valuable to others from a borrowing perspective, we will actually pay the underlying holder of those accounts for custodying those securities at the bank. And we think that'll be valuable because it's really free money. It's incredibly safe. It's safe because it goes to the Option Clearing Corporation, and it enables somebody who just wants to hold a stock like Tesla to make extra money, even without having to do anything more, take any additional risk. And then we're going to be working on, it's obviously going to be a free platform, but we're working on creation of a set of bundled offerings. So for customers that commit to us, they'll have seamless ability to move money between the banking and securities side, be able to invest, and we're going to continue to build that ecosystem up there.
So just from my perspective, even, I mean, as a consumer, what you're offering is a 360 financial service platform based on modern tech that you're actually leading on.
Right.
So that is very exciting. And then from the outside as an investor, I'm looking at banks and they're not doing well. I can tell everyone that's listening today that I bought some calls on some other banks, and let's just say they're expiring worthless. So it's very exciting to see some divergence in the space because you're doing some things very differently.
Yeah, thank you.
So what I want to leave with, we're at about 1 minute left here, Greg. What I want to ask you is, to your mind, forward looking, what is the most interesting and exciting part about Axos Bank from an investor perspective?
Right. So for over the long term, I really believe that we are the fintech that will be successful because we have all the pieces together. Each of the individual fintechs that you often look at with respect to the Chimes and the Veros and all those things, they're missing some critical component of the infrastructure. We have all the pieces now. Because we have the clearing company, we can offer a great set of value to customers that want to trade with us because we own the whole ecosystem. We can do our own margin loans. We have the bank, so we can take those deposits and we can use those deposits to offer loans to people, which means that we can offer the depositors a better value. So essentially, by all the pieces that we've put together, we really are going to be able to offer the best financial products to customers from a value perspective and still make money. And I think that that's something that's a little bit unique because although we all know financial services going digital, what has been a little bit difficult for some of these folks is to make money at it. And we actually do that. So we're a fintech that actually makes money as opposed to one that burns investor capital.
Well stated. Greg, thank you so much for your time today.
Thank you very much. I appreciate your interest. Thank you. Thank you very much.
Guys, once again, that is Axos Bank. That's AX, ticker AX. Make sure you get it in your watch list. Next up, very excited to introduce to you from Midwest Energy Emissions Corp, ticker EEC, Richard McPherson, President and CEO. And while he's coming up, just a reminder, smash that like button, guys. That really helps us know how well we are doing. It helps us get discovered so that we can keep doing these events for you guys. We will be doing a post-event survey just to figure out what you liked, what you didn't like, to make our events better and better each time, because we love feedback. In fact, we're feedback addicts. It's kind of sick. We need help. So it looks like I've got someone sharing their screen. Is that Richard? Richard, if you're with us, you're muted, and your camera's not on. Someone has NordVPN. They have what looks like Norm Macdonald pushing a shopping cart with a dog in it.
Let's get, sorry guys, I thought you folks had the presentation up. I'll have it there shortly.
Wonderful. And while you're doing that, guys, once again, that's ticker MEEC. Oh, we've got it up, Rick. Then I'm going to get out of your way and not take any more of your time, let you present.
Perfect. Thank you.
Thank you.
Well, folks, thanks so much for taking the time to join me today. It's Midwest Energy Emissions. I wanted to bring everybody up to speed on us and our efforts to reaffirm our position across the U.S. coal-fired power fleet. We've made a lot of changes of late, starting to see some real traction. I thought I'd share our presentation with you today. The disclosure page will be available for all to read. Tell you a little bit about the company as we move forward here. What we've got is a company that's based in the emissions control industry. We've been so since 2008 and became commercially active in 2011 with our first contract on the West Coast with a major coal-fired plant. Some of the key highlights of the company going forward from that time is that we moved our company ahead nicely up until 2016, where we had a peak year of $32.5 million of revenue. From that point onward, our technologies, our patented technologies, took off across the fleet. However, a lot of the utilities adopted our technologies around us and dealt directly with our material suppliers. We realized in 2017 that we needed to make a change, so we addressed our patent package and relaunched again in 2019 with a series of lawsuits aimed at folks that we thought were infringing at the time. So for the last year, we've been dealing with that effort in order to monetize our penetration that had taken effect. And almost 45% of the entire US coal-fired fleet now use our process or processes in order to be able to capture mercury and stay in compliance. What we did is we looked at going to speak with and deal with 4 of the major utilities. And since doing that, we've been very successful. 2 months ago, approximately, we were able to announce a settlement with the Vistra Corporation, which was a multi-year settlement, which sees us continuing to work with them going forward under a licensing and supply agreement. And then after that, just most recently, we also had a settlement with the American Electric Power Group, and they as well are moving forward to work with us in a licensed fashion, continuing to use our technologies and moving forward with us. We will be working with them to test our own version of the technologies going forward. The technologies that we use throughout the system are patented, adopted by a huge swath of the industry. And so we're ready to monetize that adoption. And our plan to do so is through handling the supply side of their business. So rather than be involved in long-term litigation, our preference has been business first, and in that effort, we've been very successful to date, having gained traction with those first two big utilities that we addressed. Moving forward, we expect, given that there are two other major utilities that we are in discussions with that were also part of the suit, we very much expect that we will, through the discussions, be successful in our endeavors to be able to monetize that patent package with these last two defendants. And we're working with a group, Caldwell Cassidy Curry, out of Dallas, which are an extremely competent group under very favorable terms. And the wins that we've had with Vistra and American Electric Power would attest to that. So with regards to the potential share of market and what that really means to our company and our shareholders, is that there are approximately 200 boilers across the country that are utilizing our process. We see no reason why we shouldn't be able to arrange either licenses to continue operating with their present suppliers, or allow us to come in and supply their systems for them. We expect that in 2020, this year, we'll achieve 5% of the monetization of that adoption that's taken place. Next year, we are forecasting a significant increase and expect that over half of the infringing parties will have come to the table to arrange a satisfactory supply side agreement or license agreement with us, and then the remainder in 2022. We also expect that there may be some long-term litigation, but our goal and our objective is to secure supply side agreements with these folks in order to recognize our position with our patents in this space. In terms of potential recurring revenue, there's a lot of business available to us with regards to just the folks utilizing this technology. In 2021, we see the opportunity for approximately 47 million in revenue, or 23 million in licensing revenue if folks elected to take a license instead of having us supply them. Either way, we expect that the potential is for about $11 million to drop in cash profit to the bottom line. We see 2022 with an opportunity based on that growth next year of being upwards of $74 million or 38 million if indeed it was license revenue. Either way, we expect that there's the opportunity for us to drop in excess of 20 million to the bottom line in cash profit. 23, 24, and 25 basically level off in the 100 million plus range. And EIA and other industry experts in the field expect that the amount of business that the coal-fired plants will be generating will actually increase next year and level off in 23, 24, and beyond. So we feel very comfortable that those potential amounts of revenue are real and they're there. And I think the first couple of pieces of traction that we have speak very well to our ability to be able to go after it. So we're very much looking forward to starting 2021 with these first two wins under our belt and moving forward into 22 and beyond. We have also built out, after our initial year of success in 16, we built out an excellent system which will allow us to generate over 100 million of material sales through this system located in Texarkana, Texas. So our capital requirements are very minimal going forward in order to be able to generate those kinds of revenue numbers. So we're looking very much forward to ramping up the business starting in 2021. We do have a significant amount of testing and demonstration that's coming out of these settlements ahead of us, starting up in early January. And we're looking forward to coming back to the market and talk about the results of those tests and demonstrations under our new agreements which we are hoping will lead to long-term supply side contracts. We would very much prefer to supply our customers and build these relationships rather than just take license fees. We feel we can contribute much more to the companies we're working with operations by contributing to their operations with our know-how rather than just securing license fees from them. And that's our business first approach that we have been and will continue to take. So that's generally where we are, folks. A huge inflection point for us to be able to monetize the huge adoption that's taken place of these patented technologies. And we're very much looking forward to a very strong upswing in business starting in the new year. And I look forward to reporting back to you on that. And with that, I'll turn it back over to the monitor.
Thank you. Thank you very much, Rick. I really appreciate it. This is really cool stuff and certainly something that I hope our folks in the chat have been following. If there are any questions in the chat, I'll hold just a second. Feel free to throw stuff in here and Rick and I will answer them. But Rick, I mean, end of year for you heading into 2021 after an incredibly crazy year COVID-wise. Any sort of forward-looking statements you want to leave us with as you move out of this year and into what hopefully will be new opportunities and new ground to cover for you?
Well, first and foremost, it's been several years in being able to repackage the company to a point where we could actually monetize all of the adoption that we very much expected would take place of our technologies. So with the wins that we've notched so far, we very much expect that we should be able to create a domino effect throughout the industry starting in 2021. And the folks that are using our technologies, we very much would like to be able to get to a position where we can supply them ourselves. That would put us back on track to where we were in 2016. And I very much expect a year similar to 2016 next year as we move forward and deal with the units that are using our process.
Very cool. Very cool. Well, congratulations on all your success thus far, Rick. We'll look for more news from you shortly. And guys, if there are any questions for Rick and his team, Rick, where can they reach you?
Best bet is to reach out on the company's website to either Stacy Hyatt or myself, and either her or I will get back to you immediately.
Wonderful. Well, thank you, my friend. We'll leave it there, and I'm sure we'll hear more from you soon.
Great. Thanks so much now.
Take care.
Bye-bye.
All right, my friends, let's keep this rolling. I am introducing now David Noe. David, I'll let you come on and introduce yourself there, but you're the CEO and co-founder of FinGoal. You're leading a panel on embedded fintech, fueling the new wave of growth for small cap tech stocks. This is near and dear to our hearts at Benzinga. We consider ourselves a fintech company too. David, there you are. How do you pronounce your last name for us?
Nohe, as in no, he didn't.
No, he did not, as in no, he didn't screw up my name as I was coming on the panel. Great. Awesome. David, thanks, man. I'll let you introduce the rest of the panel. I'll give a quick shout out to my friend Christine from Yodlee. It's good to see you. And I will jump out of here. Go ahead.
Awesome. Well, good afternoon, everybody, or good morning if you're on the West Coast. Thank you, everybody, for being here. Thank you to sponsors, and a special thank you to our guests, Christine Laredo, VP of FinTech Evangelism at Yodlee, and Sean DeClercq, founder and CEO of KickFurther. Now, we only have 30 minutes, so let's jump right into questions for the panel. Sean, 20 years ago, there were really only like two main sources of new capital for entrepreneurs to grow their business. There were traditional bank loans, and there was the private equity VC path. Could you share your story that led to the founding of KickFurther?
Yeah, absolutely. I would add, well, there was, when we started KickFurther, there was also AR Factoring was providing some finance in the same space as well. So 7 years ago, my background is in supply chain management. I had started my own merchandising company. So we were buying products from manufacturers over in China adding some small little customization to them, and then selling them as exclusive white label products to retailers here in the US. And that business grew from 600,000 of sales to $1 million of sales between years 1 and 2. I was ecstatic as the business owner, and I thought, surely it will be easy for me to find finance, to fund my growing business. Contrary to that relatively naive belief, it was not so easy. So we went out to market, and the best finance I could find at the time for my inventory finance effectively was AR factoring. So the best option I found, this was back in 2012, was a 5% discount per month on my receivables. And so for a 90-day turn on my inventory, I was looking at a 15% discount. And for a wholesale business like mine that was operating on a 30-35% margin, it just seems very challenging, right, to make that work and to make those deals profitable. So, we saw crowdfunding and Kickstarter and Indiegogo having a lot of success, and they were really funding what I consider to be the riskiest entrepreneurs, people that have not done even one production run, have no history. And we said, hey, isn't there an opportunity to bring that community of users that are funding these risky entrepreneurs and introduce them to businesses like mine and hundreds of other businesses all across America that need inventory finance but can't find people to help them fund the inventory? So that was kind of the idea. Nobody was doing it, so we just we grabbed it and ran.
That's awesome, and congrats on all the success. Christine, you are a hero of mine, a true guru in financial technology with visibility to a ton of trends and what's kind of where the future's going. So a quick question and then a longer question. First off, could you briefly define what embedded finance means? And then share how does B2B financing fit into the broader scope of embedded finance?
Okay, well, let's start with the first question. So embedded fintech is literally, or embedded finance is literally what it sounds like. So it's a seamless integration of financial services into a product of non-financial services. So it's happening a lot in the tech space. So big tech can all of a sudden, and we've seen this for a while, it's not the newest thing, but it's exploding right now. So what it enables is a big tech company to offer a financial service directly in their product before they might have to go to a third party, or the consumer would have to go to that third party. But now it's right there embedded into the technology for a one-stop process. So an example would be you're shopping for a new kitchen, or maybe you're going to build a in-house gym. Right now, that's a pretty big trend. And so instead of going from the retailer to the borrower, the retailer can enable you to finance a purchase within the checkout experience. So that's a great example. Another would be a car dealership. You're buying a new car, and I think Tesla does this. They text you an opportunity to buy car insurance right there.
Perfect. And where are you seeing, so that those are consumer examples that make a lot of sense to grow and increase conversion. What are you seeing in the B2B space?
Yep. So as many of you probably know, the back office is ripe for disruption. And this was a year where it really had to accelerate. Still, most enterprises use checks, believe it or not, to pay for vendors and merchants alike. However, this year that's having to change for various reasons. Some are pretty obvious. And so what's happening is we're seeing that explode, right? So folks that usually have a longer process, and these processes have been going on for, I don't know, over 50 years, right? These processes are being changed, right? So whether they go to ACH or even credit card, or even the use of Square or Venmo, we even are seeing, and this is small, but it's a little bit, we're even seeing some cryptocurrencies being adopted, especially in international payments.
Perfect. That makes sense. I really love how technology is enabling all sorts of different kinds of businesses that might not have traditionally considered themselves in the tech space, but are enabling them to grow. And that's really the common theme here. Sean, could you share a story of a fast growing company that might not have been able to meet the opportunities that were in front of them if it weren't for a solution like KickFurther?
Yeah, sure. So we had a great business on KickFurther that we really liked called Tame the Beast. So they have a curated selection of men's cosmetic products like soaps and stuff like that, very directed at men. And, all of their sales were direct to consumer. And so they didn't have any receivables that they could factor. The business had existed for maybe 8 months when they came to Kick Further. So they had a very thin file that, traditional lenders weren't very impressed with, let's say. And on Kick Further, what we saw was tremendous growth and a pretty unique product, and a business that was doing well, right? They could buy a product for $1, they could sell it for $3, and the marketing costs would wash out. So we said, great, we'll fund that inventory for $1. They've ramped up from as little. I think their first deal was $20,000 of inventory funding, and the last one they did with us was over $300,000. So they did 1.6 million, and this business grew by 300% in 18 months, right? And what we see today is that these physical product companies that really understand their digital acquisition have the ability to explosively grow in a way that didn't really exist prior to this much digital distribution. And the world of finance is kind of playing catch up to figure out how to serve the needs of these hyper growth product companies.
Wow, that's crazy growth. Cool. And what's nuts to me is that it wouldn't have happened if the financing wasn't available, right? And that just speaks to how much opportunity is out there.
Yeah. And I'll just add on a couple of B2B examples, David, that I found have been super interesting. So there was a group I ran across called Hawk Media that was selling digital marketing services. And then they launched their own finance arm, because they said, look, if we can look at a Google pay-per-click, an ad campaign, and we can see that this is profitable, which they can see, right? They're like, we're very happy to fund this money all day long, right? And you buy the marketing services from us, and you take the financing to pay for those marketing services from us, right? And you see this even with weird things like logistics, with packaging, with marketing services, right? So the embedded finance is really getting big now.
That's awesome. Christine, what current implementation of embedded fintech or finance today is getting you the most excited, and why?
Yes, well, there's a bunch, right? And it kind of goes back to what reason really drives me in the space, and I think what our company surrounds ourselves around, which is a vision to help consumers and small businesses lead better financial lives. And throughout this discussion, there'll probably be some controversy that arises from that, because a lot of embedded fintech doesn't necessarily do that. It enables a lot of access to goods that maybe a consumer shouldn't be buying right now. But I'll save that. What I like about it is the ease, like the touchless experience. I mean, I think Uber and Lyft kind of went public on that basis, that I don't have to pull out my credit card anymore. You have my information, I can pay, I can go. That was in a time where we had no time. We're in a little different space right now, right? But I still think places like Starbucks, who, if you've seen their stock, has done pretty well. Part of it is because consumers are comfortable going in there because the payments are touchless and it's easy, right? So that habit behaved. And there's going to be so much more of that as we continue with the pandemic. But what I like is some of the things that you guys probably have heard of Shopify. What they enabled is small businesses to open up their own banks instead of relying on their consumer bank accounts. And that disconnects the two, which I think is a step towards a healthier financial life for both the consumer and the small business owners, who are really under a lot of pressure right now. And I think you'll see a lot more digital banks. I think embedded finance helps digital banks emerge. In the beginning, it may just be enabling payments, but then as those brands grow loyalty, like Uber and Lyft did with their drivers, which I think will come back eventually, the use of those services for driving, not just delivering food, but however that bond that they create with their drivers enables them to do more banking services that will help folks. I think we'll see a ton more of that, kind of what Sean was talking about a little bit in the future.
Yeah, that makes sense. Sean, so we've got an audience of, small cap investors and operators in growing companies that are exploring different new sources of capital. What advice do you have to those businesses on how to evaluate their options?
Yeah, good question. I would say, so the basic advice that I gave to small cap operators is that the cheapest finance you'll get today is going to be based off of your data, right? So if you can start to build a data file, a digital data file that leverages third-party data to really demonstrate that the growth of your business is not something that you represent on an Excel, right? Or warrants you're making, but you can say, hey, look at my Shopify data, right? I pay $1, I get $2 back, right? If you have that kind of data, people will fund you, right? And if you look at the different platforms, right? Stripe has their own financing arm now. Shopify has their own financing arm. Amazon does, right? So I would say the first and foremost thing is, who are you payment processing with? Who has your data? They probably have a finance product at this point, right? Reach out to them. And then there's always, almost everybody else in the world. I think it's tough because comparing apples to apples in this world, like a 10% discount versus a 10% increase on your cost, it can be tough. So I recommend people just reach out, talk to as many of the different providers that you can easily find with the Google search. Top of mind, Kickfurther, Bluevine, Clearbank, and then the ones I mentioned, right? Shopify, Stripe, Amex, Amazon all have capital solutions. So I think the best thing to do is to shop around, right? Obviously, check out Kickfurther, no cost to apply, but I'd be remiss if I didn't plug us. But yeah, I think there's a lot of options now, a lot of opportunity for small cap operators.
I love it. And I think the opportunity is clear, and there's so much energy around fintech right now. Christine, with your perspective, what buzzword in embedded fintech, or you can even just go broad, like just zoom out to fintech. What hot trend do you think is overhyped?
Yes. And just before I answer that question, I totally agree with Sean on the part about the data. I think that's a huge piece, because that helps you be able to permission in a financial picture that could make you better off and healthier in that longer term. And the controversy of that, I feel, is kind of in this buy now, pay later, right? I mean, I think there's a bunch of action there. We've got a firm that's about to go public, probably around a $10 billion valuation. There's a company in Australia that I think it's called Afterpay, that has been around for a few years. They've grown enormously based on this whole notion, which in some regard, it opens up, like I was saying, this is the controversial part. It opens up kind of more of a financially inclusive world. However, does it better the financial lives eventually, right? And so I think this is an area where it's getting a lot of hype. It's certainly good for investors, given the two data points I gave you with Affirm and Afterpay. However, in the long run, is it really good for consumers, which is where the piece around data comes in, and I think is why we're seeing a lot of action in this area, is because those of you who don't know Yodlee, and here goes my plug, we all have to do it. But Investnet Yodlee, we've been working with banks for over 20 years, and we have the largest amount of financial institutions, 17,000 and growing, which means when you verify an account, or if you allow the lendee to pull in their financial picture, which then will pull that information, we'll have the likelihood of having that account or set of accounts, so that you can see a better financial picture of that lendee. And then the hope is that you can provide a little guidance on, is this the right thing, right? I mean, is this the right thing to be doing when your financial picture is this meek? I mean, should you instead be presenting areas to save? Now, this gets more into financial responsibility than some retailers might want to have. But I think this is the point of controversial discussion that we're having in the industry. And, I can't say it's completely overhyped. I guess the word is it's pretty controversial, and it depends on what your goal is. I certainly follow the goal of helping small businesses and consumers lead better financial lives. And so I feel like it was appropriate to bring up this point and really note that we had a high amount of consumer debt at the end of 2019. I think it was in the 4.2 trillion range, not including mortgages. So if you add what's going on this year with the pandemic, with folks losing jobs and whatnot, I think the discussion really is controversial around this. And I just wanted to bring it up in this panel because I think it's important.
Yeah, I think that's fair. Sean, do you have a controversial opinion or a trend that you believe is overhyped in our space today?
Huh, that's so funny. So I just read an article today about how there's been some changes in the regulations that have allowed lenders to go to other states' banks to charge very high interest loans to small businesses. And the example was like over 200% interest for, certain businesses, small businesses. And look, I think that there are absolutely some practices that you look at it and you say, look, we have usury laws in place for a reason, right? And it's hard for me to say that, to me, it's quite obvious that there are certain protections that should exist. But at the same time, I consider the position of an entrepreneur that needs finance, right? And they're in a really risky position because their business has existed for 6 months or 9 months or a year. And the option of, do I take on expensive capital or do I not have access to capital at all, is such a tough position for those entrepreneurs to be. And so I think that there is controversy around, how can we make capital available to these businesses that are risky businesses without also putting them in a position that they're guaranteed to fail, right? And how do you thread that needle? It's really difficult. And I think the answer is data. Really, it comes down to data. And that's what makes embedded finance so powerful, is because you are starting from a point of data with these businesses, right?
Perfect. I don't know how controversial. I think it's a controversial space. I don't know if it's a controversial opinion, but I mean, we're all nodding our heads like, yeah, that makes sense. Real quick, so you guys gave your plugs on what you're a little bit about what you're working on. What kind of folks in the audience or interests should get in touch with you, and what's the best way to get in touch with you guys? Christine, you first.
Okay, so for me, it's a few things, right? I mean, I think I mentioned that we're actively involved in some techs, mostly tech companies, embedded fintech. Happy to talk about that and ways forward. I also founded our incubator. We ran it for 5 years, still do some angel investing, and very plugged into that ecosystem. So I very much appreciate the startup ideas that come from entrepreneurs that are just helped by the embedded and the fact that fintech is embedded and there's many companies doing it, making it easier. So that should spur some ideas. So happy to communicate that way and talk. My best way to reach me is either LinkedIn or through Twitter. It's my name, Christine Laredo. So it's pretty easy to find me.
Perfect. And Sean, who should get in touch with you and how?
I would say anybody who either is supporting or invested in or in any way connected with physical product to goods companies, and they think that Kick Further could be a useful tool for those entrepreneurs' toolbox. They can easily just direct them to the Kick Further website, or if they want, we have a $1,000 referral credit, so you can create a user account and get paid for referring businesses to Kick Further. To get in touch with me personally, the best way would be sean@kickfurther.com, my email address. And, I'm happy to support. And, I really like providing mentorship is one of the ways that I like to give back. So if people are too early for the Kick Further platform, but are looking for some direction, I have spent a lot of time in supply chain management and funding. So I'm happy to talk to anyone.
Awesome. And should investors check out the Kick Further platform to put money into the deals?
Yeah, absolutely. I think if you want to support entrepreneurs, if you want to be able to, fund 10 or 20 or 100 different products companies for as little as $20 each and really learn about the space, I think it's an excellent place that you can connect with hundreds of companies and, earn a decent profit on the inventory that you're funding.
Awesome. Thanks. Same question to each of you guys. And I'll go with you first, Sean. What problem are you most excited to be working on in 2021?
Wow, what problem am I most excited to be working on in 2021? I would say, so we're very fortunate that in 2020 we had a strong year. So, e-commerce, where we have a lot of concentration, did well. We were fortunate that we have pulled together some financial resources. And I think for 2021, the number one thing for me is making sure that more people are aware of the Kick Further solution, and how do we just get the name out there, right? So it's an interesting problem to have.
Awesome. Christine, what are you most excited to be working on going into next year?
Well, I'm going to check out Kick Further first of all, and maybe we can talk a little bit about that after, because I just learned about it last couple of weeks while we were talking. But so we, in addition to what I've said about embedded fintech, we also have this NACHA requirement, which is a governing body of payments, and they're requiring in March 2021 that you have to verify an account before you fund it, which is huge for more explosion of embedded fintech. And I like it because it lowers the risk and puts consumers and small businesses at less risk. But what we have done this end of the year is we just signed a partnership with one of our incubator companies called Productify. I'm so excited about this team. I love what they have built. We mentored them, they graduated last year, and we have just invested and built a partnership. So what they do is basically fintech in a box, right? They have digital banking, they have payments, they have card issuance. And for developers, it's so easy. You literally don't read documentation or anything. You go through an application process and you create your app. You can start simple and then grow to include digital finance and, digital banking and card issuance. You may just be doing payments to begin, and it just grows with you, and they are fantastic. And some of the companies that are coming through the pipeline, I'm so excited about what's going to happen in 2021 because of this partnership. It literally makes embedded fintech easy. 3 weeks and you're off and running. So that's my biggest thing for next year.
Fantastic. Well, I want to thank both of you for your time today, and thank you to Benzinga for giving us some time to share our stories. Quick plug on my side. I'm David Noe, founder and CEO of FinGoal. We sell analytics infrastructure to trusted financial brands like banks and credit unions, all predicated on better understanding individual end users on a human level. So anybody that might be involved in banks and credit unions, we'd love to chat and talk about the future of digital banking. And you can find me on Twitter at FinGoalDavid or on LinkedIn. Anyway, thank you guys so much for the time, and back to you, Patrick.
It's our pleasure, you guys. Thank you so much for being with us. We hope you each have a great end of the year. And obviously, if you need anything at all, please let us know. Folks in the chat, if you're interested, I'll give you my email address, patrick@benzinga.com. Feel free to reach out to me and I can connect you with any of these fine folks. Thanks very much, you guys. Have a great day.
Thanks. Bye now.
Bye. Thanks. Happy holidays.
You too. All right. We will keep this rolling right along. We are a bit ahead of schedule now. So if we have him, RJ Tessie, I should say Dr. Tessie, CEO and CMO of Immune Bio. Dr. Tessie, are you with me?
I am.
Dr. Tessie, what a great name. That is awesome. And Immune Bio, let's see, your ticker is INMB on the NASDAQ. Is that correct?
That is correct.
Awesome. Well, sir, I will let you get right into it. Like I said, we're ahead of schedule. So do your thing and I will get out of the way.
Okay. So you should be able to see my screen here.
Yep, gotcha.
There we go. Have you got it?
We do.
Okay, so thank you everyone, and all I can say is keep wearing your mask. So Immune Bio is pleased to be able to present at the 2020 Benzinga conference, and we are a public company, and you have all seen these forward-looking statements before. I will not dwell on them. A quick corporate snapshot. As the host said, we are a public company traded on NASDAQ under INMB. We closed yesterday at $9 for giving us a market cap of around 120 million. We have 24 million in cash or cash equivalents, no debt, no warrants, and no preferred stock out there. We have about 13 million shares outstanding, and we inside ownership is substantial, and part of that is because of our unique financing strategy, which does not include traditional venture capital. So we are a clinical stage company. We have completed one phase 1 trial, have another one in the clinic, and a phase 2 clinic in the phase 2 study in the clinic. We have third-party validation with over 65 peer-reviewed publications in scientific and medical journals, and those are on the website. and we've received substantial non-dilutive funding from the Alzheimer's Association, the ALS Foundation, and the National Institute of Health. Our two platforms are our dominant negative TNF platform, which is a selective inhibitor of only soluble TNF, and it's a very novel drug that allows expanded market opportunities. And we have an NK cell priming platform, which targets residual disease. That's what kills most patients with cancer. I won't be talking about the NK cell priming platform today, INKmune, because in fact we have the short time. We have a number of upcoming catalysts. We have a KOL day scheduled for our Alzheimer's program in January. We'll be initiating MDS trial in the INKmune program. We'll be initiating phase 2 programs with XPro, which is our DNTNF CNS drug, and in mid-2021. And we expect to report out data on our COVID-19 program next year. So you are all familiar with Alzheimer's disease. It has been in the news a lot for justifiable reasons. It's a very scary disease. We have a very different approach to Alzheimer's. We aren't interested in amyloid. We aren't interested in tau. We are very interested in neuroinflammation. And we think Alzheimer's disease, in fact, we think a number of neurodegenerative diseases are related to neuroinflammation. Now, how do we measure neuroinflammation? Because I can't look at someone and say, you've got neuroinflammation. It has to be measured, and the best way to measure it, at least the way we're measuring it, is with an MRI scan looking at white matter-free water. You know the brain is made of gray matter and white matter, and most people think about the gray matter where all the smarts are, and the white matter is what connects all the smarts. And in some ways that's true, but it turns out there's a lot of disease in that white matter. And as you can see on the figure, that as you go from being someone normal to having MCI, which is kind of an early stage of dementia, to Alzheimer's disease, the amount of white matter free water increases. So you can measure it, and high levels are bad. Now, it turns out our clinical trial, which is a novel phase 1 clinical trial, is treating patients who have Alzheimer's disease we think caused by neuroinflammation. And we've looked at some of the data, and that was reported in July, and you see that here. On the left-hand figure, you can see we had a nice dose response. The more drug we gave, the lower the amount of white matter free water or neuroinflammation could be measured. But what really got us excited is in the right-hand figure. There was a decrease of neuroinflammation by 40% in something called the arcuate fasciculus. Now, I presume none of you are neuroscientists, but the arcuate fasciculus is a white matter tract. It's a superhighway of the brain. Think of the superhighway that connects New York with Washington, D.C. It's always filled with cars and trucks, and that's what these white matter tracts do. And the arcuate fasciculus connects two parts of the brain, Broca's area and Wernicke's area, that are responsible for language. So, in fact, what makes us human, our ability to talk, our ability to communicate verbally, our short-term memory, are all controlled or all, shall we say, connected by this white matter tract. Now, decreasing neuroinflammation is a very big deal. And why is that? Because the most sensitive clinical sign that clinicians have for measuring whether or not you have Alzheimer's disease or your Alzheimer's disease is getting worse is how you use language. That is to say, your use of language gets worse and worse as your dementia proceeds. We are excited enough and confident enough in this data that although the phase 1 trial continues as we refine our insight into the disease, we will be starting a phase 2 clinical study in Alzheimer's disease in mid-2021. So how are we doing this? We're doing it with a drug called XPro 1595. XPro 1595 is a TNF inhibitor. You've heard of TNF inhibitors, but ours is very different. And it's different because TNF biology is pretty complicated. You see, there's a bad TNF, which is soluble TNF, and a good TNF, which is transmembrane TNF. The current drugs block both the bad and the good TNF. Ours only neutralizes the bad TNF. And the advantages are shown on the table on the right. Basically, when it comes to getting rid of inflammation, they both work well. The difference lies in the side effects, the safety. There's increased risk of immunosuppression, infection, and cancer, and there's increased risk of CNS problems, particularly demyelination, with those first generation TNF inhibitors. Ours, that's not a problem. And as a result, you have this huge, let's call it an expanded market opportunity. As you can see at 2 o'clock there, autoimmune disease is the turf or the markets that the current TNF inhibitors are focused on. That's the only place they can be used because of their side effects. And it's a $42 billion market. Because we have a drug that works differently and can be used in areas where immunosuppression and CNS disease would be potentially a problem, can play in all these other markets. And you can imagine that the value of those increased dramatically. Right now, we're focused on neurologic diseases and infectious diseases. In the near term, in the future, we'll be looking at oncology, metabolic diseases such as NASH, and pulmonary disease. But for now, other than our CNS programs in Alzheimer's and treatment-resistant depression, we have a program in Queller called Queller in COVID-19. Now, I don't want to spend much time talking about the nuances of COVID-19, but we are focused on the patients who are in the hospital, but not yet in the intensive care unit. And the dirty little secret about these patients is the virus has more or less been eradicated by their body's immune system. But the body's immune system, in its, shall we say, in its vigor to get rid of the virus, is making the patient sick. And that's something called the cytokine storm is making the patient sick. And TNF is the master of the cytokine storm. That is to say that without TNF, you don't get this hyperinflammatory response that causes the pathology in the lungs, the blood vessels, the brain, the liver, the kidneys, the intestines, or the heart. So by getting rid of neutralizing TNF, you can potentially get rid of all these problems. And that's exactly what we're trying to do. But the other little problem that nobody talks about is that the real villain of COVID-19 infections are blood clots. These blood clots form in places where they're not supposed to form, and they cause problems with the lungs and the brain and the heart and the kidneys. And in fact, it's TNF that's activating cells that line the blood vessels to make them make these clots that's a big problem. So we really get rid of two things. We get rid of one of the major causes of organ dysfunction and a major cause of cell death associated with the cytokine storm. The trial, which is currently enrolling, is a simple trial. It's a blinded randomized trial. Patients come into the hospital with respiratory dysfunction, and they get either a placebo or our drug. The plan is to treat 366 patients, and this trial was designed with the FDA. I mean, the FDA's fingerprints are all over this. One important note is you'll see in the inclusion criteria, we're focused on high-risk patients. Those are patients who are older, have cardiovascular disease, including hypertension, obese, diabetics, Black, or Hispanics. As you can imagine, there's a lot of those patients out there. So in summary, those are our clinical programs. We're quite excited about them. Our website, which is www.inmunebio.com, has a lot of information. And if you want to speak with us, please send us an email or give us a call. We are happy to chat.
Great, Dr. Tessie, thank you so much. I really appreciate it. And where's a good email address for our folks to reach out to either you or a company rep with more questions?
So info@immunebio.com. And from there, I can promise you that either David Moss, who is, a founder and CFO and also in charge of investor relations, will make sure that gets to the right person.
Wonderful. Thank you so much. Again, the ticker is INMB on the NASDAQ, and I'm sure we'll hear more from you soon, sir.
Thank you very much.
Thank you. Take care. All right. Still a little ahead of schedule here. That's good. We will move right ahead to Panna Sharma from Lantern Pharma. Lantern Pharma is LTRN on the NASDAQ, LTRN. And as we're moving Panna over, there we are. I'll remind everybody again, if you have any questions at all for our speakers, throw them in the chat. We'll be happy to moderate those along. How are you, Panna?
Great, Patrick. Thanks for having me on.
It's my pleasure. I will let you jump right into it. And thanks again.
Can I share my screen, or is that being seen?
It's not being seen yet. Okay, it's coming now. 1 second. There, now we have it.
You do? Great. Great. So I'm going to go ahead and get started. Is that all right?
Yep, jump in.
Great, thank you. So my name is Panna. I'm the CEO of Lantern Pharma, and I'll be giving an overview of our exciting company. We're at the forefront of applying artificial intelligence and machine learning to solve the complex, risky, and very costly problem in developing oncology medicines. So we're leveraging AI and machine learning, but with large-scale genomic analysis to rescue and repurpose drugs that have historically been abandoned or failed, and also develop new drugs. We're publicly traded on NASDAQ. The ticker is LTRN, so I will be making some forward-looking statements that I may or may not, we may or may not update going forward. Will also be, also additional factors can be found regarding our risk factors online at some of our disclosures. So let's walk through what we do and the core business model of the company. So what we're focused on at Lantern Pharma is taking a lot of the large-scale AI development and applying it to really what is essentially a data problem, and that's developing drugs. How do we understand where a compound is going to work, what patients it's going to work in, and what tumors it's most likely to actually get rid of? There are so many drugs we know of every year that either fail or get abandoned because of lack of efficacy, lack of understanding, or lack of ability to identify patients that will have meaningful response. We overcome this large-scale problem by using data from genomic studies, clinical studies, preclinical response data, clinical response data, and mechanistic data about the molecule, and then really modeling where it's going to work, how it's going to work, and developing a genomic or biomarker signature that will give us a great degree of certainty about how we can accelerate it through clinical trials. We developed this process internally. It's called RADAR. That's our AI platform. And the core to RADAR is really to change the entire equation and transform drug development for oncology. It takes about $2 to $3 billion to bring a drug to market in cancer. Success rates are fairly low, but there are thousands of trials and tens of thousands of studies that publish data every month and every quarter that can be leveraged to use a more data-driven approach. And until recently, we really didn't have the algorithms, the machines, the computing power to do so. And now everything is being changed because of large-scale AI capabilities in the cloud. And so this has caught the imagination of Wall Street, of Main Street, but more importantly, it's actually been accelerated because of COVID-19. A lot of the vaccines you see today would not have been developed if it were not for computational virology, and that has now leaked into almost every area of medicine development. In oncology, this is especially concerning and important because about 40% of the big 12, top 12 pharma companies, portfolios are in cancer, and nearly 50% of their profits come from cancer drugs. And it's an area that most of them have been very unsuccessful in. And the two biggest reasons, according to experts, are that the cancer drugs that are being developed, oftentimes their strong therapeutic effect gets diluted because the patient population is too heterogeneous, not enough targeting. The second reason is that there's more and more genetic information that needs to be incorporated earlier into the development of that drug, so you can actually exploit the issues that are going on in the cancer and the weaknesses in those tumor cells. And again, that's not always looked at early enough in the process. Our RADAR AI platform is focused on solving these two central problems, and therefore it allows us to actually have a higher chance of success and lower the risk. So we've spent a lot of time and energy developing this platform. It's been profiled in Fortune and ZDNet in a number of publications. We believe we're at the forefront of developing this tool, and more importantly, this process for how oncology drugs can be developed. Today, we believe that we're at a very unique time period in history where we're able to access more data than ever before. AI technologies are rapidly evolving and improving. Costs are being reduced, and there's significant economic pressure to bring the cost of drugs down and to get to a greater number of patients. So we see really a perfect environment where there's economic pressure, there's technological advances, there's large-scale availability of data, and there's the collaborative infrastructure now to do these kinds of things. And so we believe we're like in a perfect position to fundamentally change how cancer therapies can be personalized. So where are we focusing our platform? Our platform today is over 1.1 billion data points across about 140 different drug-tumor interactions. We validated this and published this at places as diverse as ASCO, AACR, a number of other important trade shows and conferences. And more importantly, what we are pointing this platform at is our own pipeline. So RADAR has helped us generate the genetic signature for our first drug that's now actively in a clinical trial. It has helped us uncover the mechanisms for our second drug, LP300, which we're bringing back into a phase 2 trial. And it's given us very important genes that have allowed us to target two very powerful programs for our third drug, LP184, one in solid tumors that overexpress PTGR1 and one in glioblastoma. So again, the power of the platform is great, but the power and the ability to actually personalize these therapies and bring them to market for patients is even greater. And that's why we think we're on the cusp of transforming from purely just an early stage drug development company to, we believe, potentially a transformative entity in oncology drug development. Additionally, as we've told investors, we'll be launching new programs with new candidates or with our existing candidates in new indications every 12 to 18 months. And because we're a platform play, we believe we can constantly generate new sources of value for our investors and new ways to demonstrate how our platform can generate new therapeutic programs. Our platform reached 1.1 billion data points a few months after we went public. This was almost twice as large as we had thought we would reach by the end of the year. Our goal internally was around 500 million. We're at 1.1 billion now. We'll probably be well north of that by the close of the year. We're now projecting 3 to 5 billion next year. And again, we have programs underway today where we think we can probably easily surpass that number too. So the platform is rapidly evolving as the number of data points increase. It gives us more powerful signatures, it gives us broader indications across cancer, and it gives us deeper insight into a broader range of drug classes. And all this is really essential because this is the way you can actually de-risk program development and launch and compress product cycles. You have to compress product cycles in order to make drug development less expensive and make the drugs more affordable globally. So where does our pipeline today? If you look on the slide 10 in this deck, our pipeline today is 4 programs, one in metastatic prostate cancer, one in non-small cell lung cancer, and then 2 programs with LP184, one in solid tumors and one in glioblastoma. And we're doing this in combination with partners and such as Georgetown and Fox Chase or Alarity Therapeutics. And we have over 106 issued patents across these drugs and across our programs that span about 14 patent families. So not only is it important that what we're doing, but we actually take a lot of time to put the right kind of patent protection around our compounds, around our methods of use, composition of matter, and the genetic signatures. So these are all important areas that will give us the right to have, we think, outsized economic returns in the long term. Our programs, although they're targeted and specific, are targeting several $1 billion in therapy sales every year. And this is very important because any one of these compounds, we believe, can be worth several times our market cap today. We're trading around $100 million market cap today. Some of our peers are in the range of 1 to 4 billion. And we think any one of our drugs, as they mature and as they get potentially into trials or further into trials, can be worth several times our market cap. For example, our drug for non-small cell lung cancer is targeting never smokers. It's about 20% of the population that comes down with non-small cell lung cancer are non or never smokers. And we believe that's close to a $2 billion annual therapy sales opportunity a year. So specifically in our drugs, if you look at LP100, LP300, and LP184, these are small molecules, all going after very, very targeted groups of patients with very clear need. And very importantly, they are also, again, have a clear mechanism of action and are using genomics to target the patients. Our first drug was out-licensed on Alarity Therapeutics, and they have patents that they've developed also to extend it out to 2036, and we can get a significant milestone next year, and also pursue perhaps even additional indications. Our next drug, LP300, is in non-small cell lung cancer that's being developed in collaboration with Fox Chase and a number of other sites. And this is a drug that has had a lot of historical clinical experience. And in fact, in historical trials, it was given to over 1,000 patients and very well tolerated. And this drug actually generated about 125% increase in survival for never smokers and for female never smokers. But if you look at the trial, the way it was designed for all comers, all patients across non-small cell lung cancer. And so it didn't really have the right kind of effect across the broad population. And that's why in an era of targeted medicine, you really have to understand the population or the patients that are going to respond to the drug and then tie the biomarker profile of those cancers to the mechanism. And that's what we've done. And in doing so, we believe that we can go after never smokers that have the underlying biomarkers that show that they will respond to this drug and improve survival. So we plan on entering into a very targeted phase 2 trial, and more importantly, bring this medicine to patients that really need it. And more importantly, it's been de-risked because it's shown tolerability, it's shown efficacy. And so our challenge is really to find the population genomically and relaunch this drug. Lung cancer never smokers, as I mentioned, is a multi-billion-dollar problem globally. It's now the 7th leading cause of death, much more frequent in women than in men. We have patent applications that can give us potential protection in this indication through 2039. So even though the drug has some history, we've got significant patent protection. But more importantly, not only does the drug work, but there's a reason, there's a mechanistic reason that we've uncovered, because there's a mutational and biomarker profile that's different in lung cancer never smokers versus smokers. And so we've looked at mutation frequency from data that we've compiled across 6 different studies, and we're looking at more data that show us what is really driving lung cancer in never smokers versus smokers, and then correlates to how our drug works in never smokers. Our third drug, which is in 2 programs, this is very exciting because this program is one that has actually been most helped by RADAR, because RADAR has been pinpointed, has actually helped us uncover one of the indications. So we know this drug, LP184, small molecule DNA damaging agent, we knew that it would have power in solid tumors. What was unclear is which solid tumors and what potency level, and their engine helped us clarify that. So it saved us months and months of lab work, and maybe years. And we're able to file new patents in terms of very specific cancers that we're going after that are prioritized. And more very importantly, we've generated a signature that shows how this drug works in certain solid tumors that overexpress PTGR1. As you can see on the chart on slide 21 in my presentation, those mice that were given a human or implanted or engrafted with a human cancer a very potent multi-drug resistant lung cancer. With no drug, unfortunately, these mice, had massive tumor growth. But when given the drug at 10 and 20 milligram doses, the cancer almost disappeared in terms of its weight by 10x. And so now, beyond just these studies, we've done additional studies that zero in on the best tolerated therapeutic dose and have helped us refine the therapeutic index for this molecule. And now we're going into additional studies across a very targeted set of cancers that overexpress PTGR1. And that is the important target, because in PTGR1, once it's present, it actually transforms the drug and allows it to create very, very targeted damage at a specific place. And because of that potency, it's a perfect drug to combine with other drugs. And again, we filed patents on many of those combinations that we found. So again, it works across a range of solid tumors, as you can see in slide 23, but with thousands of times the potency of existing drugs. And again, this was largely driven by predictions that the RADAR engine made. Additionally, RADAR also suggested that it would work in glioblastoma. And when we went to the lab and tested in glioblastoma, that was the case. As you can see on the slide here, it's several thousand times more potent than temozolomide, and it has a very favorable blood-brain barrier. So this opens us up, this drug, to a whole range of blood, CNS and brain cancers now as well. If you look at what drives this, what's allowed a young kind of smaller company to develop this kind of powerful insight into these programs and develop these programs so quickly, it's because of our platform. So in our platform, we have over 1.1 billion data points, over 55,000 patient records, and that allows us to start predicting and getting insights about what cancers to target, what compounds will work, and what that combination is. So it gives us a lot of preclinical insight that streamlines the process, but then also gives us clinical insight that allows us to create a companion diagnostic so that we can actually enroll in the trial in a very targeted way. So we think this is very valuable to pharma and biotech, because they're going to want a company that has a way to do trials faster and with reduced risk. And that's exactly the problem that our RADAR AI engine focuses on. So what are the workflow details? I'll spend a minute or two on this if we have some time. And what it really works on is by gathering all the data, curating it, tagging it, giving it quality scores, we're then able to train various algorithms and various models, whether it be using Keras regression or artificial neural networks or using XGBoost algorithms. We're able to train those algorithms and then have them compete with one another to see which one has the best model or the best signature for prediction. And we look at factors like size of signature, the biological relevance of the signature, the statistical significance in terms of area under the curve, the time to develop the signature. And these models then are constantly iterated on. We're now developing new methods where the algorithms actually find the data. So we're actually letting the data find the data so that the system is much more living. And so as a result, we get constantly tuned and predictive response models that allow us to accelerate the development and target it so that every month, every week, we can come up with ideas. And the pace of this interactive Q&A is very critical, because in drug development, you were able to ask a couple of central questions a year, maybe. Now we can do that in a matter of months, or hopefully even weeks. And so if we can ask more questions of the data and incorporate even more data as we're doing it, allows us to speed up research and compress the timeline, therefore make drugs cheaper and make them with reduced risk and bring them to market so that they're much more affordable. And so at the end of the day, that tuned optimized model is important, because that's the same or similar model that we then use to create the companion diagnostic. And as we take that into the patient population, we test that response model to what actually is available in the real world setting, and we can create a companion diagnostic signature that can help us segregate responders, partial responders, and non-responders. This is all backed by a lot of patents. That's very important. That gives us the right to really compete long-term. And so we have over 106 issued patents today across about 14 families. It's very important that we collaborate with top-tier centers. So we have collaborations with Sloan Kettering, with the NIH, Georgetown, Fox Chase, Citric in the UK, and they help us not only develop better insights, help us generate insights about real world conditions, and also potentially serve in the future as sites for our clinical trials. We're often compared to some of the comps privately like Benevolent, Atomwise, Recursion, and also public comps like BioXcel, Schrodinger, and Relay. But I think we've got a lot more upside for investors trading at around 100 million market cap. I think, as I mentioned earlier, we've got several times more value in any one of our programs than our market cap is today. So I think as we grow, we have a lot of upside for investors. We've got a lot of milestones coming up next year. Next year is a milestone-rich year for us in terms of our platform, in terms of our trials, and in terms of collaborations and partnerships. We've got 7.3 million shares on a fully diluted basis, including our options and some warrants, and about 51% of the company is owned by management and the board. And we're very experienced in the category. So, we're really at the core, we're very passionate about changing the outcome for cancer patients by leveraging AI and genomics and the latest technologies. But we're not just passionate about it and have a platform. We actually have drugs in trials. We have drugs that we've applied for orphan disease. We have cancer patient populations that we've identified that have a clear clinical need for these drugs. And we have leading collaborations with institutions like NCI, Georgetown, Fox Chase, and others that will announce where we're doing development in a very smart and economically efficient way. So that I'll urge you guys to take a look at lanternpharma.com or follow us on Twitter or LinkedIn, and you can find more information about the company. The ticker is LTRN. Thank you.
Thank you, Pana. We really appreciate you coming on. And I believe, if I'm not mistaken, it's Marek, M-A-R-E-K, at lanternpharma.com, where folks can reach out with more questions. Is there anyone else that we should, any other sort of contact details we should give to our folks here? If they'd like.
They can reach us anytime at info or IR at Lantern Pharma, IR, investor info, and any of those will work to get to us. And we're pretty prompt about answering questions and setting up phone calls.
Wonderful. Well, thank you so much for your time. I really appreciate it.
Thank you. Bye-bye.
Bye-bye. All right. Well, I am going to bring my compatriot back on here, Neil Hamilton. Are you awake? Where are you? Are you okay? You good?
I'm fully awake. I'm right here.
I miss your right shoulder. It goes in, it goes out. It comes in, it comes back.
Yeah, we didn't all get fancy green screens from the office.
That's fair. That's fair.
Yeah. I got a ripped up t-shirt to hang up behind me. And so my shoulder goes away from time to time. All right.
You just look like one of the ghosts from Star Wars. It's fine. You are Obi-Wan Hamilton. Just standing there, kind of flickering in and out of being. It's fine, man. Don't worry about it.
More powerful than you could ever imagine, Patrick.
Well, that's debatable, isn't it? Okay, well, I've had a great time today. We have one more presenter. So as we get him ready to move him over, I'll just say a couple of things. We've had super good engagement. I mean, I can't wait to see the numbers tonight once we get them all back. But yesterday, I know we had upwards of 12,000 people watch our content, right? And watch this show. So we're super excited. Thank you all for being here. Thank you for tuning in. Despite Neil and I's back and forth, I'm really glad you stuck with us.
I'm trying to just be a floating head. Thanks. Yeah, like you said, thank you, everyone. Make sure you hit that like and subscribe. And it looks like our next guest has arrived.
Awesome. And Alan, welcome, sir. You are the CEO of Funware, the funnest name that we have.
It's true.
I'm out.
Yeah, PHUN is the ticker, you guys. PHUN. Neil couldn't take the heat, so he had to bounce. But Alan, welcome. We'll let you get rolling, man.
All right, let me just pop up my screen here, and we'll actually get started. So thank you, as always, for the introductions, and appreciate interest today in talking about Funware. We've actually been working for going on 12 years, 10 private, 2 public. Funware, actually, the name means applications that exhibit like game-like mechanics and behavior. And we like to say that the fun part of Funware is the fun, playful, engaging, addictive experiences on mobile that people are used to. And then simultaneously, the where part are the high-end cloud, super scalable, hardcore infrastructure that's very secure for Fortune 1000 customers to drive their mobile initiatives and digital transformation initiatives on. So today what I want to do is actually walk through a bit of the history about Funware. Think of us as an enterprise cloud platform for mobile. We're very much like you might think about an Amazon AWS or a Google Cloud if all they did was focus 100% of their efforts on the mobile application initiatives on iOS and Android for the Fortune 1000. As we like to say, Funware provides everything you need to succeed on mobile. That's the means of engaging, managing, and monetizing large audiences at scale on all the devices that we use daily. We have a normal disclaimer. We'll encourage everybody, obviously, to dive into all of our SEC filings. You can also go to investors.funware.com to get lots of information for the investment opportunity in Funware, which I'm going to summarize a bit today. So in terms of some of the background about Funware, as I said, we were started in February of 2009. So we're approaching, beyond a decade of activities, headquartered in Austin with offices in the United States. And what we did is we pioneered something called multi-screen as a service. It started as mobile as a service when there was just smartphones back when Apple came out with the iPhone. After that, though, obviously, we got beyond that from smartphones to tablets, wearables, smart televisions, kiosks, digital signage, and other forms of engagement. And what we really help brands do is to focus on that high value touch point between their brands and their anytime, anywhere users. And over the last 12 years, we started with a unique vision, which was we wanted to be able to reach every human being on earth with a device touching a network through their favorite mobile applications, representing brands, venues, and so forth that happen to run Funware software. Now, making a claim that you're going to create a Funware ID for every human being on the planet is a pretty crazy thing to say. But after the last nearly 12 years, we're actually up beyond 15 billion Funware IDs. About 800 million to a billion are active on every single month. That represents about a petabyte of data that grows at about 5 terabytes per day across all these one-to-one interactions indoors and out through these mobile applications and the software that we run on them. When you think of scale, we're up to about 5 billion transactions per day, and that represents ranging from 3 to 500,000 transactions per second. And so what we're actually doing now is taking what we have already built, our platform that we license under a SaaS business model, and we're in the process of scaling that on a worldwide basis, of which we reach more than 175 countries and markets today. When you look at our customers, and we'll then get into the mechanics of what kind of software we're licensing and the form of engagement that go along with that, it's important to realize that we have kind of a who's who by vertical in terms of the Fortune 1000 companies and government organizations that engage with our brand. All of our engagements are business to business, whether those businesses are focused on application experiences for consumers or for channel partners or for employees. Those are just really a matter of semantics. But whether it's coast-to-coast healthcare organizations ranging from Cedars-Sinai, Mount Sinai, and many others, all the way into media and entertainment verticals that include groups that represent Fox, CBS, and many others that you would use for your favorite shows, your favorite networks, your favorite programs. A lot of our platform was built on the top 10 live events in the history of the world on mobile. Things like the Summer and Winter Olympic Games, WrestleMania, the Oscars, the Grammys, the men's and the world's World Cup soccer and events of that size. And what we use all of that for was to create what were the most amazing user experiences behind the software representative of the feature sets and use cases that we all use every day on our mobile devices for the things that we love the most. While we have offerings, which I'll get into, that represent software development kits, application program interfaces, and other sort of licensable chunks of capability for companies that like to build their own applications, we also pre-integrate our platform and make them available on 1 to 5 year SaaS deals so that they can take their brand and content and wrap them around our infrastructure, much like somebody might standardize on Microsoft Office 365 for their productivity suite, or like people would standardize on Salesforce for their CRM. As we go through this today, this multi-screen as a service platform, we've already had more than $150 million of investment, between more than $100 million of equity while we were a private company and another 50 million plus on gross margin and other sorts of investments that we have plowed back into the platform over time from the organic business that we have grown. As I said, the software we use has functionality to help you engage audiences, manage them, and monetize them. So when you think about mobile application life cycles for Apple iOS and Google Android devices and environments, these are really the things that you decide, what kind of experience do I want for my banking application, or for my real estate application, or for my shopping application, or my fan application if you're dealing with sports. You know, as COVID has kicked in a high level and the pandemic has created lockdowns and shutdowns, there's never been a need more quickly now for digital transformation. And within digital transformation, we specialize in mobile applications that are used by all of us to consume our healthcare, our banking, our favorite content, our favorite teams, and all things in between. There's two types of customers in the Fortune 1000 and government organizations that we deal with. One would be what we would call do-it-yourselfers. The others would be the off-the-shelfers. Do-it-yourselfers are companies that like to build their own applications or have other third parties that like to build their applications for them. And what they do is standardize on our cloud-based infrastructure, and we provide all the ingredients that they need to provide use cases and feature sets to either engage, manage, or monetize your audiences. So think of that a bit like you're a baker. We're going to provide ingredients for an amazing cake: water, sugar, flour, vanilla. And you're going to be a baker, do it yourself, build applications, launch them through the app stores, and let people consume them. Alternatively, about half of our customers represent off-the-shelf customers. These are folks that say, you know what, we are Kaiser Permanente, we do our applications ourselves. We really have a good idea to an extent what we want to do for healthcare. But what we really want to do is specialize on what we do well, and what we want to do is partner with someone that can provide a great background and platform, you know, for our patients. So when we see these, just think of it all the time as either ingredients to make a cake, if that cake is amazing, application portfolios, or alternatively, you know, folks say, you know what, I don't want to learn how to bake. I like to eat cake. Can you license something to me so that I can use it for my brand and content? And we actually do that in both capacities. When you think economically about what this means, what it means to us is that we have two types of engagements. Kind of plus or minus $500,000 engagements and kind of plus or minus $1.25 million engagements. What we do in this is think of it like leasing a Ferrari versus renting or buying a Ferrari, and the methodologies that go through with that. So typically we have 1 to 5 year software licensing. While we're an enterprise software company, we typically focus on 1 year retail pricing. But if companies buy 3 years or 5 years at a time, respectively, we'll give them a 20 or 30% discount. So as we go out, we will license these solutions at different price points, depending on if people like to build their own applications. If they like to build their own applications, they tend to be higher budget. And we typically see a low 7-digit engagement for a booking. Conversely, if we have folks that really want to license a solution, they want to focus on the retail shopping that they do well, and they want us to handle the rest, our systems, our platform will do that. And they're really renting a right to use typically about $500,000, give or take. Interestingly, during the experience of COVID, we've seen some profound effects that have led into the investment opportunity that we have before us with Phunware. Namely, as I said, we have over $150 million invested in the platform. The platform operates at scale in more than 175 countries around the world. We focus with a core first 50 customers out of the Fortune 1000 and government organizations in areas that allow us to provide component solutions through software licenses or solutions themselves that we can provide through those same 1 to 5 year licenses. During COVID, we've actually seen this year with our focus in 2020, the average contract length has doubled, the average booking has tripled, and this has really been profound for us. When you look at that, here's really what that's meant to us during the midst of arguably one of the most bizarre events that's happened in the history of the world. A global pandemic, lockdown, shutdowns. Certain businesses have boomed during this period. Companies like Zoom, companies dealing with meal kits, companies that are dealing with online commerce. At the other extreme, you've seen devastation where you've had hospitality or live events for sports or for music that have really been hurt dramatically. We've actually been in the middle. We are licensing software only business to business to large companies. Our business is really about backlog, bookings, and in our most recent quarter, we had just under $9 million worth of backlog. If you think about like a $900,000 3-year deal, in our world, we may recognize that $900,000 over 36 months. We may have that $900,000 go immediately to backlog. We do annually prepaid in advance in terms of the software licensing. So we would take $300,000 for year 1, invoice it to our customers, receive payment, and then we would carry that as deferred revenue as a liability on the balance sheet. And then we would recognize about $25,000 a month or $75,000 per quarter. So when you see these revenues are representative of give or take about 50 core Fortune 1000 customers and growing, some small government organizations as well and growing. And the biggest revenue recognition dip we saw was in second quarter of COVID this year, where you saw sequentially we dropped from 2.6 to 2.2 million. But as we represented, we've seen every week, every month, every quarter, demand is coming back. The markets are opening a bit more with a few exceptions domestically and abroad. And what we saw in the third quarter was a 40% jump in our recognizable revenues while maintaining a good chunk of about 9 million of deferred revenue and backlog. Throughout the year, we've tried to drive our cost structure down in light of the pandemic and expand the margins of our software platform. Successfully, we've achieved a high 50s number all the way up to a low 70s number on gross margin. And what that's meant is as our revenues have expanded, the bookings and backlog keep expanding, and the duration of contracts is getting longer, we're seeing a great opportunity for us as we've been driving to break even. We started the first quarter of the year at about a $3.2 million adjusted EBITDA loss in terms of what we recognize and report. We've accelerated and improved that each quarter throughout the year, and will continue to drive to a state of cash neutrality here in the first half of 2021. Our long-term operating model is very straightforward. We intend to have 30% plus year-over-year growth so that we're in the top 10% of all publicly traded companies. As I said last quarter, we sequentially grew just over 40% quarter over quarter, yet alone year over year. Our gross margins, which have improved from the high 50s to the mid 60s to the low 70s, we want to continue to accelerate those to get steady state above 75%. And then much like you remember from Amazon or with Salesforce, we intend to hit cash neutrality in the first quarter of next year and then plow that gross margin and any of those profits back into the business to continue scaling up and to the right. On an LTV to CAC ratio, which is the long-term value to the customer acquisition cost, typically anyone in enterprise software that's running a SaaS business and achieves a multiple of about 4 is doing quite well. We've actually typically been at least 5 or 6 on the low side, upwards of 8 to 9 on the high side. And what that really means is we're getting a wild efficiency out of our investment in sales and marketing and the scaling of customer addition, longer contracts, more bookings with higher retail prices, more stickiness, less churn, and all the metrics that you might like to see for moving things forward. So with that, what I wanted to do is at least close today in the brief moment that we have with you. Obviously, our ticker symbol is PHUN. As I said, our investors.funware.com is where you can find any and all information about our company. But importantly, when you look at Funware, when we actually went public originally, we went public at a $300 million valuation. We have traded substantially higher and lower throughout. We currently sit in the low 40s. And really, there's kind of a bet on Funware at this point that's very asymmetric for those of you looking to deploy money. The downside is from 40 million, give or take, down to zero. The upside is a 5 to 10x uptick for us to just get back to where we started, and for us to simply trade at a relative comparable for our peer group. We're only at about 2.7 times sales for an enterprise SaaS business on a run rate in the teens, and simultaneously above 70% gross margin and about 9 million of backlog and deferred revenue. We're in a space where you get huge multiples, typically double digit. Here's a whole sampling of those across that we see. And if all we did is get back to just a mean average, you're already seeing us having a multiple expansion with what we already have in place, a share price of 4, and you're seeing a 5x uptick just to be traded normally. We attribute that mostly to us being a new issuance and then COVID hitting, so that we've not been able until recently like this to start at least virtual conferences, get more information out about the company. And we expect to be operating on a cash neutral basis first half of next year, and that we expect to be able to scale in the same way that others have by reinvesting the proceeds of all of the money and gross margin that we have back into scaling our sales and marketing, which have been working quite well. So with that, I'll close today by thanking you for your interest in Funware. Everything you need to succeed on mobile, trading on NASDAQ, ticker symbol PHUN.
Thank you. Thank you so much, Alan. We really appreciate you being here. And that address, info@funware.com, I would imagine is the best place for folks to go with questions.
Sure. That's right.
Great.
Is there any time for questions, or are we just doing streaming today?
I don't think we have any questions in the chat right now. I think we're good. But if we have any that come up, we'll email them over to you. Guys, info@funware.com. If there's anything else, that is where you can send those questions, and we will as well.
Excellent. Thank you very much.
Thanks, Alan. Take care, man.
Bye-bye.
Mr. Hamilton.
Here we are, Patrick. It's that time.
It is indeed. After 2 solid days, 72 presenting companies, a ton of really cool education, right? Think about it. Think of the folks, the educators that we heard from, Mighty Soldier and Lizard King, and we had Schaefer's, we had Weeble, we had some really cool folks on too. So I hope our investors get a lot out of this one.
I hope so too. I want to thank everyone that's attended this event. Big shout out to everyone in chat. Thank you for participating. Thank you for the memes that never gets old.
Nope, so good.
Love it. Love to see chat get absolutely spammed with meme stocks. Love it.
Wow.
But for everyone, I really hope that you took as much away from this as I did. Every time we do one of these events, I feel like I'm coming out a more informed and capable trader, at least for the next month or so. And then the next one comes around and re-ups my confidence.
Until there's a new catalyst to dodge. So
exactly. So I just want to let everyone know we are so really, really seriously from the bottom of our hearts thankful for you for joining us for this. We do plan on next year doing a small cap conference or something very close or similar to it every other month, alongside our boot camp pure educational events. So a lot to look forward to next year. I know that you guys probably have some big plans coming up this month, as it is the end of the year. It's that time for so many people. So I wish you all good fortune and good health. And I wish that to you, Patrick.
And you, my friend, and you. Well, one more thing I'd like to ask our audience for, one last request this year, if I could. We thrive, Neil said this a second ago, we thrive on feedback, right? We're feedback junkies. So we'd love to know what you thought of this, what worked well, what didn't, what you'd like to see, who you'd like to see. If there were stocks that should be on this program and weren't, we want to know who those folks are, right? Educators that should be up here that weren't. All of that is very, very helpful for us as we curate these programs for you guys. We want it to be actionable for you. So if there's anything that you want to pass along, I'm Patrick at benzinga.com. I think, Neil, you have like 18 different email addresses, but which one would you like folks to reach you at?
You can reach me at jason@benzinga.com. Any recommendations for improvement? Also, guys, if you register for this event by submitting your email, you will get a follow-up email with a survey with some questions about our speakers, what you liked, what you didn't like. We really use that feedback that you give us. We literally take it and reverse engineer it into the events that we create for you. So very important, very helpful. Really appreciate it if you do that. And it's a chance to win a gift card. Huh?
Who doesn't like a gift card?
Who doesn't like them? So especially this time of the year, get some Amazon gift cards.
Hey, really quick. First boot camp is January 22nd, 2021.
Heyo.
January 22.
22.
22nd. He doesn't understand. 22nd. But the voice from the ether told us.
Yeah.
January 22nd. That's Nicole, everyone. Nicole's the brains behind the biz over here. We are super, super lucky to have her running a very tight ship. So thank you, Nicole. And
Thank
Neil,
you.
don't worry, man. There's still time to figure out the numbers. Thank you.
So I appreciate it. I'm always learning. So yeah, actually a big thank you to the Benzinga team, Nicole LaPointe, Kelsey Hadley. We've got Luke McCoby,
Obi-Wan Jacoby, is that what you said?
Obi Jamogogi, and then Shelby Jones, Jason Rasnick. He's
Sarah
a big
Traceman.
up and comer. Morgan Bain, big Morgan Bain. Shout out. And gosh, who are we missing here? Who
This is
else?
why you never name names. You can't ever name names.
No, you can't. I just want to thank my agent and thank my family.
Yep. Yeah. Same agency that Tom Hanks has. That's who Neil has. So we've got you.
Okay. All right, everyone. Thank you. We will see you in about a month.
All right. Take care.